I'd like to thank everybody who has come for this conference and also recognize the presence of the people who are following us online. My name is George Mbidi. I am the Communications Manager for USAID's Kenya Investment Mechanism, one of the sponsors of this event and partners of KEPFIC since the beginning. And I will be your moderator for the day. And I would like to start by calling on stage Sandeep. Sandeep is the chairman of KEPFIC, and he is also the CEO of Zamara Group, formerly Alexander Forbes. He has over 30 years of experience working in actuarial pensions and investments consultancy. So welcome, Sandeep, to give us opening remarks.
Good morning, everybody. And I hope you'll allow me to remove my mask since I'm sitting pretty far away, since I'm standing pretty far away from you. So good morning again, everybody. And a very warm welcome to this first KEPFIC Investment Conference. The first of what I hope will be many such investment conferences in the months and years ahead. As was mentioned earlier, there are so many people joining this conference virtually from all across the country and as far as the United States. So I'd like to extend a very warm welcome to everybody joining us virtually from wherever they may be. But for those of us who are here physically, isn't it so wonderful to be out of Nairobi for many of us after such a long time, and to enjoy this, to be at this beautiful Enashipai Resort in Naivasha. When Gatia and I were planning for this event, I'd said to him that, Gatia, we can have the launch, the official launch in Nairobi, but the KEPFIC Investment Conference, we must do it outside of Nairobi so that we can have the undivided attention of trustees and we can bond and get to know each other a bit better and interact in a more informal setting. And what better venue and ambience and setting could we ask for than being at Enashipai? And for this, we need to thank the sponsors of this event, for this conference. I would say a very big thank you for Acorn, Edward Wangoi, GuarantCo. Where's Janice? Janice, you shouldn't be sitting so far back. Yeah? And of course, to the USAID, who have sponsored both the official launch and have allowed us to spend a little bit more than our budget, Gatia, for this event. So thank you very much to USAID, and thank you for being our partners. Once again, it's really great to have Acorn and GuarantCo sponsor us today, and for giving us this wonderful conference experience. So trustees, on Wednesday, we had an excellent, very high-profile official launch of KEPFIC. We had the Principal Secretary for the National Treasury, Dr. Julius Muya. We had the US Ambassador, Kyle McCarter. We had the CEO of the RBA, Zomo Mutuku. I'm sorry he's not able to join us today, but he's well represented. We have Caroline and Monica from the RBA. We had the World Bank Director for Equitable Growth and Finance and Institutions join us as well. We had Americ Saha from MiDA, the partners in the US, who also joined us on that day, and many, many others physically and virtually. And I was personally very, very touched with the goodwill and the support that KEPFIC enjoys, both in Kenya and abroad. We have so much goodwill, and there is a very, very high expectation of us. At the launch on Wednesday, I talked about the background to KEPFIC and how the idea of KEPFIC was conceived. Why it was important for pension funds to diversify their investment portfolios away from the two dominant, the two asset classes, fixed income and equities, that we have a concentration in, and why it was important for us to invest in the real Kenyan economy. How alternative assets, including infrastructure, can be an important part of our pension schemes' investment portfolios, and enable us to get better and more stable long-term returns for our members, as well as investing in asset classes that are not correlated with the markets. And with the volatility that we've seen in the past few years, this is a very important point. And why it made sense for us to do this together as a consortium. Gatia, in his remarks, will talk about the huge financing gap we have for infrastructure in Kenya. An estimated, Gatia, about $2.1 billion, or over 200 billion shillings annually. This is the gap that we face, and this is beyond the capacity of government, of the donors, as well as the banks who've been traditional financiers of infrastructure in Kenya. And provided that we can meet our risk-return expectations as pension funds, and these investments can be properly structured for us, there are plenty of good investment opportunities that we ought to be looking at to improve the outcomes for our members. And the consortium approach of investing together enables us to consider such opportunities and create the scale that we need to invest. Ladies and gentlemen, trustees, on Wednesday, we also signed our formal partnership and memorandum of understanding with MiDA. Some of you may not know who MiDA are. MiDA stands for Mobilizing Institutional Investors for Developing Africa's Infrastructure. It is a collaboration between the USAID and NASP, the National Association of Security Professionals in the US. For the last 2 years, we have been working very well with MiDA. And on Wednesday, we signed a partnership, an MOU with MiDA. And the purpose of that MOU is to create capacity building for trustees in Kenya, to create a forum for knowledge sharing, peer-to-peer sharing of knowledge and information, as well as to facilitate co-investment with US pension funds into Kenya. So this is a very, very important partnership for us. We are delighted to have formalized it, and we are looking for similar partnerships with pension funds in South Africa as well as the UK. So trustees, there's been a lot of work that has been done in the last few years on introducing infrastructure as an investable asset class for pension funds. And we all recognize that investing in infrastructure, and indeed any other alternative asset, even private equity, is not easy. Requires a lot of effort, requires extensive due diligence, much bigger ticket sizes than we are used to, and the presumption is that the risks are much higher. And yes, in many ways, they are higher. And many of us as trustees are nervous about the long-term time horizon, especially given the short terms that we serve as trustees, and about venturing into the unknown. But the reality is that if we are to achieve better returns for our members, if we are to do justice to them, we do need to think about diversification. We do need to think about those asset classes which appear very daunting to us for now. We do need to take the leadership, and we do need to change the narrative from what we have been used to in the past. We do need to test the waters. And no one says it's easy. Yes, it is complex and it is difficult. But that is why, trustees, it makes sense for us to do this together. That is why it makes sense to have the Kenya Pension Fund Investment Consortium. And at KEPFIC, we have put considerable effort into ensuring that we have the highest standards of governance. We've taken a lot of advice around this. We've structured the highest standards. We have an investment policy that will be shared with all of you that brings clarity on the type of assets that KEPFIC will consider, the exposures that we will be willing to take, our appetite for risk, as well as our expectations of returns. We're very happy that earlier this year, we were able to appoint Spearhead Africa as our full-time secretariat, Gatia and his team, right? And this has been really great for us. We've been able to unlock so much in the last few months. The partnership that we have with the USAID Indeed, as many of you will be aware, the USAID are sponsoring the Secretariat costs for the next 3 years, provided we meet certain milestones as KEPFIC. So I'd want us to have a very big round of applause for the USAID. I think I should have asked for a round of applause for Acorn and GuarantCo as well, so please let's do that now. Yeah. Okay. So we've been working closely with the World Bank, has been very, very supportive. The World Bank helped us in our governance structures, in preparing the investment policy, and have committed to support us in the future as we need to. The partnership with MiDA, as I mentioned, and I'm talking about some of the reasons why this consortium approach makes sense. And MiDA, again, can you imagine that US investors are interested in investing in Kenya? Last year, we hosted a delegation of 30 US pension funds and asset owners and asset managers who came to Kenya with assets that they look after assets of more than $1 trillion. And they are keen to invest with us, right? So they are keen, but if we as Kenyan pension funds invest, they will be more receptive to investing into our country, and indeed in East Africa. And we will be working very closely with our professional advisors, with our fund managers. The fund managers, Gatia and team, have presented to the Fund Managers Association. I hope they are represented with us today, or will be joining us virtually, but again, we will be working very closely with our fund managers. And I'm not saying that all of a sudden tomorrow we'll be starting to build a road. I know that as I was driving in from Nairobi this morning and looking at the road, we really feel that pension funds ought to be helping to build some of these roads in Kenya. But we're not just going to be jumping in building roads tomorrow. All of these will be done in a very, very structured, informed manner. Possibly we will be, as I said earlier, testing the waters. We may start with things small, and that is why the presentation that we have from Acorn this morning on student accommodation would be a fairly short-term project that would be fairly easy for us to consider. And we'll be talking to the banks, we'll be talking to our fund managers to help us to structure some of these investment opportunities in a way that we can invest into them. So there's a lot. If you look at the PPP pipeline, there's more than almost 77 projects that are listed there. Again, a lot of these are at different stages of development, but we need to have a seat at the table. We need to engage with the National Treasury, with the PPP, and I was very happy that on Wednesday, the PS actually gave us an open invitation to visit him, to talk to the government on the things that we can do together. Okay. So, trustees, the aim of KEPFIC, a very key goal for us is that over the next 3 to 5 years, we will mobilize more than 25 billion shillings into infrastructure and alternative assets classes over the next 3 to 5 years. Not all of this money will come from Kenya, and that is why we're having these partnerships with global pension funds. We expect that some of this money, indeed, a good portion of this money will actually come from the partnerships that we have created and the funds who have expressed an interest in working with us. We want eventually to become a fully fledged, fully operational investment platform that has the local capacity to mobilize long-term local currency capital and source and structure investments in alternative asset classes with good returns for our members and with a high developmental impact. And talking about development impact, we must all recognize that infrastructure is a very key driver for progress. It's a very critical enabler for trade, private enterprise, and achievement of the social development goals, the SDGs. And as pension funds, we must be playing our rightful role in some of these things. Gatia will talk about these things in a bit more detail in his presentation. Today, we have a number of investment propositions that we'll be receiving. We'll have a number of case studies that we will talk through. And we will also talk about how we can have pooled co-investment vehicles. And Emerick, who will be joining us from the US, will be talking to us and sharing about that. And we also have a dinner and dance. And Konstantin has said that, and Paul as well, that we will be dancing the night away. Konstantin, only until curfew time. 11 p.m. is curfew. Yeah? Okay. So, before I conclude, I want to end with an impassioned plea from myself. This is something that we've been working on very hard for the last 2 years. Yeah? And trustees, we have an important role, you have an important role to build a future for your members by investing their money to get the best possible returns for them. And through KEPFIC, you have a chance as you do this to even build a future for our country, to build our country together and get even better returns for our members. Ladies and gentlemen, trustees, I mean, this is something that I'm personally very, very passionate about as well. We have 1.3 trillion shillings in the pensions industry in Kenya. We have a stake in the success and the health of our economy. And we must take leadership and ownership in what we can do to change the situation. Right? I've talked about the huge development impact that we can create. And as a pensions industry, we can play our rightful role as mobilizers of domestic capital, as an anchor for overseas investors and invest into the productive sectors of our economy. We have a big vision, and I'm very confident, trustees, that together we can show that pension funds can come together and collaborate and invest and create jobs and help to stimulate our economy. And I say to all of us, we owe it to our members and we owe it to our country. And I believe, Hosea, we're up to the challenge. We can do it, and we must do it. So ladies and gentlemen, I want to stop there. Let us say that in 5 years' time, when we look back, we say this was a very major milestone in the evolution of the pensions industry in Kenya, where pension funds came together to collaborate, to invest together, and we actually achieved a transformation in our country and in East Africa and Africa. And we can be real trendsetters and pace setters in Africa and the world. Everybody is talking about KEPFIC at whatever forum you go to, locally and even globally. We need to demonstrate that we can do it. And I believe, and I have absolutely no doubt that we can. So thank you very much. I look forward to a very engaging full day of discussion, interaction. There is a lot of hard work to be done. And over the next few weeks, Gatia and his team, as well as the members of the KEPFIC Steering Committee, will be reaching out to all of you to see how do we now start taking concrete action. At this stage, I think it's appropriate that I ask all the members of the steering team to please stand up so we can recognize you. Josphat from KenGen. We have Elena from Kenya Pipeline. We have Richard from Safaricom. Paul from the Kenya Revenue Authority Pension Scheme. Indeed, we started all our discussions in the KRA boardrooms. So thank you, Paul. And Constantine from MTRH. So we're all the founder, trustees, members of KEPFIC, and this is a team that has done a lot of work. I'd also want to ask Gatia and his team to stand up. Gatia is also doing a phenomenal job and really helping to put KEPFIC and set the pace for us. So thank you all very much, ladies and gentlemen, and look forward to an exciting day ahead. Thank you.
Thank you so much, Sandeep. That was passionate. I think everybody can now see the benefits of KEPFIC. And I would like to have Ngatia to talk a little bit more and explain deeper about KEPFIC. Ngatia is the head of KEPFIC Secretariat. He is the founder of Spearhead Africa, which is the firm that is running day-to-day operations of KEPFIC. Welcome, Ngatia.
Thank you, George, and thank you, Sandeep. Just to reiterate, we are very grateful to have everyone here in this room, those who are here physically, and those who are dialing in and watching us over the live stream. As we did at our launch on Wednesday, we'd like to start off today's discussion by giving you a little bit of a broader overview of KEPFIC and what we are trying to achieve. But this time, we'd also like to give you a little bit more insight on our investment process and the strategy that we would be looking to implement. So, as you have heard, KEPFIC is a consortium of local pension funds that have come together to jointly invest in long-term sustainable infrastructure opportunities, as well as alternative asset opportunities. We aim to mobilize and invest at least $250 million in the near term, and all while providing competitive returns and diversification opportunities for our member funds. We have been challenged that our target is not ambitious enough. Sandeep has just mentioned that we have 1.3 trillion shillings in assets in the industry. Right now, 10% of that can go into infrastructure. Essentially, we're looking at 130 billion. So why are we stopping at 25 billion? And that's a challenge I think that we are up for. At the same time, we aim to build the technical and investment capacity of our members and their stakeholders. And this is the investment ecosystem as a whole. As Sandeep mentioned, we are looking at building the capacity of the trustees, the fund managers, and the whole investment ecosystem, and providing a collective voice and representing the pension fund community on policy and regulatory matters. So our goals are to establish a pool of funding for infrastructure investments, to assess and select suitable opportunities, to attract co-investments from international investors. I mentioned the capacity building of our trustees and their stakeholders, to grow our members and to grow and enhance the collaboration between like-minded pension schemes, and to advocate for our members' interests. Our partners, as Sandeep has mentioned, they have been with us from the very start. And I'd like to recognize them right now. We have USAID, the World Bank Group, and MiDA advisors. And though we are a relatively young initiative, our mission and our impact has been recognized across the country, across the continent, and indeed across the world. And we have been recognized as the Pension Fund Infrastructure Initiative of the Year at the 2019 Africa Investor Awards in Cape Town, South Africa. So turning to the infrastructure outlook on the continent, I think it's no surprise to many in this room that we face a significant infrastructure funding deficit currently. Those numbers are estimated at about $70 billion annually, with Kenya closer to 2.1 billion. Unsurprisingly, energy and transport are the sectors that have received the highest allocation of this investment. However, East Africa continues to lag behind its regional peers, West Africa, North Africa, and the Republic of South Africa when it comes to geographic allocation of these infrastructure opportunities. KEPFIC is going to change that. We have no reason not to increase our share of infrastructure investment from 14% and take it significantly higher. And with the support of those of you in the room and dialing in, we are very confident we can do that. In terms of the funding sources for these infrastructure opportunities, currently you can see that governments account for 37% and are the leading but weakening source of funding for these infrastructure investments. And they are a weakening source of funding only because they are facing growing budget deficits as well as competing needs, such as healthcare currently, food security, education, and the likes. So you can see private sector only accounts for under 12% of the sources of funding, which clearly shows you there's significant room for greater private sector participation in the same. So why are infrastructure assets suitable for your pension portfolios? Well, firstly, these assets provide competitive returns and a reliable stream of liquidity. And by their very nature, infrastructure investments are long-term in the investment horizon, which essentially allows you to match your long-term retirement liabilities with a long-term asset on the other hand. Now, these returns that I mentioned are also linked to inflation. And by doing that, essentially you protect your real return, which is especially important when you look at the investment horizon that I mentioned, which oftentimes is not short-term. These returns also have low volatility And it's as a result of infrastructure investments providing essential services that are minimally affected by economic cycles. And finally, diversification benefits that they provide, given that it's an asset class that has very low correlation with alternative, with other asset classes such as stocks and bonds. So the benefits of investing through KEPFIC are numerous. We mentioned economies of scale. By pooling together our resources, we can look at a much wider range of opportunities than any of us can do so on our own. Further, infrastructure investments are complex, like Sandeep mentioned, and require extensive due diligence, require extensive technical analysis. Oftentimes, this can be expensive. So rather than each one of the 1,300 pension schemes embarking on this journey alone, if we come together, it actually means that we will end up with greater net returns than if each one of us was to try and go through this process alone. Like I mentioned, this is further enhanced by the recent changes in the Retirement Benefits Authority investment guidelines, which now allow pension schemes to invest up to 10% of their assets into infrastructure. I mentioned capacity building of our trustees. We would like our trustees to be just as comfortable with an infrastructure investment as they are with stocks, bonds, or property currently. They say that a journey of 1,000 miles starts with a single step. So we know we still have some way to go, but through KEPFIC, we shall definitely get there. Well, we will be attracting co-investments from global pension funds, which further enhances the range of opportunities we can look at. These pension funds, like Sandeep mentioned, are quite large, a lot larger than us on the ground, but they have a significant interest in investing in Africa and Kenya specifically. But they need us to take the first step. They will not invest if we do not invest with them. And I'm glad that through this initiative, that will be possible. Advocacy is a key focus for us and representing our members in regulatory and policy initiatives. Our members will also enjoy and benefit from investment support from our partners, including USAID and the World Bank. We aim to drive collaboration and networking amongst like-minded pension schemes and to be the leading source of research and insights on this particular asset class. And finally, to present the risk mitigation and prepare the risk mitigation strategies for the investments that we get into. So to talk a little bit about the investment selection process, all investment opportunities will undergo a very strict and stringent evaluation process, which we have summarized. But essentially, it starts off with deal screening and initial due diligence. And it is from this that we will be able to narrow down the opportunities from the whole host that we expect to receive in the coming days, coming weeks, into just those that match the investment criteria and risk return profile of our members. We shall also go into extensive qualitative and quantitative analysis and put together the project and investment summaries. Now, these summaries will be submitted to our member funds, and together with the fund managers and the trustees, we shall then now go into a deep dive of each of these opportunities. There is no better way to build capacity than to look at a real investment opportunity. Finally, the investment decision shall be made, and we'll conclude with ongoing asset management and the reporting functions. In terms of the qualitative and quantitative analysis, we will focus on various key items. If we start with the qualitative side, here we'll be looking at opportunities with strong demand fundamentals, risk identification and mitigation strategies. We'll be looking very closely at the quality and experience of the management and the project sponsor. We'll review all approvals, government or otherwise. We'll review the strength of the investment documentation, as well as the credit profile of the off-taker. On the quantitative side, this is now when we look at the numbers, and they say numbers don't lie. So So here is when we will actually go into a deep dive on the financial model. We will assess the risk-adjusted returns and IRRs of the opportunities, the relative value analysis of one opportunity versus another, the financial ratios, and as well as the sources and the terms of this long-term capital. So with that, before I conclude, I just want to reiterate that we are very keen to move forward to the next steps, which will involve us reaching out to every single one of you so that we can engage on this initiative further. We can bring you on board so that we can all succeed in this infrastructure investment agenda collectively. Thank you very much.
Thank you very much, Ngatia, for your presentation. And yeah, I think that's quite powerful. We are going now to have a presentation from Acorn. It will be co-led by two people. So I'm going to welcome on stage Edward Kirathe and Wangui Maranga. Edward Kirathe is the founder and CEO of Acorn Holding Limited. He has over 20 years of experience in the real estate sector in East Africa. Wangui is the head of corporate finance and investor relations at Acorn Holding. Prior to joining Acorn, she spent 16 years in the fund and investment management sector here in Kenya, managing multi-asset portfolios of pension funds. So I would like to welcome the two to co-lead this session.
Good morning. It's great to meet all of you trustees. Really happy to be here. I think as Acorn, when we were asked to sponsor, we were very keen to do so, mainly because we believe that this initiative is a fantastic initiative for this sector. And we think that it will facilitate the pension industry into alternatives in search of course, return and diversification. So today, I and Wangui will present to you the opportunity that exists in purpose-built student accommodation in Kenya, and more specifically in the Acorn student accommodation D-REIT and I-REIT, which are shortly launching before the end of the year, and which are on the back of the green bond that we listed earlier this year. Before I start on the presentation, I think I just want to make a couple of remarks. First and foremost, obviously, as you know, the Kenyan capital markets have been lacking in good quality, asset-backed and regulated issuances for a very long time. And obviously, this has been a challenge for the market. Now, like the corporate bond market, the REITs have not enjoyed, success, to date in this market, and there have been significant challenges. But we have gone to significant lengths to address those shortcomings to ensure that success both now and in the future. Despite the challenges, I've been in this industry for more than 25 years, and I know that REITs represent the most tax efficient and sustainable way to own this type of assets in the long term. We have been very fortunate to have a lot of regulatory support, as you will see. Earlier, this Capital Markets Authority actually gave us an approval to proceed to engage investors prior to the CMA approval, which, as you know, is not the usual route. Normally, an issuer will go for approval before engaging the market. But we explained to the CMA that with these new products, you can't go to market after approval. You have to talk to the market and then go for approval. And the CMA acted quickly and gave us approval to engage investors on the investment. So all the fund managers, most of the fund managers in Kenya are already looking at the opportunity. And we are very happy to bring it directly also to the trustees. The two REITs that we are going to be launching. They're about 8 billion shillings. Acorn will retain a holding of 3.5 billion shillings. We are very fortunate to have secured an investment through actually PIGE. If you see that banner there, PIGE, Private Infrastructure Development Group. One of the entities under Private Infrastructure Development Group is InfraCo Africa. InfraCo Africa invests in opportunities that in Africa, infrastructure opportunities in Africa that meet the highest international standards and governance. And they have committed $10 million in Kenya shillings equivalent into the Acorn student DREIT and IREIT. We've worked with them over the past 1 year, together with local and international real estate advisors and specialists, basically to ensure two things. One, that the REITs that we launch meet all the CMA regulations, but also that they meet the highest international standards and best practice. And the result of that is that we've got 2 REITs now that could list in any international securities market. As you will see through today's presentation, the COVID-19 pandemic has not changed the fundamentals of demand for students' housing, and you'll see that in the presentation. And so you will also see, hopefully, that the student housing opportunity in Kenya is massive. And private sector investment will take several decades to fill the gap. As an example, the UK PBSA sector was born in 1990. That's 30 years ago. Today, it is still growing significantly. Student housing or rental housing is part of urban infrastructure. In the next, by 2050, Kenya will add 15 million people into our urban areas, whether it is Nairobi or other urban centers. Those 15 million people are going to have needs. They're going to need housing, they're going to need healthcare, and there'll be a need for education. Those types of urban infrastructure, as you will see in housing, is a huge opportunity for pension funds to participate in that growth. So before I go into the presentation, what I would like to do is take 5 minutes to show you a quick video on the student housing opportunity. Thank you.
The KEPFIC vision when it comes to student housing is that we want to impact students positively, not only during their stay with us, but also for life. Previously, students have not been able to find accommodation suited to them, and KEPFIC comes in to develop accommodation that specifically addresses students and their needs. So we look at issues like safety, security, providing an environment that is conducive for their study, and just making sure that it's for students.
We first heard about KEPFIC through our Dean of Enrollment Management. And in fact, when they talked, we found that we really liked each other until we were the first university in Kenya to sign an MOU with KEPFIC. KCA doesn't have accommodation. And we are now in an environment where we attract the students from anywhere in the country. And this is where KEPFIC comes in to focus on the providing the excellent accommodation while we provide the excellent academics. And in that case, it's a win-win for both of us.
We have partnered traditionally with some of the hostel owners. Then we have a conversation and they say, we have these premises. One, those premises are never designed to be hostels. Some of them are basically apartments converted to hostels. And you find students have to live within that kind of environment. But I'm glad that with the KEPFIC partnership, they have hired experts at its best. So they do what they know how to do best, which for us really came in handy to come to help and curb some of those challenges.
Before I came here, I went to so many places, and every semester I was moving from place to place, trying to look for a place that I could call home, because being a foreign student, you basically want a place to call home. What I did not like about where I was staying before was mainly the hygiene, all right, and how they maintain the place. Plus, of course, the water supply. It wasn't reliable. I mean, you wake up sometimes in the morning and you didn't have water to shower. I found out about Kwetu through a friend on Instagram, and we're staying at a certain place with her. Then she moved out, and I kept on asking her where she went to, and then she told me about Kwetu. So I came and paid a visit, and it was really nice, so I had to come here. So when I came in, I went to the Sky Lounge first, had a look at it. It was very nice. Went to the gym, came down to my room. I was able to cook for myself, you know. It really seemed like home, you know. Every after a bad day at school, I'll come back and chill and, you know, relax. And when I came and met the people here, they seemed very welcoming, you know. They seemed like one community that was ready to work and live together. So I wanted to be a part of that community. And I've met so many friends here, really. I've met friends from Rwanda, Burundi, Tanzania, and from Nairobi. And really, it has made me build a family of my own. It really feels like I met family here. Another awesome thing I like about Kwetu is the transport services. They get us to school on time, and they pick us from school on time. And I like the internet as well. It's very reliable, so I get to do my assignments on time, I get to do my research, and I get to communicate with my family as well back in Uganda. One of the things my dad and my mom like about Kwetu is that it's good value for money and it's affordable at the same time, all right? It comes fully furnished, all right? The transport, the internet is all on the package. And it's very convenient to pay because my parents get to pay back from Uganda to Kenya. So one word I would use up to sum up living at Kwetu is home, really. It's home, you know. Home is a place where you always look up to go to when you're tired. Home is a place that's comfortable, you know. Home is a place that can give you a smile even when you've had a bad day, really. So that's Kwetu. Kwetu is home, yeah.
We are very happy with the performance of the completed buildings, and our students are also very pleased. And we have taken in their input to design our future projects, so Kwetu can only get better. Towards the future, we expect, in the next 5 years to have more than 5,000 beds near every university in Nairobi.
Okay, thank you. Santi, thank you very much. So we'll move into the presentation, which I'll take you through together with Wangoi. I'll take you through the first sections. Just waiting for it to load, then we can start. So after the presentation, we will have a Q&A session where you could talk about the questions. But the opportunity that I'm presenting to you trustees today is around the Acorn student accommodation REITs, the development REIT and the income REIT. So I think if we go into the summary, so first, purpose-built student accommodation is a well-established asset class internationally. If you go to the US, the UK, South Africa, Australia, in many global markets, purpose-built student accommodation is a very established asset class. The largest providers of student accommodation in America and the US are two REITs as well. And these offer immense growth potential for Kenya. At the same time, obviously, Kwetu has now become the most sought after student accommodation in Nairobi. And we've worked with, as you will see, a lot of international investors to make this a reality for Kenya. Because the government first tried to do this through PPPs, as you might have heard before. The team that is developing these assets has a lot of experience in the sector. For any REIT, you need a seed portfolio. You need a good seed portfolio. That was one of the challenges, by the way, of the REITs that have launched in Kenya. Without a very good seed portfolio of high quality assets, and what high quality really means is that there is an underlying demand. Because at the end of the day, REITs offer returns through the revenue that they are generating. So that is critical. The other thing I think we've seen in this market, and even when we were structuring the green bond, a lot of investors have lost money because most of the investments are not asset-backed. One of the things I believe you will hear today is about infrastructure or this housing or REITs. The beauty with them is that you have an asset backing your investment. So it gives very good capital preservation features, which I think has not been a big thing in this market. Obviously, a lot of real estate in this country has been done through what I might call a bit opaque, and especially some of the players that you may have seen over the last couple of years. REITs offer a very transparent structure, and the other thing is that they are regulated. And I believe personally, having been in this industry for so long, that regulated vehicles are going to be the future. And of course, one of the things that you will see in these REITs is that we are offering them to the market as a co-investment. So we are in, and we are in substantially. So we are just bringing on board new investors into this huge space of student accommodation. And finally, of course, at the end of the day, the reason I think you're here to talk about alternatives is about return. And what we've tried to do, and we've worked with a lot of partners to do this, is to structure them so that they're offering a good Kenya shilling return of around 18%. So we'll talk about that during the course of the presentation. So I mentioned that there are two REITs. So I'll give you a quick summary of those two REITs. So the Acorn Student Accommodation D-REIT will be the vehicle that will be developing the student accommodation assets, acquiring the land and developing those assets. Then once they are developed and they are stabilized in terms of revenue, they will be sold to the Acorn Student Accommodation IREIT, which will allow the D-REIT to continue to develop. That solves a big issue for this type of investments, because in this type of investments, you do require, the IREIT requires deal flow. The REIT that was launched, one of the challenges it had is deal flow, because REITs only make sense at scale, and you cannot scale if you do not have deal flow. And then the development REIT needs an exit mechanism. The IREIT provides the exit mechanism. So those are the two REITs. They will be initially unlisted. We did a lot of work, including with the National REIT Association in the US, to understand how exactly do REITs go to market. Again, you don't list a REIT at the beginning, primarily for two reasons. One, you want to bring in first only sophisticated institutional capital. And then, secondly, you want to prove the dividend payout and the rental growth. Before you prove those, you can't list the REITs. The intention will be that eventually the Acorn Student IREIT will be listed on the NSE. But what we've done is worked with the NSE so that there will be an OTC platform initially for those who might want liquidity. I mentioned the two REITs are about 8 billion. And what it is we are offering them on a blended basis. So an investor who invests 1 million shillings, okay, the minimum investment is 20 million shillings, 6 million will go into the D-REIT, and 14 million will go into the IREIT. So it's on a 30-70 basis. You will see later why we have done that, but the idea is to enable investors to achieve a return of around 18% on a 10-year hold basis. As you'll see, REITs are only suitable as a long-term investment. They are not suitable as a short-term 0 to 3 year type investment. I mentioned Infraco Africa, who are the anchor investors in the two REITs. Together, of course, Acorn is a substantial investor, as you will see. So Cooperative Bank is the trustee, or will be the trustee for the two REITs. So some of you may know Acorn or may not, so I'll just spend a little time to tell you a bit about us. We're about 20 years old now, started back in 2001. We originally started by offering project management services to the corporate sector. And in those years, we did the head office for Coca-Cola in Africa and the head office for Deloitte in East Africa. In 2015, Helios injected capital into the business to take a stake in the business and came on board. And that is when we pivoted, because before that we were developing and project managing a wide variety of real estate assets. At that point, we pivoted now to focus on rental housing for young people, starting with student accommodation. So we started our first student housing accommodation immediately thereafter, and for the last 5 years, that is what we have been developing Kwetu. This year, we started work on Kejani. Kejani is meant to be a more affordable student accommodation than Kwetu. Typically, Kwetu is priced at an all-in inclusive of between 12,000 to about 30,000 shillings per month. Kejani will be priced at about 8,000 to 10,000 shillings per month. Our current focus, as I have said, is student housing. But as you will see, the opportunity in rental housing in this country offers an opportunity in the future to move into other segments, including young professionals. So what we are hoping to build is Africa's leading rental housing business. Now, this is an important slide, trustees. Let me explain. A lot of people have come into the real estate space and burnt their fingers. And the reason that that happens is that the capabilities required to do real estate development are missing. So what we've done over the last 10, 20 years, but more specifically the last 5 years, is to build those capabilities, which I'll talk about now. The first thing is, of course, you need development capability. The capability to acquire land in the right locations without losing your money. And then after acquiring it, and of course, hopefully you don't end up with a swamp, but after you acquire it, then to develop that development on time, on budget, and to the specified quality and function. That has been a big issue in this industry, because you find projects often overrun the time they are provided for, and often they go over budget. The moment you do that, you're losing your investment. So that capability is a critical capability that we've built within the business. The other core capability you have to build, if you are to do rental, is to build a capability in property management. These assets of ours, for us to be able to manage them at that scale, we have a lot of capabilities we've had to build in-house, including engineering and maintenance, housekeeping, sales and marketing. You're letting 2,000 plus, today 2,300 plus rooms. You've seen 60,000. You've got to have a call center. You've got to have a software that enables you to do that. That is what we have built, and today our rent default rate is 0. Because of those capabilities that we have built to be able to make sure that the rents are being paid, they're being paid on time, and you do not have defaults. Obviously, when we were clear that the exit for these assets is in REITs, we have built up an investment management business, which is the REIT management business that will be regulated by the Capital Markets Authority. Obviously, all those 3 core capabilities have to be supported by other capabilities, including finance, IT, HR, and corporate affairs. And if you look down there under corporate affairs, is statutory approvals and university alliances. So today we have university alliances with the University of Nairobi, KCA University, as you saw, and many other universities. And every day we are building new alliances. Just this week, we have established a new relationship with Daystar University. So that capability, the other thing I want to point out just for your knowledge is, when you do real estate, one of the biggest areas is statutory approvals. If the assets that we built for students, I was telling the government the other day, we need 37 different permits and approvals. So you've got to have a dedicated team running with those approvals. So that is a key capability for anybody who wants to do real estate at a significant scale. Then on the next slide, you will see that we have managed so far to mobilize almost $175 million into this space over the last 5 years, which started with the investment by Helios, to date around $65 million. We then got the US government private funding arm, OPIC, who committed $50 million in 2018. Last year, towards the end of last year, we issued a green bond that was anchored by Emerging Africa Infrastructure Fund, with who put 30% of the $43 million that we raised. And just a few months ago, we secured the InfraCo Africa investment of $10 million into the Acorn REITs. What we are trying to do now is to bring local institutional investment to co-invest alongside these investors and ourselves. So that's basically what we are trying to do. Obviously, we are doing this on the back of the issuance of the first green housing bond in Africa and the first green bond in Kenya. That bond was supported by GuarantCo. I believe you'll be hearing from Yanis later. And as I said, Emerging Africa Infrastructure Fund. But we saw two fund managers participate, ICA Lion and Sanlam. And I believe some of your funds may be sitting in that green bond. And of course, we saw the banks coming in strongly to participate. One of the reasons that the banks participated very strongly is because we had a Moody's rating. Now, Moody's have never rated a corporate bond in Kenya. And when we went to the CMA, we told them we need to get Moody's to come and do ratings in Kenya. And this was the first rating done by Moody's in Kenya. It brought 7 firsts to Kenya, including being the first Kenya shilling bond to list on the London Stock Exchange. So on the back of this, we were very clear that the next step was to then launch the REITs that we are talking about today. As I said earlier, real estate requires a lot of capabilities to do well. The team that is delivering on this strategy and executing it has over 200 years combined experience in real estate, investments, operations, and management. I lead the team. Ken Lusa deals with our site acquisitions and valuations. Peter runs all our corporate affairs. Indresh came in 2 years ago to run the property operations. The property operations is the most complex part of this business. And he came in, we brought him in to come and help us build that capability. Jennifer is our HR director. Wangoi, you'll hear from her later. She's in charge of investor relations. Raghav joined us in February as our chief investment officer, having done 13 years of real estate in emerging markets. And Jackie is the one who makes sure those students are happy and smiling. She is in charge of the customer experience, because it's not just about collecting rent and giving them a room. You've got to give them an experience. That's part of what has made Kwetu the most sought after student accommodation. Susan runs finance, and Wambu oversees our development team. Now, when you're assessing any real estate opportunity or sponsor, it is quite critical to look at where is the team that will deliver on that particular strategy. So over the last 5 years, we've built quite a substantial competitive moat around our business, being now the market leader in offering student accommodation. We have a very good pipeline. I talked earlier about the platform. That integrated platform of development management, property management, and investment management is crucial. We've fortunately got very strong institutional and international backing. The Kwetu brand today is the most well-established student housing brand. In fact, there is no other in the market. And when you come to the student housing and REITs, first, economies of scale is vital. We do not build less than 500 beds in any of our developments because that allows you to spread costs across a lot of beds. If you have 20 beds, the economics do not work. So scale is very critical. And of course, the asset quality, the quality of the assets is very critical also because that is what drives the demand. So that's a bit about Acorn. Now we can just talk about this asset class, purpose-built student accommodation. So purpose-built student accommodation, as I said earlier, this is a global asset class today. As I mentioned, in the US, the biggest player is called American Campus Communities. They have over 200,000 beds. In the UK, they are called Unite Students. They have over 60,000 beds. Both of them are REITs, by the way, in those two markets. Now, globally, the private sector is the one that's filling the gap. So from around 1990, even if you go to developed markets, governments and universities, they just said we need to get out of student housing. So the private sector stepped in to fill the gap. And that is what is happening in all markets in the world. Obviously, these asset types are characterized by high occupancy, low income volatility, and strong rental growth. And that has made it a very popular asset class for long-term institutional investors. I mentioned economies of scale. You need at least 400 plus beds or rooms for it to start making sense. And these assets are quite specialized to operate. I know that a few of you have visited the properties, and I think you've seen the sophistication of the operation, which is obviously higher than the standard residential. If you move away from a global context and come to the Kenya context, what you will see is that significant capital is required in this sector. I mentioned that we have mobilized about $175 million, but as you will see shortly, the Acorn student accommodation IREIT, by the time it gets to 60,000 beds, will be $1 billion IREIT. So significant capital is required, and this is where pension funds can come to play a significant role, co-investing with these international investors to fill the gap that is there. Obviously, I mean, the gap in university education, in the market is very big. We have 550,000 students in university, and the universities combined have about 40,000 beds. The gap is extremely big, and so you find a lot of students stay in very poor quality accommodation, and there is very limited supply in the market. There are very high barriers to entry, and of course, land acquisition and permitting in this country is quite a complex affair. What is driving student accommodation demand? What's the underlying fundamentals? If you look at that table on your left, that is Kenya's demographic pyramid as at 2016. And as you can see, if you look at the age group 0 to 14 years old, you can see all those are young people who are going to be coming into university and college over the next 15 to 20 years. That is what is driving the demand. And on the right, you can actually see how student enrollment has grown. Something happened in 2005. The Kibaki government was very big on education. So what happened is that in 2005, for the first time, the government delinked enrollment with accommodation. So they allowed universities to enroll more students than they could accommodate. Until 2005, public universities could not do that. And that, of course, led to the increase in enrollment, of course, because the government wanted to encourage, access to higher education for more Kenyans. And that growth has been tempered somehow by the Matiang'i and Magoha reforms, but we are still having 100,000 young people joining university every year today. And that will continue to grow. We project, based on the numbers that we are seeing, it will continue to grow at about 5% annually. Those students obviously will need somewhere to live. For these markets that we are in, at the present time, because we cannot serve the whole country, the gap is just too overwhelming. We have focused on certain universities, the public universities that are near and around Nairobi metropolitan area, and some of the private universities. But these are not the only universities we are serving. We are serving over 65 universities and colleges at the moment. And we have students from 53 nationalities living with us. Of course, 80% of the students living with us are actually Kenyans. So the Kwetu addressable market today, if you look at just that target universities, without considering all the others we are serving, is about 45,000, and that will grow to about 60,000 by 2025. So you can see we only have 2,300 beds for Kwetu. And our target for Kwetu is to achieve 35% market share. So 35% market share is about 15,000 beds. So there is still a lot of headroom, because even when we get to 15,000 beds, which we might get to by 2026, you will find that the numbers have increased. Now the market has increased to 60,000. For Kejani, which is the more affordable one, you'll see it on the next slide. This is a bigger market. It is currently estimated at 70,000 beds. Now, we don't have a single bed for Kejani. We have actually just started the Kejanis this particular year. So by 2022, we will bring about 4,000 Kejani beds into the market. But it is still not going to be, it's still going to be way too little for the size of the market. And it's, of course, a market that is growing quite significantly. That is why I said at the beginning that the student housing gap it's going to take a long time to fill, because even we estimate that at the top of our development capabilities, we will only be able to deliver between 5,000 to 7,000 beds a year. But that student population is going to be growing at 25,000 students a year. So we are still going to be quite far from where the need is. So let me take you through the REITs themselves now. So what we did is to put together a strong team of advisors and service providers that would bring credibility into these REITs, because credibility is a very important part in investment. So obviously COP Bank are the only active trustee right now. So we are working with COP Bank as the trustees for the REIT. Renaissance Capital is the overall transaction advisor, and actually they had to bring in real estate experts from other parts of the world, because we wanted the REITs to be structured in a way that they could list in any international securities market, whether it is Singapore, London, or New York. So we brought in experts from there. We've been working with the local law firm of OK Law, but we also brought in Gollings. Gollings is based in the UK, and we brought them in because they are one of the largest legal advisors in property funds and REITs in the world. So we brought them in to help with structuring. The auditors for the D-REIT will be PwC, and for the I-REIT it will be Deloitte. The tax advisors, Viva Africa. The valuers for the D-REIT is Tyson's and the I-REIT is Knight Frank. You will see why it was important to separate the auditors and the valuers for the two REITs. CDSC are the registrars, and then we have FBW as the structure engineer for the I-REIT, certifier and project certifier for the D-REIT as AGs. So that's the team that we've been working on with the last couple of months on this REIT. The board of the REIT management company, Acorn Investment Management Limited, will be chaired by Rose Mambo, who has been in the capital markets for many, many, many years and was lastly the CEO of the CDSC as an independent chair of the board. And we also have Winnie Nyamute as an independent director, but also chair of the audit committee. We have two sponsored directors, 4 sponsored directors, myself, Peter Raghav, and Amil, who represents Helios. And then we have InfraCo Africa, will have a seat on the board, and we have a company secretary sitting on the board. It was important to have at least 2 independent directors on the board, plus InfraCo, to give investors comfort that things will be done properly. Now, the thing is that the structure of these REITs, that Acorn is a sponsor, Acorn is also the REIT manager, the development manager, and the property manager. It has, the benefit is that it gives the capabilities the REITs need to deliver the returns that we're promising investors. The downside is that it creates potential conflicts of interest. So what we did is work with Gollings, the real estate advisors, and InfraCo to find the best structure outside that has been used in other markets to address those kind of issues in this kind of investments. And so we're going to have an investment committee for the D-REIT, an investment committee for the I-REIT. Nobody will sit across those two committees to have a Chinese wall. Then each of the committees has an independent valuer who's not related to the other valuer. But more importantly, the thing that we saw is done in other markets is there is a corporate governance committee. Now, the corporate governance committee, any transaction by related parties or any transaction between the D-REIT and the I-REIT has to be endorsed by the corporate governance committee, and the sponsor does not sit on the corporate governance committee. It is only when the corporate governance committee approves that investment that the board can make a recommendation to the trustee to go on with that transaction. So that's an important step, and that's what I was saying, that the REITs offer a governance structure that gives investors comfort. And that is the reason InfraCo has committed money, because they are coming as a third party. They were not part of the sponsor, they've never been part of us, but working with them, we were able to create a governance structure that enabled them to commit R1 billion into the REITs. Very, very quickly on the investment policy. So the D-REIT is investing in the student accommodation in Nairobi and its environs. It will be able to have up to 60% leverage. It will build the Kwetu and Kejani properties, and obviously it will sell its assets once they are stabilized into the income REIT. And then for the income REIT, again, similar objectives, but for it, its purpose is to hold these assets long term. Now, one of the things we are doing, there will be no leverage in the income REIT, so it will not carry debt, because debt, the cost of debt in Kenya is higher than the cost of, or rather is higher than yields for property. So it doesn't make sense for the income REIT to carry any debt, although by law and regulation, it can carry up to 35% in debt. So those are the two REITs. Right, for those, of course, who've not had an opportunity to see the assets, these are the two developments that are coming up outside USIU University. As I said, the locations we take are very next to the university, and it's a 500-bed plus operation. In terms of what's available in the market today, if you see where students live, as you saw in the video, you'll see in the next slide that students are currently living in quite dilapidated conditions, as you can see on your left. What we are trying to do and what we've tried to do is provide them decent but affordable quality accommodation. And that is what has driven the demand. In fact, before COVID, the properties were full and we had quite a large waiting list. And you will see how the properties are performed even during the pandemic. So these are the pipeline. So I said, a REIT, you don't set up, one of the challenges Fahari faced, one of the challenges the Fusion REITs faced, they didn't have a quality portfolio and large enough to attract investors. Because if you don't have scale, you don't benefit from the advantages of a REIT. So the top properties at the top are the 4 operating properties. We have over 2,300 beds now operating across 4 properties. And the ones in the middle are under construction, and the ones at the bottom are in pre-development. So the ones, we have one on Jogoo Road, one in Ruaraka, one in Parklands near Steamer Plaza or Kengen, one next to Strathmore University. Those are the operating ones. The USIU, we have 2 properties coming up. They're under construction. One is being completed in December. Then we have one in Hurlingham, just near the Total petrol station, near Desta. That is already, I think, on the 9th floor now. And then these are the lower ones. There is one next to Chiromo campus. There is a Kwetu and a Kejani. And then near Catholic University in Karen, we have a Kwetu and a Kejani coming up. So this is our build plan. So we want to get to about 60,000 beds by 2030. You can see just how long it will take to get even to 60,000 beds. It will take us 10 years, basically. And we want to start 5 to 6 new developments every year, so that by that time, when we have a 60,000 bed portfolio, that's actually a $1 billion portfolio. So there is a huge opportunity for pension funds to participate in this sector and in this growth. I talked about the returns, so let me explain how the returns work. If you look at the bottom, if we start at the bottom, that's an extract from the Knight Frank Africa report for this year. You can see where yields for property are. So yields for property, residential, 5.5, industrial, 8.5, retail around 9, office 8. Now, with this kind of yields, and obviously, by the way, these are prime yields. So what does that mean? That if you look at residential, most residential does 3.4% yield. So 5.5 is a prime yield, right? Now these yields, the challenge you have is that these yields are lower than going to put your money in this infrastructure bond and government bonds. So how do you get investors into this asset class, especially institutional investors, if yields are so low? The solution, after consulting across the market, was to offer institutional investors a blended return, so that institutional investors get into the development REIT, which is able to achieve very high returns of 34%, and the income REIT, which is at 11%, but the blended return is 18%. Now, one of the things that affected Fahari, and in this market, an income REIT can't survive on its own, not to institutional capital, because if you can see where the returns for an income REIT are, and the reason it's 11, that's a combination of the net yield. So the net yield, the dividend it will be paying, which is around 7%, and then the capital appreciation, because we review our rents annually. So if you combine those two, that's how you get to 11%. If you hold for 10 years, you get 34% in the development rate. By participating in a blended way, you get to 18%. Now this is obviously significantly higher than government securities. So you get a better risk-adjusted return at the end of the day. Eventually, the income rate will not be for, well, not be, it will be primarily retail investors. So in 2 to 3 years, we have developed a plan how we will take the income rate to retail. And that is the reason we will list the income rate eventually, so that we can be able to attract retail. However, what we always try to do is we always do our assumptions on the lower end. We actually think that rental growth will be much higher than what we have built into the model. The reason that will be is because the supply is lower than the demand. And whenever supply is lower than demand, then the rental growths are higher. So if we end up with the income rate achieving 12.5%, 13%, it would still be attractive to institutional investors. Now, just 2 slides to illustrate. Globally, if you look at REITs, and you look at long-term how they have performed against the S&P 500, you can actually see that REITs have done very well against the S&P 500, even when you look on a 35-year horizon. REITs are attractive to long-term investors. We are being very careful as we speak to the market to be very clear that actually the attractiveness of REITs is on the long term. And if you look at from 20 years to 35 years, you can see the REITs are quite stable in terms of how they deliver returns. So they are very long-term type investments. Obviously, they have still, this is a 2013 report from Merrill Lynch, but basically you can see how they performed. So what we did is we simulated, and you'll see in the next slide, what we did here is to simulate how the Acorn blended return for the REITs would have performed against other investment products in the market. And we took the Zamara report and we obviously looked from 2011 to 2020. And as you can see in 2011, stocks or equities performed very, very well in that year. But if you go to 2020, there is only one thing that happens to move from 51% to 12.5%. And of course, that means that the equities have been very volatile, delivering very unpredictable type returns. Now, that is equities in emerging markets anyway. They are quite volatile, and basically you have to either time the market or you will have challenges. What REITs offer is, if you invest 5 to 10 years, you can see in the dark blue bar that over time the REITs outperform other asset classes. And that's why we are being very careful to tell investors that REITs are 5 to 10 years. So it is for you to match your long-dated liabilities with a long-dated asset. That's the way they work. So at this point, let me just hand over to Wangoi to take you through the next 2 parts. Thank you for clapping, but I'm not done. You'll see me again.
Okay. Good morning, everyone. So I'll take you through the next 2 parts. The first one being purpose-built student accommodation as a resilient asset class. Now, when we talk about resilience, I think this year has taught us many things. Tumeona mambo, and some more than others. And in Acorn, we've seen some things. And why is that? Because The bulk of our business, most of our business is really providing accommodation to university students. And we lost them when the COVID pandemic started in March. So universities closed and the students went home. And when they went home, we had to close our properties, the 4 properties that are operational. We had to close them for a couple of months, which meant that we were not earning revenue at all. So, resilience. When we talk about worst case scenario, we were living it from March. But what happened is that we realized that, you know, when we talk about analysis and we are asked what's the worst thing that can happen, and people, analysts and investors do their, you know, paperwork and Excel module spreadsheets and their sensitivity analysis, and they come up with a figure. We were living the worst case scenario, but for us, we think that was the best worst thing that could have happened to us because it really proved the resiliency of this model. Now, resiliency is really just a definition. The definition is the ability to bounce back from a tough situation, and we have managed to bounce back. As I mentioned, we closed in March, and for 3 months, these properties were not earning anything, but we were still incurring expenses. So for 3 months, these properties were on a loss-making trend. But in July, after 3 months, we decided to open the accommodation, even though the universities were still closed. And the reason for this is that our property management team, led by Indresh and Jackie, who you saw on the slides before, they were still interacting with the students, our residents, very, very regularly. And it came to pass that actually, even though they were studying at home through virtual learning, it was not a conducive environment for them. And so many of our residents still wanted to come back to the hostels. And so we decided to open in July. And what we've seen is actually something that surprised us even, because to date, from July to now in October, we have seen about 50% of our residents coming back, either in the form of paying a deposit, so that when universities open physically, they are back, or are actually living in in our hostels. And so we are seeing that kind of resiliency, not just here in Nairobi, but we are seeing it in the global markets, that PBSA continues to be quite resilient, even in the COVID pandemic, with students wanting to come back. So we are expecting universities to reopen in January. I think we are represented by a few universities here. You can correct me, but our model is that we are expecting full resumption in January, although I think we've seen some indication of some opening in November. And even with that conservative outlook, we are expecting to break even at the end of this year, even in a COVID pandemic. What does that mean? It means that even in our worst case scenario, had these properties been in the REITs today, we would still have been able to deliver a dividend yield and give out a payment to investors, even in the worst case scenario. So for us, that's what resilience means, and it looks like it has been proven practically. So on the next slide, what we'll find is that the COVID pandemic has not fundamentally changed the outlook of PBSA in this country, certainly not for our business. We have seen that demand for higher education in Kenya is still strong and still continues to be strong. We have seen that virtual learning, even though it has become the trend for the last couple of months, is not sustainable. We don't have the infrastructure to maintain long-term virtual learning in our universities and our schools, and therefore physical learning will continue to be something that's quite paramount and a long-term for our learning education centers. We've also seen that the family home is not ideal, certainly not for our clients, the residents in our properties. we've seen many of them, as I mentioned, wanting to come back to their residences, mainly because, the infrastructure at home is not good. You have the dining room where you have to share that dining room with your siblings, with your parents. The internet speed is very slow and you have to log into class, do your exams. Electricity is an issue, so you keep getting interrupted. And they don't have any of those issues when they are in our Kwetu residences. Our internet speed is very fast. They have an uninterrupted electricity with the generator backup. They have their own rooms. They also have virtual learning in the residences. And we've seen that also the students are young adults and are social beings. They've been in the house with their parents and their siblings for a couple of months and they were going crazy. And they just wanted to get out. And we saw, practically speaking, about 1,000 of them coming back saying, we just need to come back to the residences. And so that's why we feel, even with the valuations that have been done recently by Knight Frank in the properties, we've seen that the COVID pandemic has not really altered the valuations of these properties. Nonetheless, COVID has happened and we have had to put in very stringent public health restrictions in the sector. And when we closed down, we made sure that we put down a lot of these operational elements in our residence to just make sure that we are compliant with Ministry of Health guidelines. And so what happened is that when we shut down in March, we put down these guidelines together with the help of the public health authorities, and we opened in July fully compliant. The good thing is that even with the compliance, we did not need to change the design of the rooms. So in terms of, many of the investors, particularly for the green bond, asked us, did you have to change the design of the rooms? Did you have to move students around? Did you have to do this? It did not impact the number of beds or the number of rooms that we had, because most of our rooms anyway have been single rooms, and the ones that are twin rooms are divided, and therefore we were already socially distance compliant. So that does not affect, in terms of revenue lines, the number of beds going forward. And that's something that's very key, because for us, whilst our number of beds will not be affected, it would seem that the number of beds out there for those who are competitors, that is the public hostels or the mums and pups, the private sector developers who are putting up their properties, where many of them had 6 to 8 students or residents in one room, they would have to think very carefully about separating or removing some of the beds in that one room, and therefore removing not just the supply that is already a constraint in the market, but also dipping into their revenue line. So for us, we are very lucky to note that that's not going to be an effect for us. So in that regard, we do expect that there will be a severe shortage of student accommodation. While it's already there, it's probably going to be worse following the COVID pandemic. In terms of the positioning of our accommodation, as I mentioned, we are very well positioned to take up the space right now. We have great broadband access for our students. Each room receives very high-speed internet speed access. Each of our rooms is furnished very well with the learning facilities, desk, chair, beds, to just make sure that there's a comfort for proper learning. And we also have learning centers in each of our 4 properties to just make sure that the students are able to learn, even in a classroom situation, for their classroom virtual learning. So we are very, very ready for the next future, even though COVID will be around for the long term. Now, in terms of numbers, as Edward mentioned, we have 4 operating properties right now. And these properties were earning very decent profits before the pandemic, before March. And you can see these are the three properties. So let me just give you a history. We have Kwetu Jogoo Road that opened in 2015. In 2017, sorry. And in 2017, it took about 15 months for this property to be fully let, full occupancy. 1 year later, we opened Ruaraka, and Ruaraka took about 12 months for the property to be fully let. Now, as the brand continued to improve, people knew about Kwetu. Also, the occupancy rate of occupancy was also improving quite dramatically with every property. Parklands, there was our second last property, which we opened in 2019, sorry, in April. And that took us 5 months to fill up. So you can see that with every property, we're just filling up at a faster rate. And our last property is Wilson View next to Strathmore. And that we opened in February this year. And in just 1 month, we had to close it because of the pandemic. But even within that 1 month, it was already 40% let. So the properties have been doing very well, but we closed in March. So April, May, June, July, you're looking at a loss because of lack of revenue whatsoever. But when we opened in July, we started seeing a ramp up in demand, and students started coming in. And these are the actual numbers for the three properties. August and September came back to small operating profit, and the projections for October is another operating profit. But what we've done is we are quite conservative. We are assuming that in November and December, universities would normally close down for Christmas. And so we've decided to take a very conservative approach and assume that there will be some exits during the 2 months before a ramp up again. And even with those conservative figures, we are still seeing that all three properties will have an operating profit for the year. So again, that just goes back to the point of resiliency for this asset class, and in particular for our business model. And so in a nutshell, what the pandemic has done is that it has reinforced the resiliency of PBSA in terms of the operators globally and including ourselves as Acorn. As I mentioned, we are on course to make a modest operating profit for 2020. We are looking at a sensitivity model that even if the whole of 2020 our properties were closed for the 12 months, that would still not have impacted the IRR of our properties over a 10-year hold, because it would only have reduced the return by about 0.3% when you look at it over a long term. And we are seeing that the addressable market that we are looking at in Acorn is about 50% of the total market. And again, for conservancy, we're only looking at targeting 35% of those students, which, you know, in a nutshell equates to a very small figure of 17.5%. So even with competition, even with COVID, we still are looking at a very small market share, which we are seeing we are still very far off from reaching, and that's why we have a 10-year projection to, you know, just cover this total market share of about 17.5%. And that's why with our build plan by 2025 coming through, we are only seeing that we'll only be able to achieve 5% of market share. So you may see that, you know, the total number of beds that we are looking at is quite large when you look at it in number size, but in terms of market share, it's quite small. So if we go back to the REITs establishment plan that we were talking about, that all these properties that we are planning, that we are developing and are operating, we are planning to transfer them into the D-REIT and I-REIT. We have an establishment plan of about 3 years' time, of about 3 years. The first step is to establish the REITs, and we are planning to establish them by the end of this year, by December. And as was mentioned before, these two REITs have been anchored by Infraco Africa. Infraco has come in with not just a $10 million commitment, but also what they did is that we worked with them for over 1 year to just make sure that the structure, the documentation of these REITs was really up to international standards so that we could be able to, you know, market them and even list them in any exchange going forward. And what we are doing is that we are targeting the rest of the market, only institutional investors for this time round. And the reason for this is that these REITs were not going to be listed in the first instant. Learnings that we had from the past REITs and also advice that we got from the National Association of the REITs in the US, as well as the REITs Association of Kenya, led us to the conclusion that listing a REIT on day one is not a very good way of coming into the market. The market needs to see a track record. The market needs to see that the REITs can deliver a sustainable dividend return, a sustainable dividend payout. It can be able to prove the rental growth that has been promised to investors, and very importantly, that it can be able to scale up. And so for that reason, for the next 2 to 3 years, we will not be listing until those are achieved. And then after year 3, around year 3, we will list the IREIT, and that is when we'll be able to get retail investors coming in to invest in the REIT. Now, in terms of the establishment phase, on the next slide, is that, as Edward mentioned, we took a different approach from what the market is used to, where when you go, an issuer normally goes to the market, structures a deal, then goes to the market and offers it to investors, and that's the first time that investors see the product. What we've done this time is that we went to CMA and told them that we really need to engage the market and see how it is that we can be able to get the most marketable security or marketable product. And so CMA gave us a no objection letter to go to market, and that's what we used to go to Infraco. And with Infraco, we worked with them as well as with local fund managers, got some insights, and were able to create this REIT for the last 10 or so months. And we also now, after Infraco was quite satisfied with the level of compliance, the level of structuring and quality, especially corporate governance and alignment of the promoter with the investors and minority interests, they were able to now secure the commitment of $10 million. So that's where we are. Now we are at step 2, where we are coming to you as investors to show you our product and to offer you the product. We have also engaged the fund managers, all the fund managers from the last month. We've done, we did quite a number of roadshows with them, and so they are now quite familiar with this transaction, and they are going through their due diligence as we speak. And at the same time, we are also engaging CMA. We've been engaging with CMA for the last couple of months also. They are very familiar with the product, but at the same time, they are looking at the product and to looking at it to give us approval. So once that is done is when we'll now go to market and officially open the offer, which is targeted for sometime next month. So in terms of our capital raising targets, as I mentioned, we have 2 vehicles, the D-REIT and I-REIT. The AUM of both these vehicles will be 4 billion shillings each. So that's a total of 8 billion shillings, but we are not going to market to look for 8 billion shillings. We're going to market to actually look for much less. And why is this? Because Acorn is going to have a significant stake in both these REITs. We have skin in the game for the long term. We are going to have about 2.5 billion shillings invested in the D-REIT as the promoter, and we'll have about 1 billion shillings invested in the I-REIT. Then Infraco, with their 1 billion shillings, is also going to split it 30-70, with 300 million shillings going to the D-REIT and 700 going to the I-REIT, which leaves the gray part of the pie which will be coming to you as investors to see if it is an opportunity that can be that you can look at by way of investment. And so in total, we are looking for an optimum fundraise of 3.5 billion shillings by the end of this year. And so this 3.5 billion shillings will come in at 1 billion for the D-REIT and about 2.5 billion shillings for the I-REIT. Subsequently to that, we do also expect to come back to the market in the next year or so. As the I-REIT is buying properties from the D-REIT, those will also need capital raising, so we'll be coming to market every time the I-REIT needs to buy properties from the D-REIT for subsequent capital raises. Now, in terms of the evolution of the investor base, one of the reasons why the Acorn D-REIT has got a significant stake by the promoter Acorn, and then it reduces to about 30%, is one, skin in the game is very important to us, but also two, is that Edward mentioned that the returns from the I-REIT are usually not very attractive, because what are you giving investors in the I-REIT? You're giving them a dividend yield, and the dividend yield, though when you compare with other properties, is attractive on the, for our properties. When you compare with government yields, investors might say, why do I have to have an 11% yield while I can get 13% in an infrastructure bond, you know? And so why we are doing that is that we are keeping a big stake in the D-REIT, so that as the I-REIT is capital raising in the next years, the Acorn can continue selling some of the D-REIT units to the I-REIT investors so that they can show up their returns, and that 18% can continue even for subsequent capital raises. And so in, as you can see, that there's a new investor coming in 2022-2023, that will be the retail investor coming in through the listing of the I-REIT. So what are we suggesting or recommending to you as trustees and as investors? Is that, you know, we are saying that you can come in and look at this transaction, just as you are looking at many other transactions as KEPFIC. You can also look at this transaction. It is giving you a very attractive return from day one, but you can start small. You don't need to come in. It's not a big ticket size like many infrastructure deals. The minimum investment is 20 million. However, you know, when you look at your pension scheme sizes, you can look at a size of whatever, 1 to 2%, a small percentage of your scheme. But by going in small, what it allows you to do is it gains you exposure and experience to alternative assets that are not already on your portfolio. You're going to be looking at a different way of how real estate is managed. So that can also be a comparison with your existing portfolio, your existing property portfolio. You'll be looking at working with a real estate developer with an integrated platform that is probably not seen in any other real estate company in Kenya, certainly not in East Africa. And so by that little exposure that you have in your portfolio gives you the two benefits of getting your 18% return, as well as being able to get a lot of experience from another way of looking at real estate management. And you know, if you were to come in now, you'd avoid getting locked out in subsequent capital deals. Just to give you an example, is that our green bond, we are reopening it next year. And in that reopening, we are looking at raising, you know, about $1 billion and something, about 1.5 billion shillings extra from the green bond. But what our current investors have told us is that they want to take up that portion of the green bond, which means that there would be probably nothing left for the rest of the market. And so what this has shown is that when you have good regulated products that are giving you decent returns, is that with subsequent capital raises, you might you might be locked out if you are not there in day one. So that would be another benefit to look at this transaction. And within time, you can always increase your and diversify your portfolio over time. We not only engaged with CMA on this transaction quite a bit, but we also engaged with RBA and with IRA, trying to look at, obviously, for us, talking to the regulators is something very critical for us, to just make sure that all the regulators are on board with the products that we show to market. RBA were very positive. They were very positive for the green bond, and they are now very positive for the 2 REITs that are coming to market. However, in terms of, one of the things we wanted to find out was guidance from them in which asset class would this transaction fall under. And what they said is that because it is not a listed REIT, I think when the guidelines were being developed, they had envisioned only REITs being listed. And for us, we explained to them that listing of REITs is not something that we were planning to do on day one, but after 3 years, and they understood that. And so what they advised us is that these REITs would fall under any other asset class, which is a 10% allocation, but it also means that it needs direct trustee approval. So that's a benefit for you as trustees, that the fund manager would have to come to you with a specific recommendation, and you have to give a specific approval for it. So we urge you to look at this transaction quite keenly. And so with that, I'll just hand over to Edward to make the concluding remarks. Thank you.
Okay, thank you for listening to us and listening about this. Now, just 2 things I want to say at the conclusion. So, one might ask, so why is Acorn going the REITs route? Of course, despite the limited success so far. I think what we saw with the green bond is that the market actually has a demand for well-structured asset-backed issuances. That the demand is actually still there. And actually, what is happening in the Kenyan capital markets is that there is a general flight to quality and capital preservation. And therefore, we are quite clear that if you have a good, well-structured product with a good return and properly regulated, that there is actually still quite a good market. But REITs offer 4 benefits to investors. The first is, on tax. Even when you transfer assets from the D-REIT to the I-REIT, there is no stamp duty. Now, I know that most retirement schemes, you're exempt from, income tax and that, but even when you do your real estate investments, you can't escape stamp duty. Now, in REITs, there's no stamp duty impact. So there is 0 friction between the 2 REITs. The other thing, of course, is we can clearly see that there is a flight to regulated products. Investors in real estate have lost a lot of money because of investing in these unregulated vehicles. And we can clearly see that the benefit of REITs is that because they are regulated, they will increase transparency and obviously build investor confidence over time. But the last 2 are the most important. If you saw those assets that we are putting into the REITs, each of those building costs between 1 billion and 1.5 billion shillings. Now, if as a pension fund, you buy an asset in Kenya for 1 billion or 1.5, it is almost illiquid, because at that ticket size, there are no buyers. If you have, and I've done real estate for many years, if you have a ticket size in Kenya above 500 million, there are very, very, very few buyers. So you're stuck with your asset. But what the REITs give you, because you're buying units in multiples of 20 million, which are listed on an OTC and eventually will be listed, you will have liquidity for your investment. So when you need to pay out your members, you'll be able to get the liquidity you need, which is very hard to get when you own an asset at that price. But secondly, when you have, if you take one building today, one of our buildings, you're only in a single location. But if you participate in the REIT, you're participating in multiple locations, multiple tenants, multiple universities, so you're diversifying your risk. These are not assets to hold as individual assets. They're best held in a pooled vehicle, which you can then buy units into and get the same benefits you'd have gotten had you, bought into one property. And in real estate, concentration risk is a very big risk, because markets move and things change. And like now, a lot of people with office buildings, I tell you, they are not sleeping very comfortably. They're waking up in the middle of the night because, and especially if you own one, you're stuck in that location. And locations keep changing in terms of attractiveness over time because of government policy, infrastructure, and other things. They can change a location. The simplest example I can use is, you see what happens to petrol stations when the government is building roads. A petrol station can go without any revenue for 2 years because the road has been diverted, So concentration risk is not a good thing. It is a big risk. This reduces that particular risk. So finally, if we go to the last slide, how do you establish successful REITs? These are the key things to look out for in a REIT. The first thing, you must assess the sponsor's capability to deliver those returns. Do they have the internal capabilities that are required end to end to deliver these returns? The Fahari REIT struggled because they didn't have all those capabilities. So the returns, the mall wasn't delivering the returns that was promised, the offices, and that affects you. Then which is related to the platform that we talked about earlier. That end-to-end platform is vital. Obviously, it is important for a sponsor to have a significant stake. The sponsor needs to go with the investors so that, they know that, okay, I have a good sponsor, but they've got skin in this game. They would lose if I lose. So sponsor stake is very important. One of the things we also learned is make sure that there is a performance fee so that our REITs are structured in a way that the base fee is small, and only when investors hit a certain threshold do you get a performance. In the Fahari, if you looked at it, it was a fixed fee, whether the thing is underwater or above water. That's not a good structure generally. And then, of course, you need deal flow. Again, the ability to REITs only makes sense if you can achieve scale. So you do need the deal flow, the ability to access that deal flow, and it needs to be a high quality deal flow. Returns was a big issue. As I said, income REITs in Kenya can't survive on their own. You need the blend into the development REIT because of where government borrowing is at. If one day government borrowing comes down to 5%, as it did sometime, in the 2000s, then maybe it can stand alone. But right now, it's not. It wouldn't. Of course, list after dividend track record and growth. And finally, and this is important, global REITs are specialized REITs. So in other words, if you want to do a retail mall REIT, you can't mix it with offices, residential. Why don't you mix? Because if you mix asset types into a REIT, investors, analysts, it becomes very difficult for analysts to understand what's going on in your REIT. And when analysts can't understand what's going on in your REIT, they'll just tend to discount you. And so if you look at global REITs, they're either in logistics, in retail, in commercial office, or in residential or PBSA. So it is very crucial for a REIT to be segregated into a specialist segment. So with that, thank you for listening to us. We appreciate. I believe we are happy to take a few questions if there are.
Thank you very much. Acorn, we will start with one question from Moses. Moses, following from on Zoom online, he is asking this. He's saying that he's following the brilliant presentation that you are having, and then asking, with the new norm occasioned by COVID-19, which has seen significant shift to online learning, what is your view on the impact on the demand side?
Okay, thank you. I think we kind of alluded to that. Education is not going virtual anytime soon. It's going to go back to physical learning. In fact, the government is really trying to accelerate. In fact, what surprised us is some universities have already opened, and that's what's building up the occupancy. Virtual learning will only complement physical learning. But also, as Wangoi mentioned, one of the things we saw is that the first students to come back to the property, 90% were from Nairobi. And of course we asked them, so, why I'm coming back? And they said, I'm fed up of mom and dad. So I'm sorry for parents, but I mean, they are driving each other crazy in the house. And they're like, Dad, let me just go back there and have my space. Every 18-year-old in this world wants to move out of home as soon as practically possible. And therefore, that human need, it's going nowhere. So even if university education was to go virtual, these young people would still tell Dad and Mom, please, to Eshimiane, let me go and stay on my own. And that's what we found. So that's why the fundamental hasn't changed. And I suppose some people in the audience may have those young ones, and you know how they are. Yeah.
Thank you. Any question from the audience? You start by telling us your name.
My name is James, and I have just one or two questions. You mentioned that you need 37 permits, to get a project going. That's really discouraging. I mean, assuming you had foreign investors in this room, I mean, we look like, are those really necessary in your view? Okay, just in your view. And since the PS Treasury said we can walk to his office anytime, and maybe Sandeep, you can have a chat with Sandeep here, and just tell us whether they are really necessary. 37 just looks too high. That is one. Two, my former high school is in Nairobi, and it needs accommodation. I mean, the accommodation that we had was colonial. It's a prime area on Wayakiwe. Is it possible for you to contemplate going down to high school level and doing the same thing that you're doing at the university level, especially if you're given the land for free? And the last one is, what mitigations do you have against students who go on rampage because their football team lost or something like that? It happens. Those are my three questions.
Okay, thank you very much, James. Let me, I'll try and start with the first one was? Oh yeah, it's very disheartening. I mean, we've been talking to the government. I talk to PS Charles Hinga all the time. You have, if you look at, just last year, you saw the government demolishing properties on riparian, and then you saw them stop. The reason is, they are like 3 different acts in Kenya that define riparian. There is the Survey Act, there is the Water Resources Management Act, and then there is the NEMA Act. And all of them define riparian differently. And they are just duplication. You go to site, I need a permit from the National Construction Authority, the contractor needs a permit from the Nairobi County government, we need a permit from the Directorate of Occupational Health and Safety, And they're all duplicating similar things. What I do know is that the new Nairobi Metropolitan Service Unit, they are actually trying to consolidate those permits to make it a one-stop shop, because there is just too much duplication. You know, I want to dig a borehole, I have to get a Warma license, I have to get a NEMA license, I have to get a city council license. So when you look at all the permits that are required, I mean, we totaled them up, we said 37 permits. It doesn't, but you don't see them, you know, because you apply for this one. When you now finish your building and you want to put your parking, you now go for a civil works permit. So, you know, it is, and I tell you, most developers in Nairobi don't meet those 37 permits. But these guys, once they see a tall building, you know, they move around. They come for you. You know, so you discover, every day we are discovering that there's a new permit that has come into play. I don't know, and there's a new act, it says this. So you're right, James, it's a very disheartening situation. They tried to create something called the one-stop shop at the Ministry of Trade, but even that has just been, you know, unable to do anything. So yes, it is a problem. But then for us, how do we deal with that problem? We have a dedicated team. They do nothing else but permits. So they just spend their life on permits and looking at the Kenya Gazette to look at which new law suddenly, I don't know, a regulation that has come in, because that's the thing that will trip you. And that's why they stopped the demolitions. They demolished the most obvious cases of you know, people who had built across the rivers, but they stopped because they realized even the acts are not saying the same thing. Yeah, the second question was, high school is a tricky one. I haven't contemplated it. It's a sensitive age. Even university is sensitive. The only thing is that they are now adults. You know, they are over 18, so they have their own you know, ID and can be independent. From a legal perspective, that's what I mean, legal liability perspective. Now, to your last question about damage, I remember when we started and you know, OPIC came to talk to us. One of the things they worried is that it would turn out like the US social housing, you know, the ghettos that happened in the US after they did public housing in the 60s. They said the students will damage their rooms. As you say, the team loses, they go on a rampage, destroy things. We were told they would run away without paying rent. You know, their students, where will you find them? But that's why we needed to build that property management capability, to be able to know how, you know, we have such a diligent process in those things. But what is surprising, and it wasn't surprising to us because we had seen PBSA in other markets, these students really take care of their rooms. They are so proud to have left home. They feel it is my room. You go into the room, they've put a little carpet, they've put potted plants into the room. They actually, I'm so impressed at how the students take care of their room. They feel it's my space. But in addition to that, we inspect the rooms on a monthly basis. And we make sure there is a housekeeping team and a maintenance team. Anything that is gone wrong, we will fix it and charge you. So, but the rate of fixing it and charging is less than 0.5%. It is so low that it is almost negligible, and we don't see it. And of course, we have to inspect the rooms because soon after we opened, you know, we had seen this in the US and UK, but we hadn't seen this in Kenya. Then you discover that every matatu in Kenya has bed bugs. I'm sorry to tell you. So what happens is when students go in matatus, they come back, there are bed bugs. So we have to fumigate much more regularly than even SGR has bed bugs. I'm sorry to tell you, but it's a big problem in this country. There are bugs in the, if you don't fumigate regularly, you're going to have a serious bed bug problem. And that's why student accommodation, it's not for the universities to run. What I have seen, it is so sophisticated. The universities can't actually run. And of course, they're getting very little money from the government.
Okay.
Two questions.
So I really want to ensure that even the people who are following us online are involved. So there is one question from Brightlight Group. What about ability to pay rent when the economy is down and parents are losing jobs or having less income?
Okay, thank you. Well, for sure. I mean, there are parents who have been impacted by this thing, but I think education is so at the heart of Kenyan parents that we have seen parents selling assets to educate their children. It's almost like a top priority for any parent. So you find that from what we have seen, the students are not struggling to pay their rents. They're paying their rents on time. And we even from previous experience, the education is too high up as a priority for a Kenyan parent. That, it's one of those, after probably, housing, food, and health, it's education. And parents will make a lot of sacrifices to get their children the best education they can possibly afford. And we are seeing it even now in accommodation. That they want, especially girls, parents want the girls to stay. They really worry about the girls. Yeah, so I don't see that changing.
Yeah, what they see, just to add, is what they see, the education, the rent that the parents pay for the residents is seen as part of the school fees. It's not seen as rent. Their perception, they don't see it as rent, but they see it as part of school fees. So if they have to pay school fees, they also have to pay accommodation, and that's just part of the education package. So that perception is very different. It becomes more of a need than a want.
This question at the back.
Yes, mine is not a question, it's a comment. And I must say that today I've learned something I never thought about before. I've seen Kwetu, but I never knew it presented such a great opportunity for investors. I'm a professor at a university, and so I understand the situation of accommodation for students. And I'm glad at my university you are building some hostels. Currently, students cannot get accommodation from the previous hostels that were being accommodated before, because they cannot meet the COVID new regulations. So where are they going now? Most of them are still at home because they cannot report back and they have nowhere to go. Actually, what is going to happen, and that's why I say COVID-19 has given you the best opportunity for these PBSAs, is because the old hostels are going to die out naturally. Why? Because maybe they have been having like 4 students in a room, and maybe about 20. And so what will happen is that they do not have economies of scale, maybe to accommodate 2 students now in a room. It will not make business sense anymore. And there you go. So for investors, this is an area we can look at. The opportunity is enormous, and you've demonstrated, even with the numbers, that is actually a real investment. And in the long term, not just in Kenya, but globally. Those who've studied out there, student accommodation is a real business, and it's good you're introducing it here, and quality, and with a lot of standards. But not needless to say, I'm sure there are also risks with that. You can have a very, very good product like the one you have, and then start off with very good confidence with the parents. We take our children there, and probably an incident happens that will wipe out all the confidence, and you find your hostels empty. I don't know whether you've considered risk mitigation factors. The long term, maybe dealing with the student drug issues. I'm sure if it's reported in the media one day that your Ruaraka hostel has issues with drug or alcoholism or prostitution or whatever, teenage pregnancy or student pregnancies, I'm sure that will be the end of your business. So I don't know how you mitigated this in terms of managing the student behaviors and ensuring that you maintain a good name, because reputation is everything in this kind of investment. So thank you.
Okay, thank you first for the kind words, but
sorry,
also...
I didn't say my name. My name is Thomas Githui. Dr. Thomas Gidhui, from the Catholic University of East Africa.
Yes, we bought some land from the university just a few months ago. Okay, so that's why I said managing student accommodation is a very complex. Now, we have a team at each property, and we work very closely also with the National Intelligence Service and CID, because there are not just one or two risks. There are many risks. Drugs, as you say, prostitution, but also even terrorism. So we work very closely with the security agencies. We have a team, and again, under corporate affairs, the security team that deal with that. Now, in terms of managing student behavior, by the way, by and large, again, that was a concern at the beginning, but after over 3.5 years of operations, we have to evict less than 0.5% again of students. We evict only because of 3 things: drugs, violence, and any kind of harassment, sexual harassment, etc. The other thing is our young people, they're having a lot of mental challenges and mental health challenges. And by the way, we have handled a number of cases, and the parents actually just come to thank us, because what happens is we have young people straight out of college. Those are the people we hire to be the what we call customer experience executives at our properties, so that they can relate and they can talk about their problems. If a student is thinking about, is having mental issues, they can go and talk to someone. But we hire those who are actually quite mature. And then the other industry we hire air stewards, because air stewards are trained to deal with even, delivering a baby in the sky and keeping the plane safe, or dealing with a drunken passenger who's unruly, and this thing is 30,000 feet. So we hire them, we mix them with these young people to manage the student life. Then we also have reports that come every day. We have critical incidences, and they are rated critical incident, 0, 1, 2. A critical incident 0 is a serious incident, and those get reported immediately. So we have a lot of things we've put in place, and we've had no suicide in our properties. We've had attempted suicides, but we have been able to pull those children out of that. And for me, I think that's one of the things that I'm most proud about, because, that person was going, and then you have to, but because of this quick action of staff, you're able to rein them in. Because I'm sure even the universities, you deal with these things in the university, the same things. So we've got a team that manages all of that. We check, that's why we inspect the rooms once a month. And we inspect in such a way we know where the drugs, because the drug lords of Kenya, when they come and see a building with 500 students, that's like a rich place to, to get, to start peddling their drugs. So we work, that's why we even work with the intelligence, CID. At every of our properties, the OCS in that area, the OCPD is someone, we have a team that's dealing with them, regularly. And that's why I said it's a fairly complex business to try and do it without the right capabilities. We've been able to develop that. You'd actually find you can't make money in the sector. And then we know that our operating margin is 70%. So we know what our operating margin is with all those things in place.
Well, I have a question also.
Yeah, so let's take from you and then from him. And guys, we are really, really running short of time. So I have a few questions also from online. So I will only take those 2, then the 2 from online, and then the rest we will interact with Acorn because we have them. And so Yeah, Ngachi, I know you also have several other questions that have been sent to you.
The same question.
The same questions, okay. Yeah, so I will have her, then him, and then I pose the two questions from online, and we close it.
Thank you for the opportunity. My name is Joanne. I'm a trustee for the Kengen DC scheme, and I'm just asking, have you looked at the competition? Have you perceived the competition in the market? Because, 10 years, a lot can happen in 10 years. And obviously, you've told us that the 18% blended return is based on a whole period of 10 years. So I'm just thinking, have you thought of how it'll look in the future? Also, with regard to skin in the game, you said that you've got, I think you begin with 67% in the D rate and 24% in the I rate. And I'm just wondering, of course you have to offload for the institutional investors to then come in. But how are you looking, with regard to percentages, in 10 years? Because we want to feel that you're working with us, in the 10-year period. Those are just some of the questions I'm asking myself.
Okay, Joanne, let me start with the last one. And thank you for the question, which is a good one. So we have a long-term commitment to the two REITs. The 1 billion we invest in the income REIT is not going out any time within that period. It stays there. And that's a commitment we have made even with InfraCo. That's why they're investing. In the D REIT, we will not go below, we will not go below our 30% holding in the D REIT. That's our commitment. And it's also because we want to participate. We know it is a good investment. We've been in it for a few years. So we are not just doing it to align with investors. It's actually a good investment. The reason we are bringing local institutional capital in is globally, when you look at these assets, they tend to be held by the institutional capital for the long term. Because at some point, InfraCo will come, they will go at one day. But if you're thinking 10, 20, 30 years, these are assets that are held by institutions. So that, I hope I've answered the second question. The first one, John, remind me. Competition. Oh, yeah. So that's why you heard me say that although the market for Kwetu beds is 45,000, we cannot take 100% market share. Even Safaricom doesn't have 100% market share, despite its dominance. So for us, while we know we can at least get to 50 or 70% market share, we are actually working, all our models are built on 35% market share. So we are actually leaving a lot of headroom for a competitor to come in, although we know the barriers to entry in PBSA are extremely high. You've got to mobilize a lot of capital. You saw earlier, I talked about 175 million, that's 17 billion shillings. You've got to build the capabilities that I've talked about that have taken us 20 years. So really, will competition come? I think so one day. Why will it come? Because it's an attractive asset class. There are these guys, they're called global student accommodation. They're buying assets all over the globe. They have not yet, I go to those conferences, they have not yet started looking at Africa, but at some point I'm sure they will start looking at Africa because tertiary enrollment in Africa is only 10%. It's so low that it's going to grow and demand will grow, and where demand grows, people come. But even they can't come into real estate is a very local business, so they would have to have a local partner. So the barriers are very, very high, but it's possible that somebody's gonna come up.
Yeah, and just to add, in terms of the return over that 10-year hold, is that, even in the other properties that we are seeing, the other sectors, you see the yields coming off because of competition, or there's a supply glut and too much supply in the market. And as mentioned, the supply here, there's such little supply for good, decent student accommodation that it will be a while before the demand, the supply saturates the market. So in that regard, what drives the returns of them of any investment, particularly for the IREIT, will be the rental growth. And so for while there is a very big constraint in supply, we'll be able to keep the occupancy levels high and the rent high. And as I mentioned, we were very surprised to see, even during COVID, we are still able to fill the properties, and we are selling out rooms at between 15 and 30,000 a month. There are some even rooms, the premium rooms, for 30,000. When we started building the first rooms, the first buildings, we had a very small number of premium beds at 30,000 because we thought they were unaffordable. But those were the first to go, until we had to even replace the twin rooms, 2 floors of twin rooms in the Parklands property into premium because of that demand. These kids know if they don't come to these properties, if you go to the Parklands is a student accommodation area outside of Kengen. Everything else is is student resi. So if you see, and you're a trustee there, you see the kind of accommodation these kids have. It's appalling. And so for those who are able to afford, they are willing to pay that amount and continue it for the long term. So we don't see that being a constraint for quite a while.
Actually, if there is anything you take away today, there are 550,000 university students today. By 2030, it will be 1 million. We will only have 60,000 beds if we build at full throttle. So now you do the numbers for yourself.
Okay, thank you, Edward. I think personally, I'm very happy because we have been talking about this, and on behalf of CPF Group, we are definitely going to be looking at this opportunity very critically. But I have a few questions. One of the questions I have is on this model of blending hybrid. I'm a bit concerned that when I look at the characteristics of a REIT, is, to my understanding, it's a short-term, or it's maybe a 3-year investments, which means therefore, upon completion, then the participants then get their dividends or whatever and move on. Now, while it's meant to supplement or support the income returns, the fact that it's going to end, and if I'm not in both, so that means the person who is on the other side, on the income price, it may lose out. So I really, I'm not very clear about how you exactly are going to manage that, whether you are then going to insist that the investors should invest in both, in the proportions you mentioned, or it's going to be different. The other one I was thinking about is that having learned this lesson about COVID and any other shocks which might come, is there room for creation of a investors guarantee sort of system or arrangement? Could there be a possibility out there in the market that you can sort of ring fence the income, particularly when you are going to go to retail investors? Because that tends to be an issue for the retail investors later on. And finally, I would like to ask whether the design component and of the student accommodation, again in view of these challenges which might come, and schools, the way they are closed now, and when in future it may be closed, is it possible to consider a multi-user sort of design so that you are able to switch from one user to another user in case of such a situation? Yeah, thank you.
Yeah, thanks, Henry. So let me start with the last question. So yes, definitely, if let's say pandemic was to last 5 years, we can easily convert this into pure just normal rental. And as I said, these young people are anyway looking to leave home, so they'll negotiate with their parents, whether they are working or in school, and they're easily convertible. But the way we intend to do that, we intend next year to go into the young professional rental. And that will be a completely different product, because our aim is to build rental in Nairobi across all the young age groups from 18 to 35, But we started with students because that's where the need was the most acute. But yes, we will look at those. But those will be different developments that we will do through a different REIT, by the way. Because remember, I said you don't mix asset types in the REITs. To your second question, equity, normally you can't get, and I'm sure Janice will come later, she offers guarantees around the world. Basically, equity you can't get guaranteed. But in our green bond, the investors have a guarantee because it's a debt instrument, it's not an equity instrument. But that is why I talked about capital preservation, because as the equity investor, you own the assets. So you have actually, in a sense, you have security, you have the asset, it is your asset. So even if anything were to happen to Acorn, the investors in the REITs are left with the assets. So this is an asset-backed investment. And that, I think, is one of the most important features of REITs. If you buy shares today in a bank, you depend on that bank continuing to exist. If tomorrow it stops, you've lost your entire investment. But in this one, if tomorrow Acorn ceases to exist, you are left with the assets. Yeah, so that's to the second question. On the last one about blending, so, excuse me, we're only able to offer blending for the first 3 years by offering part of our stake in the D-REIT to investors, institutional investors. And that's why we said earlier, for the income REIT, within 3 years it has to go retail. Because retail investors can't access 11%. When they go to the bank, they get 2%. Retail investors can't access 11% or 12%. But we have a strategy, a digital strategy, which we will be unveiling sometime next year, of how we will tackle that retail market, just like we've tackled everything else. And eventually, they will be the retail will become the biggest segment in the income REIT. Yeah.
Thank you. Yes, I can see Sandeep wants to say something before I ask a question from online. The final
Thanks very much. I'll use the chairman's prerogative to ask the question. So thanks, Edward. Are you able to just indicate again what is the amount of money you're looking to raise for this, both the REITs by December? And in terms of, you've invited the pension funds that they can put in a minimum of 20 million shillings and participate. If KEPFIC were to come as a block and put in a sizable investment, are you able to offer us any special terms, conditions, and can we get a better deal? Can we get a seat at the board?
Sandeep, you're putting me in a difficult, but so the money we are raising is 3.5 billion in the local market, because the rest is taken up by Acorn and InfraCo. Now, actually, we are not, let me clarify, we are not raising money, we are diluting ourselves to crowd in local institutional money, because right now we are 100%. So it actually just comes to the leader, so that we can bring in institutional capital from locally. But unfortunately, we are not offering any special deals for any specific, but one thing we can discuss is if you want to sit on the board and be able to see what's going on, we gave InfraCo a board seat as well. And I think that's something we can discuss with KEPFIC, if, with a sizable check. That is definitely something we can discuss. But if we start cutting, it's kind of, that gets a better return, we'll actually destroy the product even before it has a return. But certainly, I mean, even the way, as Koi explained, the REITs, they raise their money through capital, rights issues. So then you get, you almost ring fence a certain right for yourself within the REITs as well. Yeah.
Okay, thank you. The final question, taking this from Samia Gadia, is asking, they are keen to understand the impact, if any, will the removal of VAT exemptions previously accorded to REITs and asset-backed securities likely to have on your listing plans?
Okay, thank you. Yeah, that amendment was done this year. Of course, we are working Treasury to get it out, but it doesn't affect our REITs because we fall under residential. Residential doesn't have VAT. So the short answer, it doesn't affect.
Okay, thank you so much, panelists. Thank you so much, the audience, for the questions. Great interactions. We are going to have a very short break. We were initially supposed to have 30 minutes break. We will only have 10. So please grab your tea and get back to the seat within 10 minutes for the next presentation. We have a great lineup awaiting us today. Thank you so much. Thank you very much for your obedience. Coming back within 10 minutes. So we are going to have a presentation from GuarantCo, and again, co-presented by two people. We're going to have Janice and Samuel. I will give a brief about these two. Janice is the Managing Director, PIDG Infra Solutions. She joined GuarantCo in 2015 as a Regional Director, East and Southern Africa. And Samuel is the Investment Director, also with GuarantCo. And Samuel has over 20 years of investment banking and investment management experience. These two are going to speak to us about infrastructure investment opportunities from GuarantCo. Welcome, Janice, and your co-presenter. Thank you.
Pleasure to be here with all of you today and to see some very familiar faces. It's good to see some old faces. Mr. Onde, it's good to see you again. It's good to see the steering committee, Josephat, Paul, Elena, and of course Constantine, who helped make this happen. We were very happy to hear about the KEPFIC launch as GuarantCo. It's really good to see trustees having a seat at the table and getting proactive. And so I really look forward to working with KEPFIC to see how we can try and, I guess, stimulate the market, get things done. Because for my job is actually to try and get long-term local currency funding for infrastructure projects. And you guys have the long-term local currency funding, so for me, I'm incredibly excited to be here. I'm also very proud to see that, you know, Kenya has done it again, and we've got awards, and you're winning awards as trendsetters and pacesetters in the African market and in the world. So I'd like to do three things today. We're going to talk about GuarantCo, so just talk a little bit about who GuarantCo is, just to put it into context, because we're not an issuer, we're not a sponsor, we're a catalyst in the market, so I'm going to explain what that means. We're going to talk a little bit about what we think infrastructure is. Gachi did a fantastic job in the morning, so I'll probably just add a little bit to that. And then finally, we'll talk a little bit about some of the transactions that we're working on as GuarantCo. And you know, don't worry, I won't bore you with my voice the entire time. My colleague here, Samuel Chasia, will help share some of the floor. So let me start with GuarantCo and who we are. So GuarantCo is part of the Private Infrastructure Development Group. It's a platform of companies that were created to solve for what we call market failures in infrastructure finance. So we have an equity company. We've heard a lot about them this morning, InfraCo Africa, and they provide equity into infrastructure opportunities. We've got a dollar debt company called Emerging Africa Infrastructure Fund, who, when required, can invest in local currency, as they did in the Acorn bond. And then, of course, you've got GuarantCo. And that's us. And our job is really to try and provide our guarantee to get you comfortable to invest in infrastructure in local currency. So who's behind us? Where do we get our money? We get our money from 5 governments. The British, the Dutch, the Swedish, the Swiss, and the Australians provide us with our equity capital that enable us to write our guarantees. Now, of course, for you to take our guarantee, you need to be comfortable that this guarantee is safe to take and is worth the paper that it's written on. So our guarantee is backed by our credit rating. So we're highly rated, highly internationally rated, I should emphasize. So we're AA- Fitch, A1 Moody's. So just to give you a perspective, Kenya is rated B1, and I know you love buying government paper. You're very happy with government paper. We're a couple of notches above that, which is actually why when we listed the Acorn bond with the Moody's rating, it got a rating that was one notch above government because of the strength of our guarantee. So what's our vision, and what do we do, right? So really, what we'd love to do is to be that catalyst to make more infrastructure transactions happen in local currency, but most importantly, getting it from people like yourselves who hold the long-term, was it 1.3 trillion Kenya shillings, that should be funding this infrastructure, right? That's really what our vision is. And why local currency? Why would donors, these 5 governments that I mentioned earlier on, be interested in trying to make sure that pension funds are putting money into infrastructure? It's really simple. Like, first and foremost, the revenues for infrastructure assets are in local currency. So for the bankers in the room, you know that if you have revenues in local currency, you should be funding in local. The most obvious example to think about is Kenya Power. So all of us, when we get our bill at the end of the month, there's that FX adjustment. And sadly, it's because we still have a large element of PPAs and dollar funding within KPLC that one day we should probably try and address. Now, even if you as a project sponsor have the right or the ability to pass on that FX movement to your clients the way KPLC does, at some point it can make a project fail, particularly if the movement is very severe. And we saw that in Ghana. So we worked with a business in Ghana that was looking for some funding. I think it was back in 2014. And it was like an oil tanker business, and they needed to expand their business. So they had gone to Standard Chartered. Standard Chartered came to us to get a guarantee. Part of the funding was in local currency, part of it was in dollar funding. So they split their funding. A year later, I think the cedi, the Ghanaian cedi, depreciated by 50%. And the customer was back asking to refinance in local currency because his revenues were in local currency. I think also finally the most important thing is that actually there's a lot of money locally, there's a lot of shillings. Rather than us trying to put pressure on those foreign exchange reserves at the central bank, we should be trying to recycle the savings within a market. Okay, so anyway, enough of that economics lesson. We have a track record, just to give you some comfort. So it's not that we started the other day. So since 2005, we worked on quite a number of transactions. We've had quite a number of landmark transactions, the most recent of which, of course, would be Acorn, which we managed to list not only locally, but on the London Stock Exchange. We're very delighted about that transaction, but we'd love to see a second. So we look forward to working with KEPFIC on the next transaction. We also realize that, as Gatia said in the morning, infrastructure transactions tend to be very large, and our maximum guarantee is about $50 million or 5 billion shillings. So we've built relationships with other co-guarantors. So if some of these transactions, and they will come a time when a lot of these transactions are too large for us, we can and do work with other guarantors in the market, like ATI, like AFDB, like Afrexim. So I think I just wanted to put that there as a placeholder to let you know that we have the ability to scale the guarantees that we provide. But most important for us as a development finance institution is the development impact that our transactions provide. We've worked in over 55 transactions in 22 countries, and I think we've got data to support this. We've supported infrastructure that's made lives for 43 million people better. And that is at the heart of what we believe in and what we do and what drives us. So let me move to the second section of the presentation, which just talks about infrastructure as an asset class. It builds on what Gatia took you through in the morning in terms of some of pension funds. This is interesting. And then I'll hand over to Sam to talk about the more interesting bit of this presentation, which is the real opportunities coming up. So the way GuarantCo looks at infrastructure, there's a wide spectrum of different types of infrastructure. We typically talk about core infrastructure. So power, water, and transport is what we would consider core infrastructure, but there's also other types of infrastructure that we can look at. Obviously digital comms, so telecom towers or phone companies, but also social infrastructure, so affordable housing, which I know is a buzzword in Kenya at the moment, hospitals and schools, which have become very important and will really need a lot of capital expenditure, particularly with COVID and the need to sort of resize classrooms and schools. So we look forward to looking at these kind of opportunities with KEPFIC. What are the characteristics of infrastructure? And I think this was sort of what Gatia talked a lot about this morning. First and foremost, infrastructure is an essential service. It's something that benefits the entire population. It's not something that's just for a particular class of people. So if you think about one of the transactions we'll talk about a little bit later, the Nairobi-Nakuru Mau Summit Road, all of us will be on that road at some point, right? So it's an essential service. There's a high volume and a large customer base. It also typically requires a significant capital requirement, right? So when we're talking infrastructure, we're talking billions. And a lot of times when I go to social functions, I get a bit shy because, everyone's very excited to tell me about a 100 million shilling opportunity. But actually, when you're talking infrastructure, we're talking in billions, not in millions, because that's just the nature of the beast. And as Edward talked about the 37 permits, there's typically quite a lot of planning and approval requirements. So you need to spend a lot of time developing an infrastructure project. It's not something you wake up and do the next day. The third characteristic about infrastructure, I guess, I talk about the predictable cash flows. So whether you achieve that through what we call a concession agreement. So typically what you have in the infrastructure space, you'll have the government sign an agreement with a private party for that private party to take over a piece of infrastructure for 30 years, right? And during that 30 years, there'll be a very stable, predictable cash flow as long as the private operator keeps their end of the bargain, i.e. builds the infrastructure and maintains it. So it's very stable cash flows, very predictable cash flows. It's not like, say, the supermarket business, which, today there's COVID, people don't have as much money in their pockets. You'll find the queues in Carrefour are shorter. It's not the same thing. There's a lot more predictable cash flow. I guess the final thing, of course, is just given the demographic dividend we have in this part of the world, given the need or where we are in terms of the infrastructure gap, it's also an area of high growth, right? So what does that mean to you guys as investors? It means that you're going to be able to benefit from sustainable returns and relatively low volatility, as Gatia mentioned this morning. But also, it's a nice way to diversify your portfolio, right? Because of that low correlation with other assets. Plus, most importantly, I would think, because your pension funds and you're managing money for over a period of 30 years, some of the money you're taking out today is for that you're collecting today is for contributors who will need to get their payout in 15, 20 years. So it's really important to try and get that asset liability match, essentially. And that's what infrastructure provides in terms of an opportunity. We also talked about this funding gap. So I think I heard it was 2.1 billion in Kenya, but that's the reality. Government can't pay for everything, right? We'd love them to, but the only way government can pay for things is by taxing us more, right? So, every year when the government is reading its budget, it'll have certain sources of funds, but it can only borrow so much. And I really don't want to go into the topic of how much government has borrowed or should borrow. But I think the point I'm trying to make here is that private sector participation in infrastructure is really important if we're going to grow this country. And we all have a stake in this country. So that's why I guess, we really need to think about what are the funding models in infrastructure that private sector can play a part in, and therefore you guys can play a part in. And so I'd like to talk about three ways that this happens, or at least frame the way you could participate in infrastructure projects, in PPP projects particularly. We have one model which we call user pay. So essentially the users of the infrastructure would be paying for that infrastructure as they use it. So think about a hospital. If you used your pension fund money to build a hospital, as the patients came in to get their services, they would pay, and that money would be the revenue stream as investors that should take to recoup your investment and to earn a return. Another way that is used in the PPP space is shadow payments. This is where you have, say, a toll fund, and it'll collect tolls, but in the event that there's not enough, government can top up. But at least there's comfort that the infrastructure is being built in line with a particular need. And government will pay the operator based on how many people are using that road. And then the third model is what we call the annuity model. And it is essentially where you've got a private operator receiving this fixed amount of money every year for designing, constructing, and operating a particular piece of infrastructure. And we have that as a live example as well that we'll talk about in a short while. So very quickly, we can jump into transactions. So of course, I talked about the Acorn transaction as one of the ones that we're incredibly proud of. I know they're in the market in January for a top-up. I'm sure you can speak to Koi about opportunities to be a part of that. But now, without much further ado, we'll talk about an example of where we're using the shadow payment method to put together an infrastructure project. And I'll hand over to my colleague Sam, who can take you through the details of the Nairobi-Nakuru Summit Road.
Thank you, Janice. Good afternoon, everybody. As I said, my name is Samuel Chasia, and I'm an investment director at GuarantCo. We're very, very proud to be with you here today because this infrastructure journey is what we talk about and think about day in and day out. And I think over the last 3 years or so that I've been at GuarantCo, trying to really get us to focus on what it is that, how we can get the private sector involved in infrastructure has kind of been our goal. And so we are very, very happy to see that we're getting traction, obviously, with the developments of where we can, investors like yourselves and your fund managers can now get involved in investing in infrastructure. And it's important, and because, we talk about why it's important to invest in, infrastructure is known, what we need to do with it, social, co-infrastructure, or everything that kind of makes infrastructure. But really what makes it a possibility or not is the financing part of that equation. And I know that, we talk about politics, about how it's important for us to develop, but if we do not find ways in which we can actually finance these projects, it's going to be a pipe dream for the next generation, and we'll be talking about the same things. And so this development for us as GuarantCo, and I think for all of us as a country, I'm obviously a Kenyan here, thinking about what we can actually do for our country is actually really, really encouraging. And so, as Janice kind of pointed out, we've actually been involved in a couple of transactions, locally. Obviously, Acorn was one of our success stories here, and we are continuing to see kind of reap the benefits of that and getting investors to get involved in this infrastructure class. Right now, we're actually involved in a couple of transactions, and I'll talk about one. I think Janice will talk about the other one in the road sector. And as she mentioned, we're talking about using what we call this the shadow payments framework in getting this done. And why this is important, again, the project here is called the Nairobi-Nakuru Summit Road. Well, we actually, I think for most of us who came from Nairobi, we actually use this road on our way over here. We've seen all this construction coming in. The road itself is key. And again, I don't need to explain to you what the benefits of actually having a road network here that is actually that is well developed is how it impacts and develops the economy. But one of the things that we need to kind of really highlight here is our road network here is about 170,000 kilometers in Kenya. And unlike other countries in the West or developed countries, our road network is actually 93% of all our freight traffic actually goes through the road network. So apart from us, being regionally kind of as a trading hub and all that, the road network is actually key and a main artery kind of development. And so obviously, and quite pointedly, the government actually has devoted a lot of time, effort, and actually resources to actually develop this sector. But as you can imagine, the numbers we're talking about are a lot more than for instance, the requirements are a lot more than actually the government itself can fund. And so what the government has done here is to basically go through a PPP model and use the toll fund to basically fund, make funds available which the private sector can now attach to kind of get these particular roads financed. And so in this particular situation, go to the next slide here. I know there was a lot of discussion. Can we go to the next slide? Yep. There was a lot of discussion here about, President Uhuru's trip to France. And unfortunately, a lot of the press that came out of it is actually not correct. I think what came out of it is not that Uhuru went to get actually debt in France. What we're talking about here is actually a privately funded road for the most part. We're talking about a $1.6 billion road. It's going to be 175 kilometers, basically from Mironi all the way to Mao Summit, which is just outside Nakuru. And then also an upgrading of that 58 kilometers from Mironi to Naivasha through Mai Mahiu. So that's quite what the project scope is. And again, kind of dueling it. And it's a $1.6 billion project, right? So think about that in terms of what the financing needs will be required if we're trying to put this on the government balance sheet, right? We already know that we're already quite highly indebted. And so what we are now doing here, talking about what GuarantCo will get involved in, is trying to get the private sector involved in this particular project. And so why there was a big hullabaloo when President Uhuru went to Paris was to basically, because the sponsors of this particular deal are two French entities. One of them is a developer, an EPC contractor for roads, and the other one is actually a private equity fund. And the two of them actually are the ones who are the owners of the SPV itself that's actually going to develop the project. And they'll provide about $300 million worth of equity for this particular project. Now, I think $1.2 billion worth of debt is what is actually going to be provided by the private sector, right? And that's what I'm saying here. What was misunderstood here is this is actually a private project by private investors who happen to be France, but there's going to be a lot of funding that's coming from different parties to actually make this available. And again, what GuarantCo has been involved here to do is to try and catalyze part of that financing package to allow kind of local entities to be able to participate. Let's go to the next slide. Now, if you look at the financing structure, like I said, and these are, it's a private project, has a lot of different players. And again, when I've had these discussions with fund managers in the past, they always complain that, look, we never get the opportunity to be able to participate in these transactions. One of the reasons why was obviously we're talking about pretty big numbers over here. The second reason was a lot of these projects are actually funded in US dollars, which is something that many local pension funds cannot actually do in any kind of size. And so what and then the third also was actually just having a legal framework to allow that investment. And I think on at least the last part of that has actually been taken care of through the allowance of this 10% as part of the investment criteria. So that's a good development. The second part, obviously, of that now is to basically make sure that as part of these projects, yes, it's a $1.2 billion worth of debt, but we have insisted here, and what GuarantCo has been involved in here is to try, as part of that financing package on the debt side particularly, is to make sure that we have local currency as one of the, local currency as one of the currencies that are going to be used to actually to lend into this project. And so what I highlighted there is out of all the different classes of funding, some from DSIs, some from ECA kind of lending backed by the French government and other international commercial banks, we actually carved out a local currency tranche to make sure that we can actually make that available to institutional investors. And this particular transaction, we're talking about $50 million in Kenya shilling equivalent that's going to be fully supported and guaranteed by GuarantCo. And again, the idea here is to make sure that we can actually crowd in the local pension, the local investors into this particular transaction, just because, again, we need to actually get investors kind of comfortable with these type of structures. They're very complex. We need to build capacity to do that. And the only way, quite honestly, to learn how to invest in these projects is to get involved in them. And so our job here is to kind of catalyze that involvement, at least initially on a fully guaranteed basis. And hopefully over time, as we get more of these transactions, we'll actually, allow, the local investors to, as they build kind of confidence and expertise in this, looking at these particular structures, to be able to invest without our guarantees. So just highlighting on this, the last slide here, just highlighting kind of how we've done this. And so, the slide before this. One of the things that, again, as we're talking to international sponsors, and again, this is some of the challenges they say that when they're trying to invest in, trying to kind of bring in local capital into these transactions, the first question they've asked is, okay, do we actually have the ability in terms of capability to actually put this kind of funds to bear, right? Talking about $1.2 billion. Now, obviously, we cannot put $1.2 billion, but what we've said is, look, there's a lot of capital available locally to actually do this. So we need to be able to think about how we can actually bring it into these transactions. And so this is one way we said, look, at least it doesn't have to be the full package, but again, allow some of that financing to come in local currency. And again, what we've done also in terms of dealing with the government in terms of how they negotiate the contracts, with the project SPVs and the sponsors, to allow and incentivize investors to actually look at local currency by, for example, giving a little bit more credit for people who actually go ahead and actually put local currency into it. The second question they asked actually is, look, the cost is high, obviously, and I think Edward talked about this. Some of the return requirements are quite high because of just kind of the state of local government borrowing. And so that is actually a reality, and we have to deal with it. But what we've said to them is, look, the one thing that we can do, obviously, is if we are able to actually bring tenor into these particular transactions, meaning if we can get into 15, 20-year, 25-year type of financing, in the long run, that actually ends up helping these transactions, because what everybody talks about the cost nominally of these financing in local currency, while it might seem like it's more expensive to begin with, but it's a known and fixed rate for the duration of it, right? So while hard currency financing might look like it's attractive to begin with, obviously as we, this is a 30-year concession. In 30 years, right, if you look at kind of how the trends that have been over the last 30 years, the shilling has been depreciating. So that particular cost might look affordable now, but ultimately that cost has to be passed on to somebody. And usually it's passed on to the consumers of this infrastructure in terms of higher rates or increasing rates over time. So what we've actually said to them is, okay, fine, if you can get long-term local currency financing, you'll be able to actually achieve the goals both of the sponsors in terms of having a knowable kind of cost of financing, but at the same time also, I think in the long run, lower the ultimate cost of that infrastructure over time. So what we've done over here is we've created a structure which allows local currency funding on a long tenor, we're talking about 25 years, to be actually brought to bear. And that allows the sponsors actually are very happy with that arrangement, because it made the local currency financing part of that package competitive with some of the nominally lower hard currency financing rates that are available in the market. So again, these are things that, again, in terms of making some of these long-term financing solutions available, this is what GuarantCo actually has been able to do in this particular case. And again, what we are, again, as this is being developed here over the next 12 or so months, we are expecting the ranges of this transaction to be coming to some of your fund managers, or ultimately to you, to kind of seek their involvement in this transaction. So I think that is that I'll talk about, and I'll let Janice finish the last part of it.
Thank you, Sam. Thank you, Sam. And so the last section of the presentation, as I said, under the privately financed model, there's a different ways you can approach infrastructure. And so we've got the sort of shadow payment toll road process that Nairobi Nakuru has, but there's also something called the road annuity model. And I just thought it would be worth speaking a little bit about it. They're actually live transactions that I think your fund managers, if they haven't been spoken to, will be spoken to very soon, as Standard Bank Securities is working on the information memorandum for those, and potentially, perhaps, maybe they should now approach Ngatia. I don't know, but we'll talk about that over lunch. But let me just take a little bit of time to talk about the road annuity model, and then I'll quickly wrap up so that we can take maybe a few questions before lunch. So the road annuity model is a bit different from your typical PPP. The idea behind it is that you've got the 3 shillings of every liter of fuel that's collected that goes into a pot that can be used to finance roads. Now, the roads that are going to be financed by this annuity road fund are the rural roads, are the roads where you can't really justify that there are very many users, right? So we're talking about the roads mashinani, as we say. And so this was a model that was rolled out in 2015. I think to date, there's been 1 road. It's almost complete, or I think it's complete. It's the senior road that's been completed, but now we've got about 3 lots that are in the market. As GuarantCo, we're involved in 1, so I'm obviously plugging that in. But as I said, Standard Bank are in the room. I don't know, Greg, whether you want to stand up. That's the man to see if you're really interested in taking it forward, but I'm sure he'll be looking for Mr. Ngatia after this. So what's the project structure? Essentially, just like any other PPP, you have a project company that's created, a special purpose vehicle. That special purpose vehicle will hire an EPC contractor, will hire an O&M, an operation and management contractor, if you like, who will manage the road. The roads were being given out for a concession, a contract period of 10 years. And during this annuity payment, that annuity payment will be used to pay for the costs, obviously, of building the road, but also to pay for the debt and to provide an equity return. I think, as was pointed out earlier, just to be clear, what we support as GuarantCo is the debt side, because we provide a guarantee. We can only guarantee, something that's contractually promised. Hence, we support debt. So what we're supporting in the annuity model is the debt in these projects, right? So you have senior lenders, you have junior lenders, and in some cases, we'll also support the junior lenders in this particular structure. But just remember at the back of your head that the money that the project company receives is from this road annuity fund that's continuously collecting 3 shillings from every single liter of fuel that is sold in this country. So that should give you some comfort. Now, to make sure that the road is actually built and that there are no disputes, you'll find that there's something called an independent engineer. So the independent engineer periodically will visit the road that's being constructed, will make sure that it's to the standard that's required. It will refer to the requirements that KENHA, who are the contracting authority, the sort of standards that KENHA has stipulated for the road design are being met. And that's how you make sure that you actually get a good quality road. And the idea behind this at the end of the day is that, as most of us read in school, it's always easier to do something in the private sector than in the public sector. So by bringing in a private sector contractor who can do something faster at a cheaper cost, then we can get some of our roads built. Not to mention the fact that we said at the beginning, the idea is really to try and reduce the amount of debt on government's balance sheet. So this is a completely off-balance sheet structure. Although I should point out that to make sure that government keeps to its word and keeps the road annuity fund in place, they provide us with something called a letter of support. That letter of support is basically government's way of saying, we will not walk away from this project. We realize that it is an important strategic project. It's not a guarantee, but it's the way that government can give investors like yourselves reassurance that they stand behind some of these projects. So yeah, I think that was pretty much it in terms of the Road Annuity Fund. We don't have a lot of time between us and lunch. So I think what I'd like to do right now is just conclude by saying three things. Just remind everybody about our role. So we're here to provide you with a guarantee, that credit enhancement. We see quite a lot of opportunities, so we look forward to working with you on these. And we've taken note of the due diligence, the process that KEPFIC will be running on your behalf, so we look forward to working with them. So on that note, I think we can open up for questions. Yeah? Sorry, go ahead. I think the lady was first. So my name is Joan from Kengen, I remember.
Great, this one works. So thank you for your presentation. Actually, for me, when the whole discussion on pension funds, supporting government infrastructure projects, the biggest elephant in the room for me was guarantees. And I like the fact that you stepped up to actually take on that position. So my question is with regard to how we rank, and especially in that slide that had, the local Kenya shilling component, then there was World Bank. How do we rank with regard to, are we a senior lender, are we a junior lender?
Sure.
Then also I'd like to know with regard to, of course, the Kenya shilling interest rate is really high. So if we were to give, lending, it would be probably in the range of any other commercial bank, So with regard to looking at the feasibility of the project, I know he sort of talked about it, but I'm just wondering, will we be lending for 25 years? Because 1 to 7 years is really good, because then you're able to, sort of shorten your time in the project and be able to then exit. So I'm wondering about how the, whole IRR of the project would look like with, the Kenya shilling component. Would it make it, more unfeasible? Because here you're looking at World Bank that's probably giving concessionary lending, and us who are there in the market giving Kenya shilling lending at probably 12, 10%. So how would that look like? Then also, with regard to your catalytic role, are you offering any assistance to the PPP unit with regard to moving forward the unsolicited proposals? Because when you look at all the 77 or so projects under the PPP Act, most of those projects have been there since 2013 when the Act was actually put in place. So are you giving any assistance or any trajectory to the unsolicited proposal space?
Thank you, Joanne. As usual, excellent questions. I'll start with the first. So you talked about where you rank, because there are so many lenders for the Nairobi-Nakuru project, and it's a very good question. So all those lenders you saw there are what we call senior lenders. So you all rank pari passu. You're all at the same level. And this is really important, because it basically means that if 100 shillings comes into the project and you're owed 50, all of you will only get 50 cents each, because you're pari passu, you're all senior lenders for that transaction. The second point you raised was around interest rates, and it's a very good question. And it's something that makes my job very hard, if I'm honest, Joanne, because you're right, nominal interest rates are high, right? They're double digit. There's no going away from that. But when you think about the real interest rate, i.e. you take away inflation, then it doesn't compare too badly to, say, dollar funding, right? So dollar funding from a commercial bank would be maybe LIBOR plus 4%, but it's floating, so by the time you have swapped it and fixed it, it's LIBOR. It's about 7% fixed, right? But inflation in dollar terms, I think Atya talked about 1%. I don't know. He's a clever man in the room. He can tell us. So, your real rate is about 6%. Now, in Kenya, inflation is anything between well, it depends what numbers you believe, but say 6%, and then your T-bond for government paper, 11, 12%, I can't remember. You deduct that, and actually it's comparable to a dollar interest rate. But it is something that we find is a challenge when we're trying to encourage people to take local currency, because they forget that there's something called the real rate, and they also forget that the shilling today is at 109. Last year, the shilling was at 100 or 103. Now that differential between 103 and 109, you have to pay as additional cash if you borrow in dollars. If you borrow in shillings, you don't, right? And that is something that people always forget. But it is also the reason why you saw 25 years. So at the very beginning, when we went to the sponsors to try and convince them to take a financing package in local currency for Nairobi, Nakuru, they said no. They said, why? Look at the interest rate, it will mess my IRR, like you very rightly said. The only way the shilling tranche makes sense is that if you spread it over a period of 25 years, then the amount that you pay every year is reduced, right? So think about borrowing 100 shillings over 5 years versus borrowing 100 shillings over 10 years, right? The amount you pay every year is a lot less, so there's less deduction from the project. The IRRs are actually, in fact, probably improved. That was the case for Nairobi, Nakuru. That's why we went for 25 years. Now, 25 years is 5 years short of the concession period. It's a 30-year concession. They have a contract for 30 years. For 30 years, they'll be receiving money for the road, right? So you've got what we call a tail period in case anything goes wrong, a 5-year tail period. But you're right, that is the challenge of local currency. So thank you for those questions.
I think just kind of adding on that issue, and it's something that we kind of grapple with a lot in infrastructure. And quite honestly, one of the sad things that have happened in infrastructure financing is that, whether it's international lenders or international partners who we obviously we rely on a lot of the for a lot of some of this financing, if we cannot find a way to fund these projects in local currency, right? We will continue having this infrastructure shortfall, because the underlying problem is a simple one, right? So long as the revenues of these projects are going to be in local currency, so if we keep relying on so-called cheap funding, it's not cheap. It's just there's a cost there that is not being acknowledged in the beginning, but ultimately has to be paid. And so, and just as an example, one of the things that's happened in Ghana, for example, in the energy sector, and this has been in the news, a lot of these energy projects were financed in hard currency. And what has happened is, yes, what people have realized is the cost implications of those projects, which looked cheap. And I think Janice talked about the experience in the examples we have in Ghana. In companies that we know, this cheap funding is not cheap. It's only cheap if your currency is stable. And by definition, just given the differential in terms of our inflation expectations, we are growing economy, young population. Inflation is going to run higher than in a developed country. So the current by economic laws, the currency should depreciate over time. That's a real cost. And so I think part of what our goal here is to try, again, tap in, and this is the importance of about 25 years is that issue. The 25-year money or the 15, 20-year money lies within this group, right? If we rely on the banks, they cannot do it, because 7 years, 5 years is not enough to do a 30-year concession. So that is the challenge. We are obviously trying to find innovative ways to actually make it, to bridge that gap. But I guess what we need to begin doing, number one, is let's get rid of this notion that we don't have the capability to do these projects, because that's another thing that we always hear, is, well, wait a minute, okay, even if, Nairobi Nakuru was, we offered, for it to be funded locally, they'll say, well, there's no local capacity to actually do that. And what I say, there actually is capacity, right? We just need to basically allow, create avenues for that capacity to be tapped, train, build capacity in terms of human resource to actually analyze these projects. And again, just the more we do of these projects, the more they'll become cheap. And I think that's kind of what the challenge is over here. So, so I think on the cost issue, and that's something we spent a lot of time in, it is actually part of the package, as you can see, so we convinced them. So these projects can be done. The second thing, and I think you had a question about the other associated PPPs. As GuarantCo, we are, we are agnostic in terms of, we are trying to bring private sector investment in any project in infrastructure. So whether it's unsolicited, whether it's a government PPP, wherever it comes from, our job is to try and actually get in there and get that project up and running. And so what our mantra is internally is to basically find solutions. We are a guarantee company, but we try and get solutions to some of these problems. And that's why we spent quite a bit of time, both in Kenya, in other jurisdictions that we participate in, coming up with kind of unique solutions to some of these problems, because they're all similar problems in different areas, and we can actually learn from that. So I think that's it. Yeah.
Okay, any other, one more question, just one?
Thanks, sorry, I missed a lot of the presentation, my apologies, but isn't that the whole point? I mean, just following on from your response to the last question, that isn't that what pension funds can bring, which is the local currency and the longer maturity? But let me ask, so what sort of premium would we expect for doing that, right? Because currently you go to banks who would finance you for 7 years, 10 years max, or you would get these concessional loans, and we understand the challenges of those. So if local pension funds were to come to the table, how would you engage them, number one? And number two, what sort of premium would we expect? And I think, Katia, the other thing important for us is what sort of special purpose vehicle, or how does it work? Maybe it'll be good for the trustees to understand that, right? But also the premium is important,
So I think I'll say this. Look, these are, like I said, we're a catalyst, and we work with arrangers and different kind of financial players to do that. I think how I answer that question, because it's very pertinent, is look, depending on what our involvement is, okay? If we are fully financing, fully guaranteeing, it's one discussion. If we are partially guaranteeing, it's a different discussion. So I can't say whatever the premium is going to be. But the point here is our goal is to basically at least give, in that kind of risk-return balance, our job is we want investors, and the pension fund investors in particular, to dip their toes in first. We need to get people interested in this particular transaction. And that's, like I said, we're talking about a $1.5 billion project, for example, in Nairobi, Nakuru. 50 million is a small amount, but it's important because, number one, it brings in the people who are actually fully vested in more than anybody else. And trust me, when I do these projects, and I think there was a question about the PPPs, I think it was about 46 or 76 of them that are still there, that are still not being financed. Again, this is my kind of personal view on this. Part of the reason why we struggle with these, and again, the PPP framework is what it is, right? If we are designing a PPP framework that is targeted at getting international investors to invest in Kenya, projects will take 5 and 10 years, in my view. If we basically, as our local investment community, mobilizing the full amount of the resources we have available to us, which are significant, it's not a small amount, the trillions of shillings that are available to invest. If we can make those to bear, those projects will get it done in 1 or 2 years. Because, let me give you an example. If I came and told you, okay, what is the feasibility of Nairobi Nakuru in terms of tolls and the ability for this, none of us here has to go get a specialist from another country to come and tell you how feasible that road is. We know, right? How important that road is to our economic life. It's a core artery in terms of regional trade. But these are things that we know because we are local. But if we need to wait from international fund to come and tell us how feasible that road is, it'll take him 2 or 3 years to do it. So part of that challenge is that, yes, we need to basically get local investors involved and invested, understand these structures, feel comfortable in taking some of those risks. If we can come in and actually, initiate that process by giving you a full guarantee initially, a small amount albeit, and again, we can now negotiate what that premium is going to be. And again, the point here is to make it worthwhile, because obviously the returns need to be made. But yeah, if the second and third, and we've seen this in other projects, the second, third, fourth project could be 75, 50, hopefully at some point, no requirement for a guarantee. Once we get there, those problems will take care of themselves in terms of we don't have to look outside to fund some of these smaller projects. We're talking about roads, here where there's power plants, all these things. These are things that we can actually fully finance and fund internally if we have the infrastructure, in place, and more importantly, the appetite and the kind of confidence of the local investment community to actually play in some of these transactions.
I want to say two things about the premium. I'm not going to give you a specific number because I suspect I'd get into trouble with CMA. But I can tell you two things, that it will be market-based and it will be pricing for risk, right? So we will make sure that whatever your price, the price that you get is in line with whatever you'd be getting in the market, and that if we're giving you a 100% guarantee and it's rated higher than government, then it should be in line with that risk that you are actually assuming. Yeah? Not to be too cagey. Now, you asked another question, which is how, right? How do we make this happen? And I'm really excited you're asking this question. Now, traditionally, what happens is that we would go to the arrangers, and the arrangers would circulate an information memorandum around the with the different fund managers, and then the fund managers would diligence the transaction, and then they would present it to the various trustees, right? And I think that process is still there, it's alive, it's well. And in fact, for the annuity lots, because there's a live transaction, that's actually what's happening. It's work in progress. Standard Bank are actually talking to fund managers, and I guess once they're comfortable, they will approach the trustees. But what I heard this morning, and please correct me if I'm wrong, now we have KEPFIC, so we have the ability to come directly to KEPFIC, which is important for us because it helps us as we create the solution for the problems in financing this infrastructure to work out what you as trustees are comfortable with, what you want to see in these projects to get comfortable. I hope I've answered the question now.
Discussions are being held. If the financiers of projects or the sponsors of projects are aware that there is local pension capital available, they will also be able to look at their bidding accordingly. So even as they're bidding for those projects, they should be thinking about engaging the pension fund community. And KEPFIC would be the perfect place to do that because...
Absolutely. And Sandeep, here's a problem. We know there's $1.3 trillion of assets under management. We just don't know how to tap into it. So we're very happy that there's KEPFIC.
Okay. Thank you, Madam, for a very good presentation and also smiling a lot to us. I'm happy. The question I have is just following on Sandeep's, is the instrument you are going to use because you have sort of equated it to the government bonds paper, which we are capable of trading it in the secondary market. Yes. So we can do the same? Is it possible to? So
tradability.
Urgent liquidity.
Yeah, no. So tradability really comes, I think, from the instrument, and I think the easiest way to make an instrument tradable is to list it, right? So I have to be honest, on the annuity transactions, we're not thinking of listing. They're going to be private placements, so there might not be liquidity in those, but those are 7-year opportunities. But potentially, it could be something that we could think about for Nairobi Nakuru, and that's why I guess we'll spend time with Gatia. We're still deciding on the final structuring of that, and so we'll work out what it is that you need to see to get more comfortable. No, absolutely, 100%.
Thank you very much, Janice and Sam, for your great presentation. You can see it was great from the interaction that the audience are having with you. So thank you. Now, we are going to break for lunch. Energy levels are getting lower. We will have 1 hour, 20 minutes. Please don't make me come to the restaurant ringing bells again, because if I have to, I will, because we have great presentations coming, panel discussions, very exciting discussions. So let's have our lunch for 1 hour and 20 minutes, come back, and then we continue. Now, we're going to have lunch from the same restaurant where we had our breakfast, and you are picking a voucher from the registration desk as you walk out. Please do not forget to pick the voucher, because without the voucher, you won't have lunch. And I really want you to come back when you are full. Thank you, ladies and gentlemen. Thank you very much. Now, as I have said, I really hope you have enjoyed your lunch. We hope you have. We're going to have the first presentation is from one of key partners of KEPFIC, MiDA Advisors. We have on the call Emerick Saha, who is the partner and CEO of MiDA Advisors. MiDA Advisors is an advisory firm specializing in facilitating institutional investments and trade between the United States and Africa. They do this in partnership with USAID. So at this juncture, ladies and gentlemen, help me welcome Mr. Emerick Saha, who is going to talk to us about MiDA Advisors.
Thank you very much, and I hope that you've enjoyed your lunch. I am joining you from Washington, D.C. I hope you can hear me clearly.
Very clear.
Thank you so much. Good to know that technology is working today. We are just getting started here. It's early morning, so we had our coffee, not lunch yet, and I have been able to communicate, and Gacha and Brian have told me that you've been having a very productive session this morning and today. So I am pleased to join you to make the case for co-investments, how we can, support co-investments between KEPFIC members and U.S. pension funds. Before I do that, let me maybe first talk a bit about MiDA Advisors. I understand that some of you do not know us. I have been to Kenya many times, and fortunately, events like this, I will typically be there with you. I am joining virtually, but I look forward to meeting some of you when I'm back in Nairobi, hopefully soon. MiDA Advisors, we were founded in late 2016. We started as an initiative of the U.S. Agency for International Development, started at the second U.S.-Africa Summit, which was really focused on how do we get the private sector, investors, American investors, African investors working more closely together. And MiDA's history has always been about infrastructure. It's defined in our name. It was our mission from the very beginning. And our mission was to get American asset owners, pension funds, foundations, and endowments to look into investing more closely in Africa's infrastructure. Why? Because we knew that investing in infrastructure gives you the highest development impact. And obviously, being funded by USAID, having impact, mutually beneficial impact, is a key priority of MiDA today. US investors are able to diversify into African markets. They are able to diversify into a region where they have low correlation to today. And they are able to work with African asset owners to invest in infrastructure, which creates jobs and economic impact in the region. So that is our mission from the very beginning. Today, MiDA has now evolved into the USAID Invest Project, which is a wide investment facility that allows us to have more resources to further connect with African pension funds and seek co-investments. I'm sure you've heard about Prosper Africa. You've certainly heard about Power Africa. These are various initiatives that are focused on investing more in Africa. And we are also working with another mechanism called USAID Invest. We're pleased to partner with KEPFIC and the Kenyan Investment Mechanism to support co-investments with KEPFIC. As I said on Wednesday, we want to extend again our congratulations to the steering committee of KEPFIC, to the Secretariat, for allowing us to make it to this level where you now have a legal entity that is ready to co-invest and do business with others that are seeking to invest in Kenya. Let me make the case of why we need to co-invest. First, it's been discussed throughout this conference that investing in infrastructure is critical. It's critical for boosting trade, critical for boosting economic development. Studies have shown that you can boost economic development by up to 1 to 2% faster growth rate if you invest further in infrastructure. Trade can be a lot more productive by up to 40% if we have better infrastructure. But we also know that investing in infrastructure is a complex asset class, and you need a lot of capital. We know that Africa today, Kenya today, has low savings rates. I mean, start with the basics. You have a very young population. A lot of them are starting to enter into the workforce for the first time compared to other regions. So you know that in Africa, the savings rate, which you would say is around 15 to 20%, depending on the countries you talk about, some countries as low as 10%, compared to other developing countries in Asia and Latin America, where it's around 40%, you have very low savings rate. And it's growing fast, and it's great to see that the industry, the pension funds industry, is growing very fast, rapidly, much more faster than other markets, but you're starting from a very low base. Therefore, it's important just in terms of capacity to work with other international investors, because Kenya needs a lot of infrastructure and it needs it now. The second reason why we want to partner is around ensuring that the investments are sustainable. And therefore, it's very important that we start having some infrastructure assets being invested in local currency, side by side with local pension funds, Kenyan pension funds, investing with international pension funds. That is very important. And today we know that in Africa, it is a problem when most of the infrastructure is invested only in hard currency. KEPFIC is a model that allows Kenyan asset owners mobilize local savings into local infrastructure and start making those investments more sustainable. And we're very much supportive of that self-reliance model, and it's something that we're starting to see being replicated on the rest of the continent. I'll give you one example. When in this city where I'm talking to you from, Washington, D.C., the water treatment are funded by 100-year bonds, which means that the tariffs can be much lower because you have a more sustainable financing structure. In Africa, a lot of the same infrastructure assets are funded with much shorter financing structures and models. And that has a direct implication, of course, on the consumers that have to essentially pay for the asset class within a much shorter period of time. So part of the work we're doing with KEPFIC is also ensuring that how can we find financing solutions that are more sustainable for the asset class and for consumers in Africa. Now, let me talk to you about how we can potentially do that. How can we work together? How can we have Kenyan pension funds co-investing with American pension funds? What have we learned? What have we observed? MiDA, as I said, started back in 2016. We have seen our members investing in infrastructure in Africa and other regions. What lessons can we take from that? What tools have they used? And how we've also seen some initial co-investments between US pension funds and Kenyan pension funds. So I will talk about that as well. The first, if we can move to the next slide, please. The first thing we did when MiDA was created was to establish an advisory council of American pension funds and asset owners. Here's a list of the institutions we've been working with. And it's important that we do that, just like, you now have a consortium in Kenya to work together, to get the education together, to seek opportunities together, and leverage each other's resources. We have, in some ways, done the same thing here. These pension funds have been working with us for the last 3 years. They have, are receiving education about the region. Yes, they are more familiar with investing in infrastructure and other alternatives, but they don't know Africa as much. They don't know Kenya as much. So it's important for us to work with them, to present them opportunities in Kenya, and to do so with counterparts that are from the region, so we can mutually have exchange of knowledge about not only infrastructure, but also how we can work together. Next slide, please. One of the things that are critical that we do is to also forge relationships. It's important that we get to know you and you get to know them. And critically, what we do is take them to Africa so that we can explore what is happening on the continent. We were in Senegal in 2018 to meet and explore opportunities there. We were in Kenya in 2019, and we partnered with KEPFIC back then to start exploring opportunities in the region. As I said on Wednesday, we were fortunate to have the ambassador with us then, and again this week, and we are working with the World Bank and others to see how we can co-invest together. But I think that's very important. We would have loved to be in Kenya in 2020 because we're already seeing some co-investments, and I will talk about that in the next slides. Now, let me now provide you with some updates about how those pension funds, the list that I've shared with you, how they've transacted over the last 3 years, and how some of those funds will be deployed on the continent and in Kenya as well. I'll start with Alameda County Employees Retirement System, which is in California, and they have invested. They've made 2 recent transactions. They've invested $30 million into a fund that is focused on real assets and natural resources. That fund is investing in many African countries, including in DRC, including in South Africa, including in Mali. And they are actually right now seeking additional investments, specifically in infrastructure in Africa. We've actually had trustees from this pension fund in Kenya with us in 2019. And they are very interested in furthering the conversation with KEPFIC to see co-investments in the asset class. They've also invested in another fund, $200 million. They've made that commitment. And that fund is an emerging market fund that will be investing as well in Africa, particularly in South Africa. But that's what the case with Alameda County Employees Retirement System. And as I said before, they're very keen to focus on infrastructure, and we think that they are a serious partner, a potential partner for KEPFIC for co-investments. The next example, again, another MiDA member pension fund, is a Chicago Public Teachers Pension Fund, and they invested $20 million recently. Though that investment is one of the smallest allocations they've ever made, and I think that it tells the story here because this is a pension fund that had never invested in Africa, had never really even been on the continent, and we worked with the chief investment officer and the chief executive officer to bring them to Kenya in 2019 to really explore what was happening in the region. And they have now made 2 allocations to 2 Africa-only managers that are investing in Africa and investing in Kenya as well. I will talk about this further later because it's also a co-investment story that we're pleased to highlight. The third example that I will highlight is Prudential, which is a brand that you are, I'm sure, quite familiar with. But the U.S. entity Prudential invested $180 million in West Africa recently. This was through a different vehicle. This was more of a joint venture where they partnered with a local entity and through a SPV or investing together in the region. So, and we see a lot of this when we're talking with insurance companies where they like to do much more direct investing. I know that Ken is coming after me and he's going to give another example of how they were able to invest in certain power assets in Kenya. But Prudential is one of the examples that we highlight because it's more of a direct partnership into an asset class or a SPV in a specific country in West Africa. And this amount here are sizable. The next example that I will cover is the Texas Teachers Retirement System. One of the largest pension funds in the United States, about $160 billion. And they invested $75 million into an emerging markets infrastructure fund. That is right now investing about 1/3 into infrastructure projects across the continent, including in Kenya. And we are likely to see some of those funds deployed specifically in your region as well. Two more examples, and I will summarize these examples for you after this. Two more examples is KC Family Programs. This is a foundation based in the United States. They have invested across multiple sectors in the region, including in Kenya. They have invested in commercial properties, they have invested in infrastructure, they've invested in private equity, private debt. They've invested over $50 million over the last 2 years. They are definitely seeking more on the continent, and they are very active. We will be working with them to see how we can co-invest with KEPFIC members. They are very strong on a partnership with local asset owners, and I will speak more about that in my presentation. The next example that I will share with you is the San Francisco Employees Retirement System. The president of this pension fund was with us in Kenya in 2019 when we were there, and they have allocated $100 million into an emerging markets power fund that will be investing across various countries in the region. Now, one of the things that we can learn from some of these asset owners in the United States is that they obviously are investing. First of all, they are much larger than KEPFIC members, and that's the given. They've been around for over 100 years. They have, U.S. capital markets is the largest in the world, and therefore the amounts are significant. They have a lot more people as well. So they tend to invest no less than 20 million and up to $200 million in one ticket, in one investment. And therefore they do that because they feel like it's more efficient as opposed to having hundreds of different investments you have to manage. They like to invest in significant size into funds that have the capacity to absorb and deploy those large investments. So that's one thing to note. Second, American asset owners are not investing by country. They're not investing by even a region. The way we look at it from this perspective is that you have domestic markets, of course, then you have other developed markets, and then you have emerging markets. And sometimes in emerging markets, some of them, not all, would have frontier markets where Africa would sit. But typically, Africa is sitting in the emerging market bucket. And therefore, those buckets are significant in size and capacity. They are right now underexposed to investments in Africa. And they are keen, not knowing the region as well compared to other regions, they are keen to have local, like-minded investors, like KEPFIC members, that can allow them to seize opportunities and co-investments with local partners on the ground. And that is fundamental to what we're trying to achieve. And although we have to work on the vehicles and how we can seek co-investments, and I will talk more about that, but nevertheless, what is most important is that the infrastructure is built, right? So whether or not you have direct investments into the asset directly, or you have some international partners investing into a different vehicle and local pension funds investing to a different vehicle, it might be investing through different currencies. Some international investors can only invest in their currencies. Kenyan pension funds, you naturally will be investing in local currency, or unless you're doing offshore investments. But so it might be different vehicles. And sometimes we may have to structure new vehicles. But the fundamental importance here is that ultimately the asset is built, and that we're able to mobilize investments, funds from local actors, Kenyan pension funds, and international partners. So that is critical to what we're trying to do. And how we do that is also by working with development partners. I'm glad to note that the World Bank has been there for a while. I know that we have a presentation from GuarantCo as well that provides credit enhancements. And I want to talk about that as well, because we're working as well very closely with the Development Finance, DFC Development Finance Corporation, which is the new USDFI. And we want to seek, in some ways, their credit support, which have a tremendous impact as it comes to accessing some funds from the United States. MiDA is already engaged in 2 of those transactions, with the transactions seeking DFC guarantees. One of them is in housing in West Africa, where we are mobilizing $250 million with the backing of a DFC guarantee that will be deployed in 8 countries in West Africa, and it will provide long-term financing in housing. I emphasize on the long term because we want to make the financing sustainable. So we're targeting 15-year to 20-year maturity financing into the region so that people can afford mortgages and the rates are lower. We are lowering the interest rates in the region as well so that you can afford your house. And you can do so by financing over a longer period of time. We're targeting rates below 4% by tapping into U.S. capital markets, where, as you know, 10-year Treasury today is around 70 basis points. So in some ways, it's for certain asset classes that is important to make it sustainable. Now, we are also working with local vehicles where we understand that the dynamics are different, and therefore but still we want to make sure that the financing is sustainable. So the DFC's guarantees can be for U.S. markets, but also for local markets. And therefore, we can also structure support with entities in Kenya with local markets and allow, again, foreign investors using their yield curve, which is different from local investors using your yield curves. I don't want to scare you that, you're going to be receiving low returns, much lower than what you're receiving now. But the point here that I want to emphasize is that, we have different financing markets and different tools, ultimately to make the investments profitable, but also sustainable. If we can move to the next slide. I briefly mentioned about co-investments, and I want to come back to this further as it relates to Chicago teachers. We were going to discuss this in Kenya this year if we were able to travel. But what we're seeing is that Chicago teachers investing into a vehicle that is investing in Kenya. We've now seen 3 Kenyan pension funds active in KEPFIC investing as well into the same vehicle. alongside with Chicago teachers. And recently, we've also seen the South Africa's Eskom pension fund also investing in the same vehicle. And this vehicle already has assets in Kenya, and they are active in the region. And this is the type of collaboration and partnership we want to create and do more of that, where, you know, when you have assets that need to be developed in Kenya, you're able to tap into various investors, because again, there is a capacity issue, and you want to make sure that you have as much financing options that you can have to build the infrastructure and support economic development. So this co-investment is one of our first as it relates to our work with KEPFIC, and we're definitely hoping that there'll be more. And we're keen to also work with other pension funds in Africa. In this case, we had South Africa, but we understand that there are others in the region that can also be co-investors. Next, please. I mentioned earlier that in some cases we may have to structure new vehicles, new solutions that are adapted to your needs. And we are having discussion with KEPFIC about how we do that. How are we able to, in some ways, pool investments from Kenyan pension funds that may want to start with smaller amounts, and we understand that. And in some ways, it may be inefficient to have too many different actors invested in the same asset, and therefore, in some ways, it's more efficient to pull them so that they can, you know, be co-investors into the asset. Now, it can be, again, applied by investing directly into a direct asset, or it can be indirect. It does not matter. But we have seen that for smaller asset owners that don't have the capacity to do larger amounts, that it's more efficient to pull them into an SPV that would then just invest into the asset or into the fund. So those are things and solutions that we will be exploring with KEPFIC. And those are the same solutions that we'll be exploring, I would say, outside of Kenya as well, because other pension funds across Africa are facing similar issues and similar needs. So we look forward to working with KEPFIC to see how we can do that with your pension funds. And lastly, I talked about this, but blended finance is a tool that I think is important here. When you have the likes of GuarantCo providing some of their products, you have the World Bank that is also providing, in some ways, some of their products and assistance. USAID, which is what we're already using in this case, can provide additional support, whether it's through grants or first loss or other tools that they have as a development agency. At the DFC, which is also providing guarantees that are very attractive for US investors. Whether it's investing directly into the asset, into the project, or it's investing indirectly through funds, whether it's structured finance, whether you have different levels of security and credit enhancement, or if it's flat structure where everybody's treated the same. Those are all different scenarios that can be adapted to the particular investments that are suitable to the pension funds. And as trustees, you know, and as fiduciaries of those assets, we trust that we will work with you to see what makes sense for you, what is most adapted to your needs and to your capacity and your comfort level. But there are some work we can do here within blended finance to ensure that we can co-invest and we can mobilize KEPFIC members and others that want to partner with you to invest in infrastructure in the region. Next, please. Lastly, let me thank you for listening to me this afternoon right after lunch. I know it's not easy coming right after lunch. You are probably in need of coffee right now. Thank you. I'd be happy to answer any questions you may have at this time. I think I have a few minutes. If there are none, then I will wish you a good afternoon and a productive session for the rest of the day.
Thank you very much, Emerick. Thank you very much. Yeah, you can hear the applause, meaning your presentation has been excellent. Any comment from the audience? Anyone with a comment about that presentation? Going once? Okay, there are two reasons why you would not have a question or a comment. Either the presentation was perfect, answered all the questions you had, or you understood nothing. So, are we going for A or B? Okay, so thank you so much. If you have any questions, we have contacts for Emric. If you want to understand more about what MiDA advisors do and their partnership with KEPFIC, please feel free to talk to us. We can be able to put you in touch. Now, the next session is a presentation, which is really an exciting one. We're going to talk about investment into heavy fuel oil power plant, which is like a case study. So we have been talking about investing in infrastructure. We're going to have a session which tells us a live investment opportunity, so that you don't go home saying that we were just telling stories. Okay? Someone is gonna come here, talk to us about a live opportunity, and we ask questions about it. We're going to hear from Britam. We have with us Kenneth Kaniu, who is the CEO of Britam Asset Managers, and he is responsible for Britam's asset management business in Kenya and Uganda. He is also responsible for execution of Britam Group's property strategy. He is well experienced in asset management, risk management, investment product structuring, and investment innovation in East Africa and Europe. Now, Kenneth is going to do the presentation in partnership with James Mose, who is the Chief Investment Officer also for Britam Asset Managers. This is a position he has held for the last 3 years. He is in charge of, his position is in charge of $2 billion USD of assets. Those guys are going to talk to us about that one investment opportunity I've mentioned. So please, a round of applause as Kenneth Kaniu and Mose come on stage.
Good afternoon. Good afternoon once again. It's a pleasure to be here and to see all of you here. As have been mentioned, my name is Kenneth Kaniu, the CEO of Britam Asset Managers, and I'm here with James Mose, our Chief Investment Officer. I think, James, you can have a seat. I think, firstly, allow me to extend greetings from the Fund Managers Association. The Fund Managers Association certainly is with you. We do certainly support this initiative as KEPFIC, and I think together with my fellow colleague Nicholas Idondeka, the CEO of Corp Trust, who had wished to stand up and perhaps wave to the team that's here, we certainly as fund managers are people who do feel that this is the way to go in as far as alternative assets is concerned. And certainly I think there's a very bright future in as far as support for KEPFIC should continue. I think secondly, for us as Britam, we have been a member of KEPFIC for the last 2 years, perhaps even longer. I sit on the steering committee representing our customer, Britam Life, who made a commitment more than 2 years ago to then allocate funds into real estate, infrastructure, energy, and so on and so forth. And I thought this was a great initiative to then participate in, to then ensure that we can further that particular agenda. For us on the asset management side, we are here to discuss the investment that we made maybe 2 years ago into the Athi River power plant. It took us, let me call it, close to 18 months to actually make the decision and go through the entire investment process, due diligence and so on and so forth to invest. So it was a fairly, what I would call, complex process. but I can confirm to you that we are certainly better off for it. I think we are very excited to have made this investment. And from the point of view of the skills and capacity it has built within the team, I think that is certainly something that's unbelievable. I think we decided to do this from an asset management perspective as part of the strategy that we had set up for ourselves in 2016. Because in 2016, we had then realized that, particularly if you look at the pension sector, the kind of liabilities that we have in this sector are fast outpacing the assets that are available for investment. I can see Caroline there from the RBA, she knows better than me. But truly, I think pension assets have tripled over the last 7 or 8 years. That's truly what's happened on the ground. But if you look at the asset side, if you look at the number of companies listed on the stock exchange, we still have the same, is it 60 companies that are there? It's been the same 60 for the last 10 or 15 years. In fact, the message that we now hear is for companies to tend to delist, isn't it? To move away from the exchange. That's the current message. We still have one government bond every month that is issued. Granted, the size has increased. It used to be 1 billion shillings in terms of a bond. Now perhaps you're talking of 30, 40, 50. I've seen even 60 and 70 billion shillings. But it's still only one bond. And if you look at the secondary market in terms of trading, it's not very deep. In fact, for us at Britam, we trade perhaps 5 billion shillings a month worth of bonds, and we sometimes find that's too much. If you want to trade beyond that, you start actually to struggle. So what do you do with the money? I think for us, that's the issue. You look at corporate bonds. When is the last time we all discussed a corporate bond? It's been some time, isn't it? It's been a while since we saw those things. I'm not also convinced that we can call a bank deposit an investment. Are you going to pay a fund manager to put money in a bank deposit? It's not convincing, isn't it? We've been discussing private equity. You know, private equity, how much do we have in private equity? 0 point something. Caroline, sorry, I don't know the number, but we know for sure it is 0 point something. Real estate, I think we're up to our eyeballs in real estate, isn't it? 20% in real estate. A lot of that real estate, you know the returns better than me. Is the real estate earning 20%? 10? 5? Those kind of numbers, isn't it? If you're lucky. In fact, it's even better to be in a T-bill, isn't it? Not very easy. So I think I do applaud the work that, that Acorn then is doing, because they are now demonstrating you can make a return from real estate, isn't it? Which is good, and I think that's what we want. So for us as Britam, in recognition of that, that is why we then decided we must set up an alternative asset strategy. And we said we are going to be very deliberate about trying to invest money outside of the T-bills and the deposits and the shares and the bonds. And that's why we went out looking for infrastructure and energy. So I think when we sent the message out that we were looking for infrastructure and energy, I think that was 2017, I must have met more than 50 different people. So entrepreneurs, funds, people who are credible, con men, briefcase. You know how Kenya is, isn't it? But I had to go through all of them. I had to go through all those meetings and sit through and kind of figure out what is real and what is not good, isn't it? And finally, we settled on this particular transaction. For us, being our maiden transaction, we were not willing to deploy what I call development funds. We didn't want to go through the cycle of dealing with contractors, greenfield projects, approvals, blah, blah, blah. We decided we wanted to go for a brownfield project, which in summary means you are investing into a project or a power plant or a road, which is already income generating, isn't it? So less risk. You're talking about cash. The return is lower, granted. The entry multiple is lower. But from the point of view of that assuredness, that is the stage of the transaction that we wanted to participate in. And it took a lot of effort, a lot of energy for us to identify this particular investment. In terms of our methodology, we decided we didn't want a direct investment. We'd rather go through a fund so that we could put pressure on the fund to actually manage the asset for us, which is why we chose that fund manager called Everstrong, that US-based fund. And they formed a specific vehicle just for us to allow us to invest into the Athi River power plant. So as James will explain to you, we invested funds into Everstrong Capital, and Everstrong Capital took all our shillings, the exact amount of shillings, and put them into the Athi River Power Plant. And it's a great investment. We're very happy with it. We've held it now for some 2 years. It's a euro-denominated return. We're earning 9% in euros. I think you'll see that from the presentation. But we've effected a currency swap. Because we are supposed to be clever as fund managers, we then went for a currency swap. So we're earning 14, 15% in shillings. And we're very happy with that, to be honest. The money comes on time, it comes in net. We now sit on the board of the power plant, of course, trying to understand what then goes on. And that is why I started by saying we are better off for having made that investment. And what we want to do is do more of these kinds of things, because that 1.3, 1.4 billion we've invested actually gave us immense learning from the point of view of internal due diligence, external due diligence, what you need to look out for with operators, what you need to look out for in terms of the O&M component. So quite a bit of learning for us, but I think it's something that we want to do. So I think on our side, we are willing to then make this presentation, and we are then willing to engage with KEPFIC, and we're willing to engage with all the pension funds to be able to share our experience, because this is our first investment, and I can tell you that there's many more that we have lined up. I still have another 50 people who are knocking at my door wanting to engage, so I'm seeing them, because we are going to have to make another investment in 2021, and I think the more we can do of this kind of thing, then the better for us. I think if you look at specifically the asset, and I think James will take you through, you can see that is the asset there. Athi River Power Plant is a heavy fuel oil power plant. So they use heavy fuel oil, which is just another term for saying diesel. So it's a diesel-powered power plant. It's what they call a dirty plant because it's not clean energy, it's not renewable. We already know that. But you see, for us, we're investors. So truly, what we were looking at was the return. And when you look at the kind of tariff, and I think I was even saying over lunch hour, if you look at the power purchase agreement and the tariff that one gets or negotiates with Kenya Power, the regulator, you'll find that the tariffs are different based on the different sources of power for these power plants. So you have solar, with the solar farms, you have the wind plants, you have the hydroelectric dams, all of that is renewable. And then, of course, you have what we are talking about here, which in summary, that is actually an independent power producer, is an IPP. Those have the highest tariffs. So for us, that was what we were driven by, because if we are going to get that 13, 14, 15% return, it's not going to come from a solar-powered plant. That will perhaps give you 5 or 6%. So for us, that's what truly drove us to then look at this kind of investment and consider it as something that was fit for the funds that we were then managing. So I think at this stage, what I'll do is that I'm going to ask James just to take us very quickly through the presentation. I've spoken for too long already, I think almost 20 minutes. So James, perhaps it's another 25, something like that. And I think we will leave time at the end for questions. And what you'll see from the presentation, it'll really speak through the process that we followed in making the investment. You'll be able to see the kind of returns that we've been able to generate from this asset, and you'll be able to see what the benefit has been for us in as far as managing the funds that we have under management. So James, I think let me invite you to come and take the guys through, and then together we can take questions at the end. My suggestion, I know we work together and we are close and all that, but take that microphone there. It is better for you. Tafadhali.
Good afternoon, everyone. My name is James Mose, as introduced. I'm the Chief Investment Officer of Britam Asset Managers. So today I'll be taking us through our experience with these power plants that we invested in, how we got to know about this opportunity, what we liked about the opportunity, how we structured the opportunity, how the plant is performing thus far, and the key learnings that we'll be willing to share. So I'll start with, can go to the next slide. I'll start with introducing the opportunity. Ken has done a good job in introducing the plant. So these an 80 megawatt power plant sitting somewhere in Athi River. It was commissioned in the year 2014. So it has now about 14 years remaining in the power purchase agreement. The construction was done by Gulf Power, which is 100% owned by Gulf Energy. Gulf Energy is one of the leading oil marketers in East Africa. Can go to the next slide. So the engine this power plant uses is the speed diesel engine supplied by Wärtsilä. Wärtsilä has expertise in producing such type of engines, and it controls 50% market share in the world. And Wärtsilä is the O&M operator for the plant, the operation and maintenance. Just based on how exactly the plant has been performing, Wärtsilä has been doing a very good job. So the sort of contract that these plants and the company has with Kenya Power is the take or pay contract. So what exactly it means is that the plant is paid for availability. Ken talked about the fact that this energy is expensive. So to stabilize the grid, KPLC taps onto these plants when, say, hydropower is insufficient, when we're experiencing, say, drought. So for the plant to be paid, it needs to always make sure it's available. And the sort of availability that the plant needs to present is always 85% of its capacity needs to be available whenever KPLC wants to tap into the plant. But just going by how it's against the threshold of 85%, this plant has been almost 100% available. So we've just shared a snapshot of availability of this plant going back 2018, 2019. We invested in this opportunity in 2018. So the whole of 2018, this plant was available 98% of the time, while the contractual availability is 85%. Last year, it was available 99% of the time, and the first quarter of this year, available again, almost 100% of the time. So most of the revenues that this plant gets paid from KPLC are capacity revenues. So once it's available, it's paid 100% as per the power purchase agreement. The fuel that the plant uses is just a pass-through. So whenever it incurs expenses as regards to fuel, it bills the same quantum, it bills KPLC, and KPLC pays for it. This is how exactly we structure the deal. The opportunity that we were presented was an equity opportunity. So Everstrong introduced the opportunity to us, and the opportunity they are looking for is Britam to invest, to buy an equity stake into this plant. But seeing that it was our first time investing into infrastructure, we wanted something more de-risked. We wanted to pass on the risk of performance to Everstrong and Gulf. So we structured a debt opportunity instead, and the amount that we invested was 1.4 billion Kenya shillings. So we gave the amount to Everstrong Power. We in turn passed the full amount to Gulf Power. So the relationship between Britam Asset Managers and Everstrong Power is a debt relationship. But the relationship between Everstrong Power and Gulf Power is an equity relationship. Ken talked about the opportunity yielding euros. So the amount we invested in Kenya is Kenya shillings. So there's an issue there. So I'll explain how exactly we went around that currency mismatch. Because the liabilities that we have, they are Kenya shilling liabilities. The asset that we're investing in is a euro asset. Then how exactly do we go around that? So the fund manager for Everstrong is Everstrong Capital. Everstrong Capital has immense expertise in matters energy. So this is the fund manager charged with the responsibility to ensure that these assets then performs and the sort of obligations that Everstrong has with Britam asset managers, those obligations are met. The debt that we structured is a 5-year debt opportunity, whereby we are paid coupons semi-annually. The coupons are coming in at 9% euro, and they're paid every March and September of every year. So then also there's another mismatch because the tenor of the asset, like I said, the asset was commissioned in 2014 with a PP of 20 years, meaning it's running up until 2034. But we invested for only 5 years. What exactly then is Everstrong going to do to ensure that, one, we are paid for the 5 years, all the coupons that were meant to be paid at 9%, and then at maturity, year 5, we are paid our full principal. So I'll start explaining firstly we can go to the next slide, on how we went around the challenge that we had Kenya shillings where the opportunity was a euro opportunity. So we approached a local bank. The local bank was happy to get into a cross-currency swap transaction with us, whereby we gave the local bank 1.4 billion Kenya shillings, which was equivalent to the stake that Everstrong was going to invest in Gulf Power. So the bank then gave us the euros equivalent, and we agreed on a price for this cross currency, which is a 5-year contract, but it's reset every year. So every year we negotiate based on interest differential between Kenya shilling and the eurozone. We agree on who needs to pay who. But going by historically, interest rates in developing worlds are actually lower. Rather, interest rates in the developing world are always higher as compared to interest rates in developed worlds. So always you'd find that if, for instance, you're executing a cross-currency swap with someone in the developed world, that person will always be paying you. So if you look at the performance for this cross-currency swap for the past 2 years, the bank has been able to pay us about 5% every year for the last 2 years. So what exactly that means, the opportunity is giving us 9% in euro. Then we are getting 5% in Kenya shillings. So that then translates to the return that Ken talked about of 14%. And there's also another opportunity to make money from this transaction, because the coupons are paid in euros. And we can see, like, for instance, how exactly Kenya shilling has performed against the dollar and euro, especially this year. So we've been paid our coupons, our March coupon in euros, and again paid our September coupon in euros. If you look at how exactly Kenya shilling has performed against the euro, this year Kenya shilling has depreciated against the euro by more than 10%. That's another opportunity to actually enhance the returns. So for instance, the sort of returns that we expect this year, total returns, the 9% coupon coming through from the debt coupons that we expect to be paid by Everstrong, plus the cross-currency, about 5%, plus again case depreciation against the euro, based on the fact that we are paid the coupons in hard currency, we expect the return to be upwards of 14% this year. So quickly, I'll take us through the process we went through. So like I said, the opportunity was introduced to us by Everstrong, just like a standard process. Whenever you're looking at an opportunity that is not like widely available to all the investors, we executed an unbinding, an undisclosure agreement, an NDA, and we are given exclusivity of 90 days to conduct our due diligence. So the sort of due diligence that we conducted financial due diligence, we conducted technical due diligence and legal due diligence. The reason as to why we started with financial due diligence, and it's standard process, before you start spending money on technical due diligence and legal due diligence, you need to be certain that these are bankable opportunity. So we had to look at the historical performance of the company, look at the financials, look at the forecasts. Then the moment we were convinced that actually it was a bankable opportunity, we decided then to go through the technical due diligence and the legal due diligence. Like I said, the opportunity had been initially offered to us an equity opportunity. So we had to look at, like for instance, what's the expected internal rate of return? The expected internal rate of return, had we gone directly and invested, did an equity investment, the expectation was anywhere between 12% to 14% on the euro. So we had to verify that actually indeed that 12 to 14% can be supported historically and even with the forecast. So once we were happy, we then conducted technical due diligence. We didn't go for international firms to conduct the technical due diligence. There is local capacity. So we got engineering firms locally who went to the plant, looked at the performance of the plant, the past. Then we invested in 2018. The plant had been in operation for 4 years. So the maintenance of this plant, whether the maintenance had been done, the availability, the state of all the machines and the engines, and the technical, the local engineering firm that we onboarded were happy with how exactly the plant was performing and exactly the plant was maintained. Then we had to conduct legal due diligence, and here we used our internal legal expertise and also got external legal expertise. And here we looked through the PPA. The PPA ordinarily is a document that is almost 200 pages. So the legal counsel had to make sure that as per the PPA, the interests of the investors were actually protected. Again, we had to also execute a debt agreement between ourselves and Everstrong. So again, the legal counsel came in handy. Another reason as to why we lacked this opportunity is, while the asset was, the performance of the asset backed by the financials was actually very strong, but we liked also the risk mitigants that had been put in place. For instance, if KPLC, for any particular reason, happens not to be in a position to meet its obligations to Gulf Power, the plant that we've invested in, there is a letter of support from the government of Kenya. So the government of Kenya then will come in and meet those obligations in full. So it then operates like a government bond, but a government bond that is yielding way more. So then, of course, we went and further had negotiations on the terms, executed a term sheet and a debt agreement, and deployed the funds. Yeah, so the investment considerations that we considered, yeah, the debt that we structured is a 9% debt, 5 years, backed by a PPA, which then had 14 years to run. Currently now, rather had 16 years to run. Now the PPA has 14 years to run. We liked the take or pay model, meaning the only risk that the plant has is just to make sure, or rather the only expectation just to make sure that the plant is available. And based on how exactly it has been available in the past, we had no reason to actually worry that these will change on a going forward basis. The risk mitigations that we considered and which gave us the comfort to go ahead and make the investment is the plant performance. Like I said, Wärtsilä is renowned for maintaining these power diesel engines. It controls a market of 50% globally, and based on how exactly it had conducted its maintenance, we were happy with the partner that the plant had chosen to go ahead with. There's another risk of single offtake because the only buyer of this power is KPLC. What happens if, for instance, KPLC chooses not to make its payment? But like I said, there's a lot of support from the National Treasury. So in the event KPLC is not in a position to pay, the government will step in. The other risk that we had to consider is exit, because while the asset now has then had 16 years to run, we're investing in a 5-year opportunity, which we have to exit in the next 3 years. What gave us the comfort that this will be possible? It's the reason as to why we believe largely this risk of exit is managed. It's because of the financial performance of these assets. Like I said, had we gone in and invested as an equity investor, the sort of returns will have gone for is anywhere between 12 to 14% on the euro. So we took a haircut, took lower returns, so that we could get the sort of safeguards that we wanted: stable revenue, 9% every year for 5 years, then be able to exit year 5. So now the responsibility that Everstrong Capital has is to ensure that by year 5 they found an investor who's happy to actually take out our investment. And the reason as to why we're happy that rather we don't have concerns that they won't be able to find someone, it's the strength of the expected returns even on a going forward basis. We think they'll be able to find an investor who's happy to actually take on an investment that is yielding 12 to 14% on the euro. As regards to the next slide, where we think, based on the risks infrastructure assets presents, where exactly we think infrastructure assets fall as compared to all the other investment opportunities available for pension funds. We think infrastructure falls just above fixed income, government bonds. So cash, of course, has the least risk. For instance, if you invested in a stable bank, tier 1 bank, the risk is low, but again, the returns are equally low. Fixed income, because of, for instance, even government bonds, for pension funds, we're required to mark-to-market investments in government bonds, so they're impacted by yield curve movements. So that's why a fixed income just falls above cash. But just looking at our categorization, whereby we think infrastructure just falls right ahead of fixed income, and we've put infrastructure and real estate together, I think there's room to actually improve this slide because we have a real life example whereby we've been subjected to COVID-19. All these investments have been subject to COVID-19 this year, and we have benefit of hindsight, whereby as Britam asset managers, we've invested in an infrastructure asset. We've also invested in property, income generating property. And just to report here, if you look at the coupons coming through from this power plant that we'd invested in, the coupons have been actually paid ahead of time. The March coupon came in ahead of time, and even the September coupon came in ahead of time. But when you look at the property investment that we've made, income generating property investment that we've made, we've had situations whereby we've just been negotiating with the tenants. We've been forced to give the tenants moratoriums, and I'm certain this is not just true to us. it may be something that you can actually relate to as well. So we think, based on the fact that the resilience infrastructure as exhibited, especially this year of a pandemic year, we think it's actually less risky as compared to real estate. And on the other hand, even the returns coming through from infrastructure actually are even higher as compared to real estate. Then equities, of course, the returns expected higher, but the risk is equally quite high. And that's true for private equity as well. The key learnings we've been able to record from this investment that we made. The first one is on risk. Yeah, so there's no way you can avoid risk 100%. You must be willing to take on some risk, but it has to be calculated risk for you to be able to get greater returns. On the avenues you have as investors in getting into infrastructure, you can decide to do a direct investment, whereby, like for instance, we'll have gone directly and invested in the plant, or you can do an indirect investment, like we did, whereby we went through a fund manager. The risks with those two approaches, the risks that come with those two approaches. Direct, the chances are that returns are meant to be higher, but you may be forced now to stick in for the entire period. You may not be able to have a liquidity event like the opportunity that we have, whereby we expect a liquidity event within 5 years. You can choose to go through debt, or you can choose to actually make an equity investment. Debt, of course, the returns are slightly lower. Like I said, our returns expected is 9% directly from the opportunity. Equity, we should have gone for 12 to 14%. But again, well, now when we sit back and ask ourselves, it's been 2 years, should we have gone in as equity investors? We think there is opportunity loss. The fact that we are getting 9% as opposed to 12 to 14%. But we are comfortable with the fact that this 9% is regular, has no variability. It's actually very stable. And also, the other compensation we're getting is that we'll be able to exit within 5 years. And like I said, lastly, real assets are actually, they have real benefits. This opportunity has been subjected to a pandemic, and we've been able to get our full returns. And this year of the pandemic is the year we even expect to get the highest returns. We expect this year to beat the returns coming through this year from the asset plus the cross currency, from the depreciation of Kenyan shilling to the euro, to beat the 14% that we booked in the first year. So as I conclude, this is a comment that Ken, the CEO, made when we were launching this opportunity. So as Britam, we're happy that we contributing to the funding and provision of long-term capital into the Kenya power sector. Thank you very much.
Thank you very much for that presentation, Mose and Kenneth. So I open it up to the audience for any comments, any questions you have. Going once? Okay, yes, the first one is here.
Thank you very much, Ken and Mose, for the wonderful presentation about this opportunity. I think we actually had also a similar experience, although we didn't conclude, one which we did in neighboring, you remember? The one for the Triumph Power. But definitely this is a wonderful idea. In fact, the innovation of going through debt as opposed to equity is something which we definitely are going to consider in our forthcoming investments in this area. But the one question I have is it possible also that you could have considered an investment model whereby, although you are you're going in as an equity investor, and because the funds, the payments which are coming from Kenya Power are sort of predictable and in US currency, is it possible that you could have created, and I believe the plant is not making any reinvestments, you could actually have unlocked up to almost 80% of dividends or revenues to be able to go to the investors directly every year, as opposed to keeping a lot of reserves. I don't know, but that's a model I would think would have been also ideal, and therefore you'd still have benefited from the maximum opportunity of equity on equity investment. That is by negotiating a lot of cash to be released in form of like cash dividends. Is that something you could have considered?
Yeah, that's a good question, and I think James will also comment also. And that is the model of the power plant, because what should be happening is that, maybe I can just stand. What should be happening is that, recall with many of these power plants, and I recall even the one that you're talking about, the Triumph Power, and even with the Athi River Power Plant, these things are funded on debt. And if you look at the financing model, usually it is 70, 80, even 90% debt in many cases. So once a power plant is up and running, you find that whoever has funded it as a promoter or whoever has set it up is typically looking to exit that particular debt, which is where the opportunity then comes in for an investor like us or you to then come in and take out the debt and provide some equity. Now, what is supposed to happen in terms of the cash as it's paid from Kenya Power is that the cash comes in, you are then supposed to pay off the operating expenses of running the power plant, pay off the debt, and whatever money is left available is then distributed to the equity investors. So the reserves, as you say. We don't want any further funds used for further investment because the plant is set up for 20 years. And truly the OPEX, or the operating expenses, is just to buy the lubricants, buy the diesel, pay the land rates, pay Watsila, your operator, and so on and so forth. But remember, for us, we chose to invest debt. Now is when we are actually kind of, regretting that decision, and it's fair to say that, because the equity investors are making more money than us. But we know that, and we decided up front it's okay, because as our first investment, we needed to protect first the downside, rather than get into an investment where we were not certain on the equity returns. Because remember, the equity returns are now based on the efficiency of running the power plant, isn't it? If someone is using too much diesel, if the operator is not doing the right thing, the equity investors then take a hit, isn't it? But if you have an efficient operator, then truly the reserves that are left actually contribute to a very strong equity return. So it's correct that we could have done that. Maybe in our second investment, we might be more courageous to then say, no, we want equity, not debt, and we can benefit from that. But one of the things that we negotiated in this deal is that we also put some pressure on the fund manager. Remember I said we went through a fund manager. We put some pressure on the fund manager to renegotiate the balance of the debt that had been in the power plant. That debt had been taken from some DFIs, and sometimes DFIs, we really wonder about DFIs because they almost operate like commercial banks. So the rates on the debt were very high from these DFIs. So because of renegotiating the debt, and that is what is ongoing as we speak, and we've been citing that and been involved in that, bringing the debt down will release further cash. Unfortunately, that bit we can participate in. So we do expect to see a bit of a return there, a bit of a better return. But it's true, had it been equity, I certainly think would not be at the 9% euros, maybe 13, 14. You add back to shillings, because again, we'd still have set up the cross currency swap, it would have been a number more than 14. But for a first-time investor, we think it's reasonable. Yeah. You want to add anything? Yeah.
Good afternoon, everybody. I am Andrew. I would like to ask a question that I always ask the fund managers or the promoters of these wonderful ideas. And I think I appreciate the fact that Mr. Kenneth, you have pointed that you guys are you are in the investment, you are in the field of making money. But again, I would like to present this moral dilemma that on the other hand, we Kenya are blamed for having an expensive power that is hindering investment in the sectors that will really have driven the economy. And so, because again, you come actually in midway, maybe somebody has already initiated the conceptualized idea, so yours is just finance. What comes to your mind, for example, when you read in the papers like we did this week, that it looks like the PPP, the independent power producers, they look like they have a lot of influence on Kenya Power, that really clean energy is left and they give priority to, that's actually the way it's being brought out in the media. What comes out to your mind? What role do you think you can play, not just for this particular one, but how can we balance between stabilizing power and also bring costs down? Thank you.
No, it's a great question. It's a great question. We also considered that in our discussions with a lot of our partners prior to us making the investment. Because I get where you're coming from. It's an independent power producer, it's a thermal producer. So you are just burning diesel and it's being released in the air. So how clean is that, as an example? And once again, it's the most expensive form of power. Truly, if you look at the tariff, you look at what we pay, you look at the fuel adjustment, the forex adjustment, there's a lot that we're paying for that as a country. So certainly, if one talks of a moral dilemma or moral argument, truly, perhaps we should be looking at the renewable energy and so on and so forth. But as with everything in life, there's two sides to a coin, isn't it? It's not usually a one-sided coin. So there's two sides to the coin. I think the first kind of argument we saw is that if you look at stability, and you look at this issue that they call a base load, unfortunately, this thermal power is the most stable form of power that we actually have as a country. If you look at the availability of the wind, the solar, and so on and so forth, whilst it is there, it's not as available as that of thermal. So whenever we have power interruptions, whenever we have breakages, truly, that is when they switch on the IPPs, because those ones are the ones that will provide that stable base load. Again, if you look at the other argument, and you look at even these countries in the West and so on and so forth, a lot of them are still using coal and thermal power. In fact, most of their base load, 50–60% is that coal and thermal power, because they also know you cannot run a factory on solar. They have understood that, but they want you to do that, which we don't think is a reasonable thing to do as a country. So even as a country, if we do want a stable base load, then we have to be able to exploit some of these coal resources I keep on reading about in Kwale and so on and so forth. Perhaps that's the way to go. We need to be able to make sure that if it is hydro, it is available. How do you even make hydro available? We're relying on God. But perhaps it is the geothermal that we then need to exploit to then ensure that we are able to provide not just available power, but affordable power. Because if you look at Kenya relative to other jurisdictions, we are seen as quite expensive, and that we certainly agree. But for us as an investor, because I started the presentation by saying I am aware of that dilemma, I knew you would certainly have to ask a question like that or somebody else. For us, we are wearing our investment hat. And from an investment perspective, the PPA is great. And the tariff backing that PPA is great. If you look at what then happens with particularly a thermal power plant, it's a very interesting way of looking at things. It's a take or pay contract. So you are being paid for simply being available. Remember, they have not switched on the power to draw down on power for you. They are just paying you for being available. In fact, for an inefficient power plant, the second you're switched on, you lose money, to be honest. Because now you have to switch it on. You have to fire up the engines. You have to buy the diesel, blah, 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 and so on and so forth. But just for that mere fact of being available, And the fact that you can be called upon at a moment's notice to supply the power, you are paid. And the way they calculate it, you are paid cost plus a margin. So to be honest, the cost plus the margin is enough to get you almost that 9% he's talking about. But when they switch you on, of course, some work then happens, and you need to run the plant efficiently, and so on and so forth. Which is why you saw that in terms of our own specifications, and also the specifications from Kenya Power, they need you to be available. I think it's 80% of the time, or is it 85? A number like that. 85% of the time. This plant is up 98% of the time. So for Kenya Power, they must pay, which is typically what then happens. So morally, it is true. I'm also paying for that. It's expensive power. I'm also not excited when I see that. If I want to run a factory, I cannot compete with Egypt and South Africa and the rest of it. But you go to other African countries and see what then goes on. We are fortunate we are here in Enashipai. In Enashipai, there is no interruption. We are not on a generator and so on and so forth. You just have to visit some other African countries, Central, West, and so on, to appreciate what then we have here as a result of the very good power mix that we have, thermal, geothermal, wind, and so on and so forth. But I know there are people here from some of our electricity players. Some of them, I know them well. They know what they are doing from the point of view of diversifying the power mix and so on and so forth, because even for them, it's not an interesting discussion. I see you're looking at me, she's also looking at me, but it's okay. That's where we are here. So I think back to you for the next question.
Thank you very much. I am afraid it's already break time, and it is a very exciting presentation, very exciting discussions. I will give room to eat into our break time for 2 questions, but I will say 2 questions with a but. 2 questions if you will ask a question, not a question inside a question. That's number 1. And number 2, if Britam will also respond briefly, so that we can have the short break and get back for the panel discussion. During the break, can you and Moses, right? Jane, Mose, they will be available during the break. We can interact with them. But so I will give, there was one first question. Yes, to that gender role.
Well, thank you for considering gender. So first I wanted to make a very brief comment and say going the debt route was very brilliant. You might think that you're sort of not getting the full return, because of course debt and equity have got different characteristics, but I think in my view it was brilliant. To my question is, I'm just wondering, you said this year will be one of your amazing years because obviously of your currency swap and the Kenya shilling depreciating and the 9% return. But I'm just wondering, haven't you gone through the force majeure notices that Kenya Power has issued? And if so, how have you dealt with them?
Right. Thank you. That's a very good question. So indeed, we've received the force majeure notice. But remember, the person who's received is the fund manager, because the fund manager did make an equity investment into the plant. By notes, so it means they need to actually bear any consequences coming through from the FM notice so that we get our return, a 9% return in full. But I'm happy to report that the FM notice came in April, and what we know is that at the beginning of August, it had been waived. And when we had discussions with the fund manager just to assess what was the impact of the FM notice, the indication they gave us is that if you look at the expected revenues for the full year, because I can disclose, the FM notice was KPLC had felt that because of the pandemic, demand for power had been affected, and they were not able to utilize the available capacity in full. So then they said, would want to reduce your invoices by a certain percentage. So of course, the the plant based on the PPA. They contested that because they said even if the FM notice is actually valid, this PPA is backed by a letter of support from the government. So what exactly KPLC needs to do is to go to the government and tell the government, we only able, based on the revenues that we are making, to pay, say, 80 or 90% of the PPA. So the balance, please make it whole on the basis of your letter of support. Yeah, so KPLC shouldn't have just passed on that risk to the investors, seeing that there's already a letter of support from the government of Kenya. But when we further engaged the fund manager, because again we sit in board meetings for the plant, the assessment they've made in the worst case scenario that those percentage of invoices, rather that percent that KPLC is not willing to pay, is not paid for this full year, it will only affect 2% of their full year revenue. But remember, the returns they're making, the fund manager is making, is upwards of 12%. So that's why they were happy to fix 9% to us, so that the margin between 12% and 9% is their spread. Yeah, so we've been paid our March coupon in full. Even the September coupon was paid in full, so the FM notice has not affected us.
Thank you, Ken and Mose, for the brilliant presentation. Rono is my name. Maybe just a general question aligned to what Mose has talked about, the stories of Kenya Power. Where do you think is the future of investment on energy sector, considering that when you look at, for example, power, there is a likelihood that we might never have this kind of opportunity again, where government are basically licensing another independent power producer. Or if they do so, most of the risks will be shifted to the producer. And this is on the fact that when you look at the energy mix currently in the country, I think geothermal is now becoming more dominant. I think your plant must have come in at a time when we were so dependent on hydro, which was quite unreliable. So where do you think is the future in terms of investment on this kind of asset class?
Yeah, that's a good question. Initially, if you look at the way the energy mix was set up, and I think the guys know better than us, initially we were on hydro, maybe 70% hydro and so on and so forth, and then the balance was plugged in by the IPPs and also the emergency power producers, which are even worse than the IPPs. That's how we used to run our power. So whenever there was a drought, hydroelectric would then be rationed and the balance would be made up for by the IPPs and EPPs. But now we have discovered that there are other sources of power. So if you look at geothermal, geo is a huge, let me call it, reservoir of power. I think they have the kind of base load that we've understood that is there can power, I think, Kenya and several other African countries. We are now also looking at wind and solar, as I mentioned earlier. And I think the government has already dictated for us, as you have rightly said, what the future is going to be. We have some 10, 12 IPPs that are out there trading in the market. And the government has made it very, very clear through the Ministry of Energy, they are not going to license any further IPPs. So whoever now is there in an IPP is of course very happy, he's enjoying his return. But the problem then becomes the reinvestment risk. What are you going to do with this money? You've been earning some 10% in dollars, or 12 or 13 or 15%. When did you ever earn such another return again? So that certainly is an issue. And if you look at the kind of returns and the kind of PPAs being signed on the renewable side, the returns are not as high as those of, let me call it, the thermal sector. So, you know, the kilowatts percent or whatever it is are very, very low. So it then requires a different kind of investor to then go in and exploit that particular asset and commercialize it and bring it up and so on. So you see, for us as fund managers and for you as pension funds, you're commercially driven. I know I was asked the question about morals, but truly, when it comes down to the board, we may not quite consider that. I'm not sure in which AGM you can truly go and tell your members we're here because of that. We are here because of the returns. We need an asset backing those liabilities, otherwise the whole thing doesn't work. So you may find that for those kinds of investors, it will be difficult to justify why you are off earning a T-bill return, as an example, or even below T-bill. So it needs another kind of investor, a more patient investor, an investor whose mindset is attuned towards the development of that power sector, as opposed to people like us. And I think that is where the danger now lies, as an example. But I think for government, they are completely set on ensuring they bring down the cost of power while increasing the base load. Is the right thing to do, if you ask me as a Kenyan. That one I cannot disagree with. So I do think that for us to then kind of consider a solar power plant or whatever, we'll struggle in the future to do that. Maybe we might consider the development side, because on the development side, you can extract a development return. But now you need someone to sell. You need to be able to sell this asset to somebody who can then run it, as an example. But we remember we've been talking about power. And this is not a power conference, to be honest. This is an infrastructure conference. So energy is only one part of infrastructure. So there's so much more that we can do. Roads, bridges, hospitals. Those are some of the things that we are looking at now, because those ones still have those kinds of returns that we are talking about. So that, to me, is still a very attractive opportunity. But power, I think the government has kind of said, we don't like you commercial investors. We are in fact lowering the tariff to signal to investors or to signal to the market what we actually want. And I mean, it's expensive. It's expensive for Kenya Power. It's expensive for Kengen. It's expensive for everybody. That bit we understand. But if you ask me, in terms of the future, it's renewable. It's going to be that clean energy.
Thank you very much. A round of applause to Britam guys. Thank you so much for your presentation. I'm gonna give us a 30 minutes break, and I mean 30 minutes. I will come around with my bell after 25 minutes. You will see me coming around. You know why? Because we have a very, very exciting panel discussion. Our panelists, those who are joining us online, are already online, eagerly waiting to have a discussion with you about demystifying infrastructure investment in Africa. So that we can come and have that exciting session, please take your tea very fast. And those who are also online, we're asking them to also take a break. Go take your tea, because we want you to have energy for that session. Thank you very much, and let's have our tea. So I hope you enjoyed your discussions over tea break. You go to ask the tough questions to Britam. Okay, so now we are going to have a panel discussion. I'm just giving 1 minute for everybody to take their seat. We're going to have a panel discussion. And the discussion is about demystifying infrastructure investment in Africa. I'm going to introduce to us the moderator for that session. I've been kicked out. I am no longer the moderator. For the panel discussion, we have Roslyn Spencer. Roslyn is the managing director for MiDA Advisors. At least we all know who MiDA Advisors are. We listened to Emric talking to us about MiDA Advisors. Roslyn has over 25 years of experience in the financial services industry, primarily working with pension plans. Her broad experience covers all aspects of pension plan management, investments, and operations. As a managing director, she is responsible for developing and managing strategic client relationships and overseeing investment advisory projects. Thank you very much, Roslyn, for joining us. Can you just say hi for everybody to hear you?
Hello, everyone. I'm delighted to be here. Thank you for having us.
Thank you. That is Roslyn for you. And the next panelist is Valerie Mosley. Valerie is a senior advisor also for MiDA Advisors and a member of MiDA and NASP Advisory Council, which advises USAID programs on impact investing and trade relationships with Africa. She is
She also serves on the board of Eaton Vance Mutual Funds and the corporate boards of New York NYSE, that is New York City Stock Exchange, right? New York Stock Exchange, which is New York Stock Exchange listed Dynex and InvestNet. Valerie Mosley, welcome. Can somebody unmute her for her to just say hi?
Hello, habari yako?
Mzuri sana.
Mzuri sana.
Thank you so much, Valerie. And we are going to have also Nicholas Idondeka. Nicholas Idondeka is the chairman, Alternative Investment Committee in the Fund Managers Association. He is also the managing director, Coop Trust Investment Services Limited. And prior to joining Coop Trust, he served as vice president, Pinebridge Investments, East Africa. And before that, as the portfolio manager at Old Mutual Asset Managers. He has over 14 years experience in investment advisory and fund management services. Welcome, Nicholas is going to be here. Say hi to everybody. Thank you, Nicholas. Next in the panel, we will have Josephat Muriuki. And Josephat Muriuki is actually a KEPFIC steering committee member. Josephat is the Chief Executive Officer and Trust Secretary in charge of both the KenGen Staff Retirement Benefits Scheme and KenGen Defined Contribution Scheme with cumulative assets value of over 20 billion Kenya shillings. He holds an MBA, Finance and BSc Actuarial Science. He is a certified investment and financial analyst, a member of Chartered Institute for Securities and Investments, certified information and security auditor, certified pensions trustee, and a JQuat, that is Jomo Kenyatta University of Art and Technology, student undertaking PhD in leadership and governance. Welcome very much, Josephat. Say hi to everybody.
Evening.
Thank you. Then next, we will have Onesmus Nzuki. Onesmus Kioko Nzuki is a member nominated trustee at the KRS Staff Pension Scheme. He works at the Policy and International Affairs Division of the Customs and Border Control Department at KRA. He has been a trustee for the last 3 years and has recently been elected to serve a second term. He also serves as a director at the Ushuru Sacco Society Limited and is also an advocate of the High Court of Kenya and a member of the Law Society of Kenya. So if we have any legal discussion questions, he is our guy. Say hi to all of us.
Good evening, everyone.
Thank you, Onesmus, and welcome. Then we will also have David Thompson, who is the Private Enterprise Officer for USAID Power Africa. He has been in the foreign service with USAID since 2003. Prior to joining Power Africa, David completed 4 years as USAID Deputy Mission Director in Dar es Salaam, Tanzania. So probably he understands the context in East Africa. He was Chief of Policy, Outreach, Strategy and Evaluation Unit, Office of Development Planning in the Bureau of Africa between 2013 and 2015. He was also Senior Policy Analyst in the Office of Strategic and Program Planning, Bureau of Policy Planning and Learning, 2012 to 2013. He was the Director of the Office of Democracy and Governance in both Afghanistan, that is 2011 to 2012, and Honduras, that is 08 to 2011, and Director of the Program Office in Albania. I just want to emphasize and say that Power Africa are proud supporters and partners of KEPFIC. So welcome, David. Somebody can just mute him and say hi.
Asante sana, thank you very much for the welcome. Wish I was there with you in Nairobi.
Thank you. So those are our panelists. I will leave it to Roslyn, who is going to be the moderator for that session. Thank you.
There's just 4 major themes that the panel will focus on. the role of pension funds, their mandates, policies, and insights, the 2021 perspective for investments and co-investments, as well as hesitancy by investors. What's the holdback? What's holding them up? And how can we get them to the table? And last but not least, we'll talk about collaboration and engagement with international organizations and governments such as Power Africa and other institutions that we have worked with. So to kick off the panel discussions, I'm going to go to my fund managers in Kenya, to Onesmus, and followed by Josephat. So the question I have for you is, could you please provide a brief background of your fund? And from your perspective, how can pension funds play a role in building the economy in Kenya or in the region? Onesmus, can you start us off?
Good evening, everyone. As introduced, my name is Nzuki Onesmus, a trustee with the KRA pension scheme. KRA staff pension scheme is a DC scheme since the year 2005. We have an asset under management of about 22 billion. And our average return for the last 3 years has been around between 8 to 9%. Our asset allocation, we are quite heavy on government securities at 45%, property at 25%, equities at 23%. We have some exposure in that is bank deposits at around 4%. We got no exposure at all in infrastructure or pension or PE. The role that pension schemes, in my view, and from what we've discussed even today, in the economy is investment. If as pension schemes, we could just invest in infrastructure, as we've been talking about, at least the burden that the government has been having of external debt, we can at least come in and help in that. By investing in infrastructure, of course, we create jobs, meaning that we stimulate the economy. And as pension schemes, I think we need to consider investing in infrastructure. Thank you.
Thank you, Onesmus. We operate two retirement schemes, Kengen DB scheme and Kengen the DC scheme. The DB scheme is the conservative scheme, which is for the members who were there then. And the scheme was closed in 2012, and we have the DC scheme, which is more aggressive. We have a cumulative asset capacity of $200 million. And we have a distribution of our asset in various asset classes, from real estate, private equity, we have fixed income and government securities. Additional to that, we cumulatively, for the last 5 years, we have a return of approximately 12.5%, looking forward to get better return after investment in alternative assets. And we have an allowance to go to up to $10 million in alternative asset classes. Pension schemes have been playing a great role in the economy through the funding that the government have been borrowing from the market, that is through the fixed income. However, infrastructure investment provides a great avenue for the pension schemes to have a bigger impact, because previously it's not a direct impact to the economy. This is through infrastructure like real estate, transport, communication, financial industry. And through this, the pension scheme will have direct impact to the monarchy on the ground. Their impact will be felt, at where at the same time will be able to give a better return to their members. Additionally, pension schemes are considered to have better corporate governance. And the good corporate governance in pension schemes, through their project implementation, it will be adopted in other government infrastructure projects, and the ripple effect what the infrastructure investment in the economy will be done better than they have been done previously. Additional to that, pension schemes are considered to be able to harmonize the moral, the ethical, and the political angle of all investment. So due to the accountability and the transparency of the pension scheme investment, they'll be able to bring this back to the economy by investing through infrastructure. So we think we have been playing the role in the economy, but through infrastructure, we'll be playing a better role. Thank you.
Thank you so much. If I can now move on to Nicholas, who is a fund manager. And Nicholas, you've heard the two pension fund managers talk about the asset allocation and about the fund. How do you see the fund manager, from a fund manager perspective? What is your role in the alternative asset investment process? How do you assist these pension funds to allocate monies to the asset class with the expectation that the returns will be as expected or as promised, given that it's a very long-term perspective?
All right, thank you, Rosalind, and good to see all of you this afternoon. Before I make my comment, I just want to pass the regards of the Fund Manager Association chairperson, who's logged in online, Jonathan Stitchberry, who couldn't make it today, but he gave us his blessing. So, Rosalind, in terms of that question, there is quite a broad way of reacting to that. And the underlying issue is that we are mandated by law through Retirement Benefits Authority to guide the clients and the trustees on investment affairs. And this covers all the investment classes that are available in the market, including alternative investments. So I think going back in Kenya in the last couple of years, we've had tremendous developments about who covers what. And in the last 4 years, even the RBA itself has come in to give greater clarity on who covers particular investments. And the alternative investment class clearly sits on the fund manager's docket. And coupled with that is now guiding the trustees who we understand that we also see that they're not professionals, investment professionals in the day-to-day life, about the process of going through the various investments, how to vet particular classes, how to look at each particular unique investments. If you look at the power project that Ken and Mose were presenting earlier on, if you step back about 10 years ago, trustees have probably gone on that investment alone and without even considering the fund manager. But as you bring in the fund manager, then you're able to walk into small steps, look at the risk factors, which schemes can either take on or not take on, and at the end of the day, be able to execute significantly into this alternative investment class. And again, the background of that is because we have seen tremendous growth in retirement benefits funds. If you look at the growth of market capitalization, I think the only one which compares the growth in assets in pension in Kenya is probably just government debt. In terms of equities, especially if you strip off Safaricom, we are virtually competing for the same stocks. So alternative investments is clearly where the action is, and for the fund manager, Rosalind, I think it's quite key to protect the fund in terms of risk factors, in terms of giving trustees that comfort as to whether they are being able to meet the criteria you're looking for, and of course the investment return. Coupled with that is enhancements, which will be able to push in there. What trustees sometimes are not able to see is the fact that we would be fighting with Edward in the boardroom and Koi when they come to present, pushing back on particular fronts, or for example, private equity. And with that, we're able to give the trustees a more balanced investment class, and of course, a more acceptable investment avenue. Thank you.
Thank you so much for that. Let me go over to Valerie. Valerie, you come from the U.S. perspective as an institutional investor. You sit on the New York State Common Investment Advisory Board, and as well as on the Eaton Vance Investment Advisory Board as well. Can you tell us from the U.S. perspective as an investor, what are investors looking for, and what let's talk about hindrance, okay, and build that all in. What are they looking for? What will it take to get them to invest alongside with the Kenyan pension funds or in Pan-Africa with other African pension funds?
Thank you very much. It's such a pleasure to be here today. In answering your question, a few things come to mind. Just want to frame the conversation with what are the expected returns in US markets? They're really quite low. Recent studies have put European equities at 6.5%. That's nominal returns. The expected return for large cap equities is 6.1% nominally. If you look at the emerging markets, it's 7.5%, which is where most of the opportunity is. And if you consider bonds in the United States, the expected return, according to BlackRock and others, is less than 2%, 1.7 to be exact. So if US pension funds are looking for attractive returns, they have to look outside of the United States and what they're used to, more often than not, European equities, to get the actuarial returns of at least 7% on average. Some have 7.5%. So what's particularly attractive from where I sit is the returns that you're talking about generating are extraordinarily attractive. Some of the hindrances are perceptions. And so I think that if we do more education with pension funds, you'll have more adoption. The hindrance is many times people don't understand, or there's some fear or some concern. But I wanted to point out, another major concern is the volatility of the currencies Pan-African wise. But if you look at Kenya, the shilling's volatility is really quite low. So I think Kenya is actually quite attractive. And of course, we're looking for long duration assets. The yields that you get on long duration assets in the United States are still quite small. Another trend that's, when I was at Wellington as a partner, I chaired the industry strategy group, where we would identify headwinds that were facing some industries and tailwinds that were propelling others. And when I think of a major tailwind in the US markets, it's ESG, environment, social and governance investing, and impact investing is also picking up. So when you think about what is happening with the infrastructure in Kenya, there's a lot of impact that is coming, and there are very strong impact investors. And increasingly, we've seen that the returns in the equities are greater if a company is more ESG centric. So I think that the opportunity to bring the investments or to co-invest, as you mentioned, Roz, should be quite attractive. Now, I want to point out again, from a context standpoint, this is not an African versus US issue. If you look at the $4.3 trillion of assets that are managed in the United States, less than 1% is going to infrastructure right now in the US. So another hindrance is, well, we aren't even investing in it here. Where should we start? Should we start here, or should we start outside of the United States? And I think to the extent that there can be some partnership arrangements, and these are the things that MiDA is considering and trying to facilitate, I think you'll get much more adoption.
Yep. Thank you, Valerie. Thank you for that. And that's a great segue to Dave Thompson, because you mentioned the low allocation or investment in infrastructure in the US. It's a topic that's frequently talked about, especially during election years. And then after that, it just all go back on the table with insufficient action to support it. David, tell us about Power Africa and the work you're doing in Africa, and how can you partner with some of your main initiatives? How can you partner with KEPFIC and other pension fund managers in Africa based upon the work that you do?
Thank you so much, Rosalind. First, I want to say I'm so happy to be back in East Africa after just completing 4 years in Tanzania, even if I'm only with you virtually. So I would really love to be with you, and I hope we are all able to cross borders and be together again soon. So Power Africa leverages the combined tools and resources of 12 US government agencies, 19 development partners, and more than 150 private sector partners. Power Africa's more than 70 full-time boots-on-the-ground advisors, 10 of which are based in Kenya, are embedded in ministries and utilities across the continent. And they work through our network of embassies and USAID missions to help governments, utilities, and independent power producers develop and negotiate critical commercial documents and create strong and transparent regulatory frameworks necessary to support public and private sector investment in their respective energy sectors. So when Power Africa was first launched about 7 years ago by President Obama, we started providing technical assistance for energy development in Kenya as a focus country. Our work then and now supports development of Kenya's power sector, as well as in other countries, through a combination of financing, transaction and technical assistance, advocacy, and investment promotion. Power Africa's work to mobilize over $1 billion in private investment in Kenya addresses a significant hurdle for many projects and will accelerate power projects across technologies. Since 2013, Power Africa has helped 124 projects reach financial close, and those projects are worth a combined $22 billion. And 8 of these 124 projects are in Kenya. These 124 projects will produce more than 11,000 megawatts of new electricity when they are fully online. In its continuing work to strengthen the relationship between the US and African energy sectors, Power Africa also directly supports the United States government's Prosper Africa initiative with a commitment to increase two-way trade and investment between the United States and Africa by working to improve African governments' capacities to manage the power sectors and leverage the playing field for competitive investment. Coordinating with Kim and Prosper Africa and our East Africa Energy Program will bring technical support to KEPFIC to advance transactions with increased investments. Thank you, Rosalind.
Thank you so much, David. I will now go back to our pension funds on the ground after hearing from Power Africa and how the work they're doing in Kenya and how they can collaborate to working with your pension funds, as well as hearing from Valerie how U.S. investors are looking at infrastructure, and if they're looking to close their funding gap, the area to look into will be infrastructure in Africa because of the generous returns that is not being realized in the U.S. So whatever that hurdle is, and we talk about it every day as we engage with pension funds in the U.S., it's more of a perception versus actual risk. You know, you hear about the risk all the time, and most time it's perceived risk. And I can even say today we have just as much risk in the U.S. as we have in emerging markets, especially in Africa. So if I can go back to Onesmus and Josephat and ask you, what have been some of the key challenges that you are facing with your board and with your members and with your asset allocation in general, as you tend to balance your asset allocation to infrastructure and the returns from it? What are some of the challenges that you are facing?
Thank you, Rosalind. As I stated earlier, we got no exposure in our fund to infrastructure, and therefore mine would be learning from my colleagues here on how their experience has been, and especially how they have been able to navigate the issue of due diligence, the complexities that we as trustees perceive investment in infrastructure to have. But generally, the challenge has been that this being a new concept, trustees have been have been adopting what I would call a wait and see. You know, you want to see what the others will do, and then from there you pick the points and see whether they are successful or not. again, given the long-term, the long-term nature of infrastructure investments, somebody would be thinking like the money will be there for close to 30 years and all that. So issues of liquidity come in and all that. But again, let me just listen the experience that my colleagues have had, especially those who have exposure in infrastructure. Thank you.
So before, just 1 second, let me throw in a follow-up question there. You currently have no exposure to the asset class. Is it an asset class that you are considering? And if so, what do you think it's going to take to move the needle for your trustees?
Thank you. Yeah, this is something that as a board of trustees we are considering. If you listened earlier on, this concept of KEPFIC actually started in our boardrooms, that is KRA boardrooms. And ideally, we were looking at how is it then that pension schemes can come together, just give out some little money and invest as a team. So this is something that we are considering. And of course, a lot has been done. The demystification about the investment in infrastructure has been done. And therefore, it will be so easy for us to convince our fellow trustees and also our members. As we were talking, we did realize that infrastructure is long-term, just like the pension schemes. And therefore, it's a perfect match, as we learned, for our liabilities in future. Thank you.
Thank you, Rosalind. The unfortunate thing with the Onesimus is he will be joining when we have already taken everything home. So as you wait to learn, just already taking the harvest home. Infrastructure investment is an asset class that is not well known. Or alternative investment, it's not an asset class that is known by members, not even the board of trustees, not even us who are seated here. So the bigger issue you have it is the research that you need to do, the capacity building with your board and your staff, because this asset class is like something that you are getting into, you have never been into, you might be the first one getting into, you don't even know the return that is expected than the promised expectation, which most of the time you know very well the promise and what is delivered is completely different. So there's a lot of capacity building. Due diligence is very costly. We have incurred a lot of cost in due diligence for alternative asset classes, and also convincing board of trustees to increase the ticket size, because you feel like the kind of the investment for you to even to get a board membership in some of those investments, you have to have a better ticket size. So even convincing your board to give more becomes a big challenge. Additional to that, members don't understand the asset class. So when you're going to the AGM and explaining to member, you have invested to an asset class which previously was being called other. Is until last month it's have its own category, becomes a very hard even to explain to the regulator. So those are some of the challenges. Other challenges when you think about the exit, because as you get in, you have to think about the exit. So as all expected, it will be very hard to exit this asset class. So you have to have your everything, the plan very well done to be sure that as you get in, the exit will also be soft for you. But unfortunately, most of the schemes are waiting for others to take home everything and to join, where there's only what is believed for them will be what maybe most of you will be joining. What will be left for them is a small markup, which will be very small, that we have already taken home and will be going to another asset classes. But the unfortunate thing that the bigger challenge I see in the future is regulations, because sometimes what I think of is, what if one day after investing so much in infrastructure investment, which is a long-term investment, all my trustees asking me, what if the regulator wake up one day and come with the regulations that says that members can access their benefits before the age you have expecting. This new regulation comes allowing members to access, I think, 60% for houses. What happens 2 years from now? They say members can access and clear their circle loans. Where will you get the money from? Thank you.
Thank you so much. And liquidity is really an important part of infrastructure investment. It is long-term. However, you are getting constant returns on that long-term investment, although you cannot exit as quickly as you want to exit. And hopefully that's where your asset allocation actually come in matching your liabilities to the value of the fund. Okay, so I've heard about that, where there's consideration for extending loans for housing in Kenya, and they're looking to the pension funds to extend those loans. But again, they are loans, right? So those loans have to be paid back, right? And I'm not sure what the details are. But that it's very important to do an asset liability study to determine what is your asset versus the liabilities that you have to pay out, and what are the frequency of those payments, and how you can match infrastructure investment with those liabilities. I actually think it's a good match, because it pays over the long term, and the return over the long term is perhaps greater, as Valerie indicated, than it is on the public markets, which you experience a lot of volatility from. But let me go over to Nicholas, our fund manager, and ask Nicholas to talk about improvements on the macro side in Kenya and other factors that are leading to attractive opportunities that you believe outside investors should be looking at. Can you discuss some of the improvements, what they are, and why investors should seriously consider investing in Kenya?
Thank you, Rosalind. And before I jump to the comment, I think I just want to make a comment after Joseph on the regulation issue. And I quite like the analogy you talked about, the perceived and the real risks, because in Kenya, and I'm happy Kili is here, who holds in CPF probably north of 50 billion. Every single regulation which you require to go through, we are able to adequately influence and advise the government, both RB and CMA, and they've been very supportive. So when we talk about change of regulation in terms of housing, in terms of withdrawal or retirement age, I don't think it should really be a hindrance in terms of investment classes, because we still are able to lobby as service providers and the industry, and we're able to influence what, of course, works in our favor. At the end of the day, the government is very pro these investments. You realize these infrastructure projects largely hinge on the government. So it's very unlikely for them to not hear us if we, for example, jump into them and they start talking about movement of retirement age to 50 or thereabout. That said, Rosalind, I think in terms of the macro bit, one of the key things we've been talking about for the last 10 years, and this has been very live in the Kenyan space, is just demographics. And when you talk about demographics, you talk about consumption, you talk about the 75% of the average age below 35 years old, tells you what will happen in this country in the future going forward. And we have seen people who spotted those opportunities quite fast. We are very happy with the likes of Acorn, because when they come to talk to us, they represent a product backed with data. And you're able to see what they're mapping out in the next 10, 15 years quite easily. That said as well, the drives by government in terms of infrastructure, one of the key comments I made when I was starting off is the growth in pension assets, which cannot probably only be backed by government debt. But again, that government debt has gone a long way into infrastructure spend, which is the roads all the way back in 2003. You will see what happened in terms of infrastructure expenditure, in terms of roads, in terms of networks, in terms of processes in the country. And that has had a ripple effect on the economy. So when you look at Kenya, we have a lot of things going in terms of demographics, in terms of the government, in terms of the political space as well. We have seen some key institutions which the government is controlling quite able demonstrate their place in the economy, starting all the way from the regulators, CBK, RBA. We are here virtually because of what RBA did in 2001. Even in 3 years ago, when they came back and said about all investments under one fund manager, is just to be able to guide them to walk into this kind of investments which you're seeing, which is alternative investments. That's it, Rosalind. Again, you'll see the equity markets has virtually stalled, mainly because of there are clearly more opportunities outside the equity markets. People are not going to listing. And why you're seeing all this fight from private equities sending money in Kenya and larger East African is because of the opportunities that they're being able to support. And for us as fund managers is to try and see the best way we can structure pension scheme money into that investment. So in terms of the macro factors, Rosalind, inflation is controlled. We are a well-balanced economy in terms of reliance to particular sectors. Again, when people are going through specific issues or specific countries, Kenya was ranked up there in terms of how well balanced the sectors are, which means if you have a pain point, for example, if it's Zambia, for example, and you have a pain point in mining or oil industry, for example, in Nigeria, for us in Kenya, it would take almost 3-4 sectors to actually buckle for you to see a stall, a stagnation in the economy, which I believe is going to be the case currently and also going forward, which continue propelling growth in the Kenyan economy. Thank you, Rosalind.
And thank you for that detailed answer in response to why Kenya is an attractive investment location. David and Valerie, I'm reaching out to you guys. David, tell us more about how can we engage in transactions with the Kenyan pension funds. How can we work more closely with KEPFIC? How do you see that taking place? First David and then Val, and from Val's perspective, how can we engage the U.S. institutional pension funds to facilitate and participate in co-investments in Kenya and Pan-Africa, but specifically today for Kenya? David, I'll start with you.
Great, thank you. Thank you, Rosalind. So, let me make sure, am I muted?
We can hear you.
Okay,
yeah.
Great. Sorry. Yeah. So Power Africa is working to close a significant gap in between Africa's energy finance needs and its current finance realities in 3 ways: by strengthening the enabling environment, by crowding in new types of investors, and by continuing to play a catalytic role in mobilizing commercial capital and moving transactions forward. So regarding strengthening the enabling environment, when we speak of the enabling environment, just want to make sure everybody knows we're talking about the spectrum of political, legal, regulatory policies and practices that determine whether a country is an attractive or risky place for investors. In Kenya, Power Africa has supported an improved enabling environment for energy sector investment in the following ways. Power Africa implemented the Grid Management Support Program. This program supported the development of a new electricity grid code, which has helped with the successful integration of intermittent renewable energy projects into the country's generation mix. Power Africa also supported the KEPFIC and Public-Private Partnership Unit of the National Treasury to update the policy framework to support development of new transmission infrastructure through public-private partnerships. Following the support, 5 transmission lines were approved for development through public-private partnerships, and the procurement process has been initiated. And also public-private partnership support has been provided to KenGen, who under their current strategy plan to increase partnerships with the private sector to develop new geothermal generation plants. So regarding crowding in new types of investors, we need to look at who is not investing and how can we engage them. Specifically, we need to tap into domestic pools of capital through African pension funds and institutional investors and unlock US institutional capital. Infrastructure yields long-term stable returns as has already been mentioned, that institutional investors like pension funds look for, and African pension funds are typically denominated in their country's own currency, so investments could avoid currency depreciation risk. Also, there's a pool of trillions of dollars, foreign institutional capital, and many investors abroad have expressed openness to better understanding opportunities to participating in Africa's infrastructure sector. We hope to continue exposing market opportunities in the power sector, increasing global investor awareness of African markets, and bridging the information gap to reduce perceived risk. And lastly, regarding playing a catalytic role in mobilizing commercial capital and moving transactions forward, the philosophy of Power Africa is to partner to achieve development results. And so we partner with African governments, such as in Kenya, with development community, civil society, and the private sector. Our approach to achieving our generation and access targets is to identify suitable transactions and leverage our toolbox of financing and transaction facilitation tools to support them through the project development process and make them investment ready for you all there. We provide a flow of bankable deals for investment to the private sector, development partners, and other international financial institutions. And with our on-the-ground teams, as I mentioned before, we support transactions to negotiate through countries' legal and regulatory processes and agreements to reach financial close. Key to continued investment in the energy sector is a viable utility. So Power Africa also supports utilities to improve their performance, cost recovery, and quality of service through technical assistance to reduce technical, commercial, and collection losses. We do not seek to substitute or crowd out commercial capital, and we coordinate among US government agencies and Power Africa partners on assistance to projects to enhance development impact. Back to you, Rosalind.
Thank you, David. So Val, if you can take us from there, understanding US investors' interest in engaging and learning more about opportunities in Kenya, what are some of the infrastructure sectors you think they should be looking at? And again, KEPFIC has done a lot of work in coming together, in pulling these pension funds together to collaborate and pool the funds for investments. What do we need to do to attract US investors to join with KEPFIC on projects? And what are some of those projects that you think they will find more attractive?
Thank you very much. And before I jump into that, I'm going to take a page off of David's introduction. It's really, really, really good for me to be here. I studied in Kenya a long time ago. I went to the University of Nairobi for a semester and absolutely loved it, and came back last year. So I have a fondness. So if I can be very helpful in any way to help institutional dollars come there, I'm going to come there. In fact, I worked with Maendeleo Yawanawake as an intern a while ago, and hung out at the Y and the University of Nairobi. So anyway, it's just really, really nice to be here. And with that, I would say, again, if you think about US investors are looking for low correlated attractive risk adjusted returns, right? So, and I think infrastructure in Kenya offers that. And so with most cases, you've got to get people in the room and just start talking about perceived risk versus actual. You start speaking about start with what is it that US pension funds need. Yield is low all around the world. Yield is abundant in this asset class. Also returns that have low correlation with existing returns, and importantly, attractive returns, absolute attractive returns. And as you know, many of the pension funds are, at least the public pension funds, are significantly underfunded in the United States. So they have to look for alternatives that are going to help and ultimately be additive to the portfolio. And so I think it comes down to relationships. Like, even though this is a numbers game, it's a relationship driven function that's really important when you're trying to decide what are you going to invest in. The other thing I think it helps actually is to see that your own pension funds are investing in the asset class, right? So if you aren't investing in it, I would be surprised if somebody would ask, well, maybe they know something more that we do. So I think that would be helpful. So maybe working with those who have already invested or those who haven't, to just talk through the issues. And as I was a portfolio manager at Wellington, and so I managed quite a bit of money. And when you're thinking about the risk and you might say this is attractive, sometimes what we would do is, and what I would do is just start to invest a little so you can see, because you invest a little where it's not going to do too much damage, but at least it forces you to follow. And you can see in real time how this asset class is performing against anything else. And if it works, you invest it. It's almost like an option, but I think I would encourage our pension funds to do that, as well as the local pension funds doing that. I don't know if that answered your question.
It did, and thank you for that. For those of you who have not read my full bio, I was previously a CIO and a pension fund executive, and I too struggle with allocating to infrastructure for some of the reasons that our colleagues on the platform mentioned, the long-term nature of it. Will the project continue to generate those consistent, attractive returns over the long term? But we eventually broke down, and as Val said, we invested a small allocation, 5 million. We started with 5 million, and the fund size is about $1.8 billion. So out of that, we allocated 5% to infrastructure. And that fund, within 2 years, started to generate a return. Within 2 years, compared to private equity that was taking up to 8, 9, 10 years to generate a return. So lately, I'm no longer there, but they have increased that allocation to 12%, just based on the initial investment they've made. So Val is absolutely right. We just have to start. And having skin in the game, it's a very attractive reason, not to mention some of the reasons mentioned earlier, demographics, attractive opportunities, support from the local pension fund, support from regulators. All of these are reasons why investors, especially our US investors who are watching, to consider looking into some of these attractive opportunities. So go ahead, Val. You got 2 minutes uninterrupted.
That's funny. The other thing is, you think about it, there aren't too many inflation-adjusted assets that are available to investors. And infrastructure typically is going to offer some inflation protection. Now, there's argument as to whether or not there's going to be inflation because of how the economies have responded. But our inflation numbers have come down for so long that it's just starting to happen, that people, tips are becoming more attractive, and people are starting to pay attention to what's going to happen in the future. Because you think about the liabilities of the pension fund are actually quite long. So to be able to match the liabilities, well, this is another point I wanted to say. We've had equity markets that have gone through the roof, completely through the roof. So you have to, just from a conscientious and governance standpoint, you've got to ask, are those returns likely to continue? And increasingly more corporate pension funds are thinking about, they're thinking about this asset liability matching, because more of the corporate pension funds are not underfunded. And when you aren't underfunded and you've had this incredible run up in the equity markets, now's the time to lock things in. And I think infrastructure plays a really attractive role there. You can do it with treasuries, but you can also do it with infrastructure, because treasuries in the United States the yields are just awful. Right. They've been in 50 plus years.
Thank you, Valerie. I believe we've got about 10 more minutes, and thank you, audience, for sticking with us. We will now go to Q&A. I believe there are 2 or 3 questions on the floor. George, can you assist us with the Q&A?
Yes, I was actually standing, Roslyn, so that I can be able to signal you for that. So we are having a Q&A at this moment. I want to check from the chat. I can see questions. I will pick a question from the audience. I want to see the hand so that I decide who goes first. I want to see the hands. I've seen one. Okay, yes, I see the rest. Okay. First, introduce yourself.
Thank you very much, Roslyn and the panel. My name is Osia Kili. I'm an administrator for one of the largest pension funds consortium within Kenya for the local government. I want to ask a question to the Power Africa and Val there about the opportunities available for partnering directly with Kenyan Pension Fund, which is interested in investing in energy production and reticulation within the local government space, because our constitution allows our regional or county governments here to make investments in power distribution and power production, and therefore there's an opportunity there which we would like to spearhead as a local government pension scheme in Kenya. So if is there an opportunity for possibly direct partnership between the US pension funds who would like to get into that opportunity? And of course, from the discussion you have had here today, you realize that there's good opportunities, particularly in the renewable energy space, and also particularly in geothermal space, and also in hydro. So if there is, thank you very much. We would be very happy to have such discussions. Thank you.
David, you want to start?
Yes, thank you very much, Rosalind. Thank you for the question. So let me get the advertisement up front. If you are an investor and you're working on a specific transaction and you'd like to work with Power Africa, please get in touch with us. So our email, organizational email is powerafrica@usaid.gov. And our website is www.usaid.gov/PowerAfrica. So we have a dedicated team that works with investors like yourselves, and we're familiar with the broader landscape of financial offerings and markets. And we can put you in touch with someone on that team. They'll get to know you in your transaction, and we'll be able to advise on the best next steps. For example, this could be connecting you with a Power Africa technical advisor on the ground, one of our US government interagency contacts, or any number of other potential actions. And so we're already working in Kenya with Kenya Investment Mechanism and the East Africa Energy Program, which is based in Nairobi. We have committed to funding the Kenya Investment Mechanism support to KEPFIC over a 2-year period. And we're very pleased with that partnership. We look forward to seeing positive progress on upcoming goals related to closing the first KEPFIC facilitated investments by Kenyan pension funds and KEPFIC's gradual transition to a self-supporting institution. So we have support to KEPFIC Secretariat, its legal formation, etc. KIM will also provide transaction support for pension fund investment opportunities in the infrastructure and power sectors, leveraging KIM's network of experienced transaction advisors. Regarding the East Africa Energy Program, or EAEP, as we call it, this is Power Africa's primary implementing mechanism for supporting the on-grid power sector in 11 countries in East Africa. It's headquartered in Kenya with on-the-ground teams possessing a good understanding of regional energy sector landscape, with the regional energy sector landscape. EAP optimizes the power supply, helps to optimize the power supply. We help to increase grid-based electricity access. We help strengthen utilities and other power sector entities, and we increase regional power trade. So we can, please contact us. We can connect you as appropriate with the people to advise you and see where we go. Thank you.
Thank you, David. Any further questions, George?
Any other question? Let me see a hand. Okay. I was trying to do to that gender role, so please help me.
Okay, thank you. Yeah, this is Rono once again from CPF. Maybe perhaps a question to Valerie, especially in an experience on investing in Africa. How do you compare in terms of the return perspective of the investments which has been placed in Africa and the ones and the investments you've done in domestic, that is in US government? How do you compare the return perspective? Do you find investments made in Africa in general, maybe not specifically Kenya, to be more appealing? And maybe the other question to the panelists seated in front here, one of the biggest challenges of investing in alternative asset classes is actually maybe the level of knowledge on the side of trustees. Taking these new investment opportunities to trustees, they will straight on just say no. Not because the investment is not appealing, but it's because maybe they don't understand the investment which is being undertaken. What do you think needs to be done? Is it an aspect of education, or it could be an aspect of regulations? Do we force pension funds to invest in some of these vehicles? Because if you look at, actually, there's a joke in terms of who owns Kenya. And when you look at who owns Kenya in terms of the major investment, is actually foreigners. It's actually foreigners investing or in some of the PE funds, or the PE funds getting money mostly from foreign companies who now come and invest in our country. Why is it so difficult for local institutions, local pension funds to invest in our own country? Thank you.
I think that's a really good question, and I'm going to take your last one first. It's education is really critical. So if I take you back to where New York State Common Fund was several years ago, we invested very little in the infrastructure and alternative space. Take out infrastructure, just alternatives in general. It started off at 5% and then 10%, but over the last 20 years, it's been incredible. We're now close to 40% of all of our pension assets are in alternatives. Why? Because, so there's 10% in real estate, there's up to 10% in private equity. We've gotten out of venture capital. I take that back to me. Some people define alternatives differently. We have a 25% cap. Take that back. It's 25%, but then there's alternative credit. And so depending on how you define the categories, but we started off at 1%. And I think, and if you look at the returns of the colleagues on our panel, one had a return of 9%, but the one that was involved in alternatives, their return was 12%. So I think it's imperative that you open the aperture and start to consider a broader set of options. You've been really blessed that you've gotten really attractive returns from government bonds. So when our first speaker pointed out that 45% of the portfolio was in government bonds, that's just mind-boggling from where we sit, because on our side, we use very little for government bonds, and it's used as an anchor to windward. So we would use that in the event, it's sort of insurance, in the event that everything falls apart, the government securities will do fine. Whereas it's sounding like the government bonds, because the yields are so attractive, that's sort of the safe haven. But you can't, we used to say scared money won't make money. So you can't fly unless you're willing to let your feet leave the ground. So you have to take some risk. And where is a good place to take risk? Locally. So I think the question that you're asking the pension funds is a really good one. Take the risk and think about the comprehensive returns. You want your fiduciary, so you want financial returns, but to the extent that it's helping the economy, I think you have to think broader, and that's what we're doing in New York State Common. We just committed $20 billion that we're going to put in impact investing over the next 2 years, which is pretty aggressive. Now that's 20 billion out of a 200 plus billion portfolio, but think about that. We're going to do that focusing on impact. And so anyway, to answer your earlier question, which was directed to me, how are the returns compared for Pan-African investing versus domestic? That question is really a function of the tenor. So if I invested right after the global financial crisis, the returns were much stronger in the US because they were so depressed. But if you do an apples to apples comparison in the bond markets or even in the equity markets, there's usually an additional yield that comes from a class not as well understood. So the yield benefit has been more attractive to go into Africa. And I think going forward, what's really, really, really compelling is that the growth in Pan-Africa is so much more attractive than Japan, than the US, than Europe. And so I think that's a really strong story.
Yeah, thank you, Val. There was a point made about education, and one of the local pension fund mentioned the need for trustee education. I like to highlight that because that's something that MiDA advisors will be able to assist with. That's something that the World Bank will be able to assist with, as well as Power Africa. But that education goes both ways. We need to bring that education right back here to the US, to the US pension funds who do not have enough knowledge about Africa and the attractive opportunities in Africa. There's something called seeing is believing. So over the past 3 years, MiDA has been taking US investors to Africa to take a look firsthand at some of the projects, excuse me, some of the projects that are available. And that was an eye-opener. I was one of those investors who came to Senegal and to South Africa. I came to Kenya later, but on the first 2 delegation trips, to see firsthand the attractive opportunities there were, and to take that back to my trustees and my board and educate them. So, it's easy to invest in China, right? Because everybody's saying China, but a lot of investors in the US know very little about China or about the risk in China. But that's coming sometimes from the money managers industry who have gone and done the due diligence and hit the market with these products. So we need that kind of exposure from the money managers community and from MiDA and Power Africa and other groups to educate the US pension funds about the attractive investment in Africa and the value of working with KEPFIC. When you have your colleague private equity funds putting their own skin in the game, the least we can do is to jump in there with them for development of their community. And look how many jobs it could create, not to mention the resources it provides to these communities. So I just like to throw that in there. And with that, I'll go back to George. Do we have one last question, George?
I'm sorry, Rosin. I think I want to make a comment because
Sure.
this is one of the few opportunities I get to give feedback to the trustees without affecting my contract. So, Rona, I like the fact you've brought the bigger issue to the room. And the issue of education, we've had it for the last 6 to 8 years. And at the end of the day, as much as we are here as KEPFIC, it will boil down to the individual trustees. And we do expect to see some level of support when it comes to that level, when it comes to those tabling of those approvals. But that said, we are sitting with trustees who increasingly are getting aware, and the fact that Kili is here for a whole day, I'll tell you he's a very busy man, and sorry for bringing your name all the time, is because you simply have no choice. We have schemes who are literally bursting in the seams. You have nowhere else to take money. Unless you get clever and you jump ahead of the alternative investment class, then you will start, buckling under the pressure of non-performing equity markets, which are moving from sideways or having 4 cycles in one single year. Government yields, which are nothing to write home about, or the fixed deposits Ken was talking about, which is virtually no one wants to pay you for that. At the end of the day, you'll end up jumping into what you call junk alternative investments because you simply did not take the time to do it well and do it early enough. So as much as you may, as trustees, you may think it is a choice you have, if I speak from a personal point of view, I don't think you have any choice. Some of the schemes you're talking about right now, and Ken will tell you, most of the schemes you're managing as 4 managers. That's how big they've become. Back in the days, it used to be 1 manager. But now you're sitting with schemes like Kengen, which are 25 billion plus, and there's so many of them. So quite literally put, trustees have no choice. You simply have to embrace it. You simply have to become courageous at some point. They say fortune favors the brave. So at some point, you simply have to say, let's start with 5%. Let's start with 2% in this. And at the end of the day, as fund managers, we are there to tell you about the risk factors. So when we come back and say this is a risky affair because this particular issue, then of course, don't fight us back because we're just telling you our professional opinion. But at the end of the day, there's so many things we table, and trustees will simply, for the lack of clarity, will not take a decision, and it will pass. So at the end of the day, you just urge the trustees when the reports come, when we see the likes of the players from the US coming on board, and they're willing to jump into bed with us, it's for a reason. It's just to spark the economy and spark the industry. And for us, we look for the day we'll be talking about, we are asking RBA, can we lift the 10% on alternative investments? We'll be happy to talk about the US scenario. 40% is sitting in alternative investments, which is where the real economy is. Thank you.
I think just because I know you cannot mention this, unfortunately, I think the barrier to alternative is also have been brought about by fund managers who either don't understand the asset class or who fear that getting to this alternative asset class, you are pulling some money from them. So it's not all the fund managers, but some of the fund managers either don't understand it or they fear the asset class. So that is also one of the barriers to this alternative asset. Thank you.
Thank you. Thank you. Okay. Thank you very much. Thank you very much. I think that point is really exciting to the audience. I am afraid Rosalind, we are really running out of time.
Okay.
I look at the audience and ask if there is a burning question that you feel if you don't ask, you will actually ban. Going once?
George, I have a burning comment.
A burning comment,
yes,
which will ban you if you don't.
In light of the last comment by Josphat. So Josphat, that's a fair comment, and I think I speak on behalf of the association. There has been increasing input even from the World Bank as far back as 2012 and 2011 to try and develop the capacity within the local industry. So some investment houses have embraced it, and some others are still lagging behind. But that said, of course, we take up the challenge and try and bring the industry to a fair playing ground in terms of information and, of course, understanding of the particular products.
Thank you. Thank you very much. Rosalind, I'll take it back to you to close that session.
Okay, thank you so much. Just to mention a few points, a few takeaway in closing. We have resources and partners available to work with KEPFIC and the Kenyan Pension Fund to advance their goals and objectives to the next level, which is the level of transactions. I'd like to reach out to the pension funds in Kenya who have not yet signed up to work with KEPFIC to please join us, because I think we have a very good organization. The goals and objectives are right on point and will take Kenya to the next level of development that not only will provide the resources needed in Kenya, but will also provide attractive returns for their investors and the participants. There's also a need for education that came out several times from several members of the panel. The need for trustee education in Kenya as well as in the US about this asset class and how we can increase allocation to the asset class. And as always, as a former director, the participants, it's their money, and you are only the custodian of that money, and making the right investments to improve their pension fund, it's part of your mandate. So there are organizations like MiDA, like USAID, our sponsor, and Power Africa, the World Bank, all standing by to work with you in that education level. So I'd like to thank the panels today for their insight and sharing their valuable experiences with you. And I hope that we brought something to the table. I'd like to thank the pension funds in Kenya who participated on the panel, as well as our fund manager. Thank you so much. I'll turn it back to George.
Thank you, Roslyn. Thank you, our panelists. We really appreciate your time. So I'll ask you to take back your seats as I welcome back on stage Ngatia. Ngatia is going to do closing remarks. I know it has been a long day, but it has been a long and exciting day. So thank you. Welcome, Ngatia.
Everybody, thank you, those who are still dialed in, for all the participants, all our speakers. We appreciate you today. Before I make the closing remarks, there has been a request that we play our KEPFIC video, the one that we showed first on Wednesday. So if I may ask the team to put it on our screens and we can watch it. Thank you.
In the search for optimal returns, Kenyan pension funds, like those the world over, continue to scout for profitable and impactful investment opportunities. While most pension funds have traditionally invested in government securities and blue chip stocks, investments in infrastructure and other alternative asset classes present an innovative, profitable, and long-term sustainable opportunity. The Kenya Pension Funds Investment Consortium, KEPFIC, is a consortium of Kenyan retirement benefit funds that have come together to make long-term infrastructure and alternative asset investments in the region. Infrastructure investments offer attractive returns, portfolio diversification benefits, and match long-term assets to long-term liabilities. And over the next 5 years, KEPFIC aims to mobilize $250 million from Kenyan pension funds and offshore co-investors for investment in impactful infrastructure assets. To do this, KEPFIC aims to identify suitable infrastructure opportunities, pool investment capital from local pension funds and co-investors, and build the technical and investment capacity of our member funds to enable them to make informed infrastructure investment decisions.
Infrastructure, by its very nature, is a very complex investment class. It requires costly due diligence and research, and the amounts required, or the ticket sizes, are beyond the capacities and regulatory limits for individual pension funds. And indeed, when you look at the pension fund industry in Kenya, we have 1,300 pension funds, and most of these are too small, and even the larger ones would struggle to invest in infrastructure on their own.
Kenya faces a significant infrastructure financing deficit estimated at $2.1 billion annually, a deficit that cannot be met by public resources alone. While historically infrastructure has been the domain of national and county governments, there is a significant opportunity for private sector participation as more private capital seeks longer-term steady returns, while governments are faced with much-needed competing priorities such as healthcare, food security, and education. infrastructure presents an attractive yet underutilized investment opportunity for pension funds, and the involvement of private institutions will not only contribute to Kenya's economic growth and transformation as a whole, but also to better project governance structures by adopting global best practices. Thanks to a recent provision in the Retirement Benefits Authority investment guidelines, Kenyan pension funds can now invest up to 10% of their assets into infrastructure, effectively unlocking over $1 billion into the asset class.
We have recently amended our investment guidelines to allow schemes to invest a portion of their assets in infrastructure. We are therefore very supportive of KEPFIC's mission to bring together different pension schemes and other stakeholders which are keen on investing in this area of infrastructure, and is also bringing together other stakeholders to develop the infrastructure investment agenda.
KEPFIC was recognized as the Pension Fund Infrastructure Initiative of the Year at the 2019 Africa Investor Awards held in Cape Town, South Africa, further validating its mission and shining a brighter light on the East Africa infrastructure investment opportunity globally. The consortium has also received technical support from USAID and the World Bank to help local member funds navigate the infrastructure investment terrain, and by working with the mobilizing institutional investors to develop Africa's infrastructure initiative MiDA, KEPFIC has further leveraged its mission and established a partnership with US-based pension funds with total assets under management in excess of $1 trillion to explore infrastructure co-investment opportunities in the region.
KEPFIC presents an innovative approach to investments that will catalyze critically needed sources of private sector capital for infrastructure development. This comes at a time when national and county governments are facing growing budget deficits and competing priorities in healthcare, affordable housing, education, and food security. USAID's Kenyan Investment Mechanism is pleased to partner with Kenya Pension Fund Investment Consortium to support this expanded source of new capital.
MiDA Advisors has been supporting KEPFIC in the creation of a local consortium of pension funds to invest in infrastructure. We're working under the umbrella of the U.S. Agency for International Development. Our goal is to support a strong partnership between American pension funds and Kenyan pension funds. And American pension funds need a critical partner in the region, and like-minded investors that are working for the benefit of its retirees and that are looking to undertake economically important projects in infrastructure, in housing, supporting job creation and economic development in the region.
By joining KEPFIC, pension funds will participate in infrastructure investments and enjoy several benefits such as economies of scale in the infrastructure investment selection, structuring, and due diligence processes, capacity building through live deal analysis and project site tours, regular investment workshops with experts in infrastructure investment, and networking sessions with like-minded local and foreign pension funds. Co-investments with global pension funds. Technical support from implementation partners in the investment selection and execution process. And finally, advocacy efforts by representing its members' interests in regular engagements with regulators and external stakeholders and contributing to supportive policy measures.
Investing in infrastructure for us is an interesting asset class because it provides an opportunity for us to make a difference in the development of our country as well as other regions. What we benefit by working together as KEPFIC is access to knowledge, access to risk management, and access to partnership with other like-minded investment vehicles.
KEPFIC, mobilizing institutional capital for impactful infrastructure investments.
So thank you very much. I would like to take this time to just thank all our partners. Let me start off by recognizing and thanking the local pension funds, their trustees, and their secretariats. So, as you have heard, KEPFIC is an initiative by pension funds and for pension funds. And we are here because of you and to serve your members who are hardworking Kenyans who rightfully deserve a secure future post-retirement through prudent investments. I also want to thank our steering committee members for their leadership through the years. Thank you for nurturing this initiative from its small beginnings to where we are today. To our implementation partners, USAID, and in fact a special mention for USAID's Kenya Investment Mechanism, and the team led by the Chief of Party, Roger Bird. It truly has been a pleasure working with you on this common mission to mobilize private capital. To the World Bank Group, we'd like to thank Mr. Alan Dennis for speaking at our launch on Wednesday, and the team led by Caroline Seruti for continuing to support the development of our strategy. MiDA advisors, Emric Saha and Rosalind Spencer and their team in Washington, D.C., thank you for helping put KEPFIC on the map with global investors, which are a critical part of this initiative. To the government of Kenya, Dr. Julius Muya, the Principal Secretary, National Treasury, who spoke at our launch and endorsed this initiative and has opened his door for us for any matters that we may require his assistance. We also want to recognize and thank our regulator, the Retirement Benefits Authority, and their CEO, Mr. Nzomo Mutuku. Supportive policies underpin all that we do, and we thank you for challenging us to do more. To the Capital Markets Authority and their market deepening team, who continue to express a lot of support for KEPFIC and the use of capital market instruments in achieving our goals. And to the Fund Managers Association and your members, you are a critical partner on this journey that we shall walk together. Last but certainly not least, to our event sponsors, to Acorn and GuarantCo, Edward, Koi, Janice, and Sam. We are extremely grateful for your generosity in sponsoring this great conference today. But beyond that, you have brought to us live deal opportunities, well structured to attract our kind of capital. All while emphasizing this truth, and I would like to close on this, the truth that Kenyan pension funds have the financial capacity locally to invest in these opportunities and many others and drive this agenda forward. Asanteni sana. Thank you.